So picture this. It is early 2026.
Right.
A beautiful, sunny Saturday morning in Madrid. The skies are just, perfectly clear.
The kind of day that totally begs you to go outside, take a walk, and just enjoy the city.
Exactly. But Spanish financial analyst Jose Luis Cava is definitely not outside.
No, he is not. He has deliberately locked himself indoors.
Yeah, completely isolating himself from any potential distractions. And he does this to record a really deeply technical, chart-heavy defense of his favorite asset.
And he's doing this right in the middle of a massive market panic, which is the really crucial part.
Right. The timing is everything here.
It is. Because in February of 2026, Bitcoin experienced some incredibly aggressive price drops.
Oh, yeah. The broader sentiment among casual investors was tilting heavily toward fear.
Very much so.
Yeah.
Yet Kava remains just fiercely optimistic. He sat down to record this video titled, "Why I Am Bullish on Bitcoin."
And his stated mission in this video wasn't to, pitch some get-rich-quick scheme to you.
Not at all. His goal, along with his team at OPLA, is to basically provide young people with a framework.
A framework to defend their wealth against what he identifies as the systemic degradation of fiat currency.
Right. So today, for this deep dive, we are opening up Kava's charting blueprints.
We are going to unpack his very specific thesis, and we'll be moving from this fascinating historical allegory about 19th century monetary policy,
Straight into the really practical mechanics of modern tax loss harvesting.
which is super interesting. And from there, we're going to look at the psychological warfare of, institutional market manipulation.
It's a huge topic. But before we really dive into the mechanics of his argument, we kind of need to establish the ground rules for what we are looking at.
Yeah, that's a good point, because Kava's analysis leans pretty heavily into political themes.
He does. He argues that politicians deliberately print money to buy votes.
Right, effectively impoverishing the working class just to maintain their own power.
So we need to be explicitly clear right up front that our role today is just to analyze the mechanics of his argument.
Exactly. We are looking at the financial architecture he describes and how his view of macroeconomic history informs his charting strategies.
Right, and his price predictions. But we are not endorsing any specific political viewpoint here.
No, not at all. Nor are we taking sides on the historical political conflicts he brings up.
We are simply decoding the source material for you to understand his overarching philosophy on why markets move the way they do.
Okay, so let's unpack this. To understand why Kava believes an asset like Bitcoin is even necessary today, we first have to understand his core premise.
All right, his premise regarding fiat currency.
Yeah,
Okay.
and to explain how a nation's wealth degrades, he doesn't point to some dense Federal Reserve white paper.
No, he uses a children's book.
Which is wild. Specifically, L. Frank Baum's 1900 classic, The Wizard of Oz.
It's a brilliant framing. Kava asserts that The Wizard of Oz was actually never meant to be a simple fairy tale.
Right.
He aligns with this well-known economic interpretation that Baum's work is actually a really sophisticated, biting critique of the U.S. monetary system.
Specifically at the turn of the 20th century, right?
Exactly. This is a period of just immense economic upheaval, and Baum was allegedly embedding all those macroeconomic struggles into the characters and the setting of his story.
So let's start with the geography of the story itself. The name Oz isn't just some whimsical, made-up syllable.
No. According to this framework, Oz is literally the standard abbreviation for ounce.
Wait, like the measurement?
Yeah. Specifically the troy ounce, which is the foundational unit of measurement in the precious metals market.
Oh, wow. So Dorothy is literally trapped in the land of the gold ounce.
Exactly. And to navigate this land, she is instructed to follow the yellow brick road.
And Kava points out that these yellow bricks are quite literally gold ingots.
Right. The yellow brick road represents the gold standard itself.
That makes so much sense.
In the late 19th century, the United States was fiercely debating its monetary foundation.
Because the gold standard meant that the currency in circulation was strictly tied to the amount of physical gold held in government vaults, right?
Correct. So Dorothy is walking on this rigid, inflexible foundation of the era's monetary policy, just trying to find her way to a solution.
And the companions she meets along that road are basically avatars for the distinct economic classes suffering under that system.
Yes. So the first companion is the scarecrow, who famously doesn't have a brain.
Right. So, economically speaking, the scarecrow represents the agricultural sector of the American Midwest.
Places like Kansas, where Dorothy originates.
Exactly. And during this period, farmers were caught in a brutal economic trap. They were producing massive yields of grain.
Huge yields,
Yeah.
raising more cattle than ever. But they were suffering from severe deflation.
So deflation is the really critical concept here. Because the money supply was restricted by the physical scarcity of gold, the value of a single dollar was incredibly high.
Right, which meant prices for goods were just dropping. Farmers were selling their crops for less and less money.
But, and this is where the agrarian crisis truly deepened for them, their debts were fixed.
That is the real trap. If a farmer borrowed $1,000 to buy equipment, that $1,000 debt became increasingly difficult to pay off.
Because they were earning pennies on the bushel compared to what they used to make.
Exactly. They felt completely outmaneuvered by the Eastern banking establishment.
Hence the scarecrow's defining characteristic, the feeling that he lacks the intelligence to navigate this complex financial system.
Precisely. Then we meet the Tin Woodman.
Right. He is rusted solid and lacks a heart.
Economically, he represents the rapidly growing industrial working class. The U.S. economy in 1900 was violently transitioning.
Moving from an agrarian society to a massive industrial powerhouse.
Yeah, and Kava provides essential context for this transition. He points to the massive waves of immigration creating just an enormous labor pool.
So because there was this massive surplus of desperate labor, business owners had all the leverage.
Right. Kava refers to these owners as desaprensivos, or basically ruthless opportunists.
They had the leverage to unilaterally drive down wages.
Exactly. The industrial worker was treated as a machine, expected to toil endlessly without any compassion.
They were quite literally rusting away, deprived of a living wage and stripped of their humanity.
Which Baum symbolizes as the complete lack of a heart.
Wow. Which brings us to the political conflict of the era, embodied by the cowardly lion.
Right. The lion is supposed to be the king of the jungle, a figure of immense power, but he is terrified.
So in this economic reading of the text, the lion represents a populist politician of the era.
Most commonly associated with figures like William Jennings Bryan.
The guy who famously delivered the Cross of Gold speech.
Exactly. The populist politicians were advocating for a policy known as bimetallism.
They wanted to dismantle the strict gold standard.
Yeah, and introduce silver alongside gold to back the nation's currency.
Because silver was far more abundant than gold.
Right. If you incorporate silver into the monetary base, you can suddenly print a vastly larger amount of paper money.
So they basically wanted to inflate the money supply.
Exactly. By printing more money, prices would rise, which theoretically helps the scarecrow, the farmers.
Because it makes it easier to pay off those fixed debts with cheaper dollars.
Yes. But Kava's interpretation focuses really heavily on the political motivation behind this.
He argues that the Cowardly Lion wanted to attack the gold standard primarily just to print money out of thin air.
Right, allowing politicians to make grand spending promises and essentially buy the votes of the struggling masses.
It's like a modern politician promising everyone free pizza, but quietly making the pizza slices 50% smaller so there are more to go around.
That is a perfect analogy. It introduces a temporary illusion of prosperity.
You expand the money supply, people feel like they have more cash in their pockets.
But the underlying purchasing power of that cash rapidly diminishes.
The structural problems of the economy remain totally unsolved, but the politician secures their power.
Exactly. And waiting at the end of this whole journey in the Emerald City is the wizard.
The Emerald City represent the halls of power, like Washington, D.C. or Wall Street.
Right. Initially, the wizard is perceived as this terrifying, omnipotent architect of the monetary system.
Controlling the entire land of the troy ounce.
But when the curtain is finally pulled back, he is revealed to be a completely ordinary, flawed man pulling mechanical levers.
He is a technocrat, a central banker or a politician projecting this aura of absolute control.
When in reality, he is ultimately just guessing, reacting, and pulling levers in an attempt to manage a system that is largely beyond his true control.
Okay, I actually need to interject and push back on Kava's logic here for a second, because there seems to be a massive contradiction.
Okay, what do you mean?
Well, Baum is clearly writing a critique of the gold standard. He is showing how the yellow brick road leads to absolute misery for the scarecrow and the Tin Man.
Right.
But Kava is a staunch advocate for Bitcoin, which is universally modeled as digital gold. It has a mathematically fixed supply cap of 21 million coins.
It is the ultimate hard money.
Right, so If Kava agrees with Baum's analogy, shouldn't he also agree that a fixed supply standard like gold or Bitcoin crushes the working class through deflation? Doesn't Kava basically disagree with the author?
That is the exact tension Kava addresses, and it is where he diverges completely from Baum's underlying politics.
Oh, interesting.
Yeah. Kava argues that Baum accurately observed the misery of the era, but fundamentally misdiagnosed the cause.
Really?
Yeah, in Kava's view, the gold standard was not the villain at all.
So if the deflation wasn't the problem, what was?
The exploitation of labor by the monopolies,
Hmm.
the ruthless business owners.
Uh,
Kava argues that under a hard money standard, technological advancements and increased productivity actually should lead to healthy deflation.
Meaning the cost of living drops and the purchasing power of the average worker's wage increases?
Exactly. The misery of the 1890s wasn't caused by the gold itself. It was caused by those opportunistic owners artificially suppressing wages.
Despite the hugely increased industrial output.
Right. So Kava actually views the gold standard as a vital stabilizing anchor.
He believes the anchor was doing its job, but the ship's captains were still starting the crew anyway.
That's a great way to put it. Kava extends this logic right into our modern era.
How so?
He suggests that if Baum were observing the economy today, he would see that the flawed but stabilizing wizard of the gold standard has been entirely evicted from the Emerald City.
Right, because in 1971, the U.S. completely severed the dollar's final tie to physical gold.
Exactly. Today, in Kava's view, the cowardly lion is in absolute control.
The populist politicians and central banks are just running the printing presses without any hard asset constraints whatsoever.
And this, Kava argues, is the massive engine of the slow impoverishment we see today.
The constant expansion of the fiat money supply silently drains the purchasing power of your wages and your savings.
The shield against the lion, that hard monetary standard, is just gone.
And this is precisely why Kava believes we need a modern equivalent to the yellow brick road today.
Which brings us to his solution, Bitcoin.
Right. But recognizing the need for a hard asset is really only the philosophical foundation here.
Yeah, Kava doesn't just leave his audience with abstract theory. He transitions into incredibly specific, tactical execution.
Which I loved. If the fiat system is constantly degrading, how do you actually position your capital to protect it?
And what surprised me is that he doesn't advocate for the stereotypical crypto-native approach.
He really doesn't. I mean, the prevailing ethos in the cryptocurrency space is not your keys, not your coins.
Right, advocating for direct ownership through self-custodial hardware wallets.
But Kava bypasses this entirely. He treats Bitcoin as a mature, structural component of a broader traditional portfolio.
He executes his strategy within a standard brokerage environment. Specifically, he references a platform called Freedom 24.
He prefers the traditional infrastructure, but he isn't buying spot Bitcoin ETFs, which, completely dominate the American market headlines right now.
No, he specifically utilizes ETN's exchange-traded notes.
We really need to dissect the mechanics of an ETN, because the distinction between a fund and a note carries entirely different risk profiles.
It is a totally critical distinction. An ETF, an exchange-traded fund, is a trust or a company that purchases a basket of assets.
Right, so when you buy a share of an ETF, you actually own a fractional piece of that underlying trust.
Exactly. An ETN, however, is a debt instrument. It is essentially an unsecured bond issued by a major financial institution.
Wait, so if I'm buying an ETN, I am essentially lending money to an institution in exchange for a piece of paper?
Yes.
A piece of paper that just promises to pay me back based on the performance of Bitcoin? That sounds like taking on massive counterparty risk.
It is.
If the issuing bank goes bankrupt, my note becomes worthless completely, regardless of what the actual price of Bitcoin is doing.
You have identified the core structural risk of standard ETNs. However, the specific European crypto ETNs Kava utilizes are structured to mitigate this exact issue.
How do they do that?
They are physically backed. For every note the institution issues on the exchange, they are legally required to purchase and custody an equivalent amount of physical Bitcoin in cold storage.
Oh, wow. So it's a direct peg.
Yes. This one-to-one backing mechanism ensures that the ETN tracks the spot price of Bitcoin with near-perfect fidelity.
Eliminating the weird tracking errors you commonly see in futures-based products.
Precisely.
So you get the exact price exposure, but it's wrapped in a regulated financial instrument that you can view on the exact same dashboard as your S&P 500 index funds.
It provides tremendous agility.
But the real genius of Kava's methodology isn't just choosing an ETN over cold storage. It is how he actually structures his watch list.
Right. He doesn't just select one Bitcoin ETN. He deliberately selects two legally distinct instruments tracking the exact same asset.
This is where we move from basic portfolio management into some pretty advanced tax loss harvesting.
It is. The primary ETN he selects trades under the ticker symbol BTC.
And he chooses this specific instrument because it has the highest liquidity and the largest volume of assets under management in its category, right?
Exactly. Liquidity is paramount if you are moving substantial capital.
You need to know that if you decide to sell a massive position, there are actually enough buyers on the other side of the trade to absorb it.
Right. Otherwise, the sheer size of your sell order will drive the price down against yourself.
Okay, so that's the first ticker. But then he explicitly adds a second ETN to his arsenal.
Trading under the ticker WBTC.
Why on earth would you buy two different trackers for the exact same asset? Doesn't that just needlessly complicate your dashboard?
On the surface, diversifying across two identical trackers seems totally redundant, but Kava is preparing for the mathematical certainty of Bitcoin's volatility.
He assumes quite rationally that he will eventually make a purchase right before a massive downward swing.
It happens to everyone. Let's walk through the mechanics of a failed trade. You allocate capital into the highly liquid BTC ticker. A week later, the market sentiment shifts. The price plummets 20%, and your position is heavily underwater.
Ouch. So you make the disciplined decision to just cut your losses and sell the position to preserve your remaining capital.
At that exact moment of sale, you have realized an economic loss. Your account balance is tangibly lower than it was when you started.
Right. And in a standard tax environment, you would expect to use that loss to offset capital gains elsewhere in your portfolio.
Exactly, reducing your overall tax burden at the end of the year.
But the crypto market moves extremely quickly.
It does.
Let's say 2 weeks pass, the dust settles, the chart looks incredibly bullish again, and you decide it's time to re-enter the market.
If you simply log back into your brokerage and buy back into the exact same BTC ticker,
You trigger a massive regulatory trap.
you trigger the wash sale rule, or its international equivalent, depending on where you live.
Right. Tax authorities across the globe have very strict regulations regarding the buying and selling of substantially identical securities within a short time frame.
Usually a 30 to 60-day window. The IRS, for example, operates on a strict matching principle.
So if you sell an asset for a loss and immediately buy it back, they argue that your economic position hasn't meaningfully changed at all.
Right. They think you simply shuffled paperwork around to generate a tax deduction.
They view it as a purely artificial transaction. Therefore, they just completely disallow the loss.
They essentially say, we acknowledge you lost money in reality, but for the purposes of your tax return, that loss literally does not exist.
That is brutal. You suffer the actual financial damage, but you are denied the fiscal relief.
It fundamentally destroys the efficiency of actively trading a volatile asset.
And this is exactly the problem Kava's two-ticker strategy magically solves.
Exactly. So, applying his method, you take the loss on the BTC ticker, you wait 2 weeks.
But instead of buying BTC again, you purchase the WBTC ticker.
Exactly. Because WBTC is issued by a different entity, possesses a different legal structure, and trades under a completely different identification number.
Tax authorities generally recognize it as a separate and distinct financial instrument.
Even though its price action is 100% correlated to the asset you just sold.
Wow. It totally avoids the wash sale classification.
The initial sale is legally recognized as a closed final transaction. Your economic loss is firmly locked in as a fiscal loss, ready to be deployed against your tax liabilities.
Meanwhile, by holding the WBTC ticker, your portfolio instantly resumes its full exposure to Bitcoin's upside.
Kava isn't just analyzing the asset, he is optimizing the entire legal and fiscal architecture surrounding the trade.
Here's where it gets really interesting because it demonstrates a level of institutional discipline that retail investors rarely employ.
Very rarely. He's treating this highly speculative digital asset with the same rigorous structural planning a hedge fund applies to, like corporate bonds.
But as Kava acknowledges, even the most elegant tax strategy in the world cannot protect you from the sheer emotional devastation of a market crash.
No, it cannot. Which brings us to the psychological core of Kava's thesis.
Right. If you are going to survive in an asset class capable of dropping 40% in a single month, you have to fundamentally dismantle the way you perceive price charts.
You have to stop viewing the lines on the screen as objective mathematical realities.
To frame this psychological shift, Kava relies on a brilliant quote from a 15th century writer, José de la Vega.
who actually authored one of the earliest texts on stock exchange practices.
Right. And De La Vega described the market as a business of people with the excuse of the economy.
A business of people with the excuse of the economy. That is just a phenomenal lens.
It really is. When you open a brokerage app and see a chart, your brain inherently assumes you are looking at the intrinsic value of the underlying asset reacting to macroeconomic data.
You think you're looking at supply chains, adoption rates, or monetary policy.
But Kava argues you are looking at literally none of those things.
The chart is nothing more than a real-time electrocardiogram of human emotion.
It is a visual record of collective fear, greed, panic, and euphoria. The economic data is merely the excuse people use to justify their emotional reactions.
Exactly. And once you accept that the chart is just a map of human psychology,
Yeah.
you can begin to identify the distinct tribes operating on that map.
Kava categorizes these participants into two starkly different camps: the dumb money and the smart money.
Let's dissect the behavior of the dumb money first. We are talking about the retail masses.
The average people managing their own retirement accounts on their phones while commuting.
Right. The defining characteristic of the mass is that they are entirely reactionary.
They wait for confirmation from the chart before they make a decision.
They look for historical resistance levels, price ceilings, where the asset has previously struggled and failed to break through.
And when the price finally surges past that ceiling, the mass experiences a collective wave of FOMO.
The fear of missing out.
They see the green candles, they see the triumphant headlines on financial news networks, and they just assume the risk has completely vanished.
So they buy heavily into the euphoria.
Conversely, the smart money, meaning the massive institutional players, hedge funds, and market makers, operate with a completely different objective.
And a completely different set of structural constraints.
Right. Because a retail investor can execute a $10,000 buy order instantly, the market absorbs it seamlessly.
But if an institution needs to deploy $500 million into Bitcoin, they face a catastrophic liquidity problem.
Yeah, if an institution just drops a market order for $500 million, they will instantly exhaust all the available sellers at the current price.
Their own buying pressure will violently drive the price upward in milliseconds.
They will end up paying a massive premium for the bulk of their order, effectively destroying their own profit margins before the trade even settles.
They cannot buy in bulk unless they have access to an enormous pool of sellers willing to offload their assets at a low price at the exact same moment.
And how does an institution convince thousands of people to sell a valuable asset cheaply?
They manufacture a crisis, they engineer a panic.
Kava details the precise mechanics of this manipulation. He refers to this maneuver as a burrito, or a sweep.
The institutions use their deep understanding of retail psychology to create artificial volatility.
Designed entirely to shake the assets out of the hands of retail investors.
And Kava doesn't just describe this theoretically. He provides a highly granular historical case study of a burrito in action.
Pointing to the absolute market massacre that occurred in April of 2025.
Put yourself in the position of a retail investor during that specific week.
Okay, leading up to April 7th, 2025. Bitcoin had established an incredibly obvious, highly visible price floor at exactly $74,420.
The chart showed that every time the price dipped near 74,420, it just bounced right back up.
So the retail mass looks at that historical data and concludes that this level is an impenetrable support zone. It feels totally safe.
So they allocate their capital. And to protect themselves against catastrophic loss, they utilize an automated broker instruction known as a stop-loss order.
A stop loss is simply a directive that says if the price of this asset drops below my specified safety threshold, sell my entire position immediately at whatever the market price is.
It is designed to stop the bleeding.
So thousands of retail investors place their stop-loss orders just below that 74,420 floor, assuming it will never actually trigger.
They have unknowingly constructed a massive, highly concentrated cluster of automated sell orders just beneath the surface.
Now, shift your perspective to the institutional desk. The smart money knows exactly where those stop-loss orders are clustered.
They can see the liquidity pool just waiting to be tapped.
The safety net built by the retail investors is actually a giant target painted on their own backs.
Exactly. So to access that liquidity, the institutions deploy a fraction of their massive capital to aggressively short the market.
Or they just sell into existing bids. Their goal is not to exit the market, but simply to apply enough artificial downward pressure to push the price just a few dollars below that 74,420 threshold.
And the millisecond the price ticks below that line, the trap snaps shut.
The algorithmic dominoes fall. Thousands of retail stop-loss orders are triggered simultaneously, flooding the market with automated sell orders.
This massive influx of selling drives a price down even further, which then triggers the next layer of stop losses, sitting slightly lower.
It becomes a self-fulfilling cascade of total liquidation.
And this is where the media apparatus inadvertently aids the manipulation.
Oh, absolutely. The retail investor gets a push notification that their stop loss triggered. They open their app and just see a vertical red line.
They turn on the financial news, and the pundits are screaming about a market collapse.
Kava highlights the specific narratives that emerge during these sweeps. Articles start circulating claiming that the traditional four-year halving cycle is fundamentally broken.
That macroeconomic headwinds are too strong, and that Bitcoin is basically destined to crash back to 50K or 40K.
The psychological pressure becomes completely unbearable for the retail participant. The weak hands investors operating without a deep structural conviction capitulate entirely.
Driven by pure terror, they manually sell whatever remaining assets they have.
Desperate to salvage any remaining capital before what they perceive as the absolute bottom.
And while the masses are fleeing the burning building, literally throwing their assets out the window.
The smart money is standing on the street corner, calmly catching everything. It's like someone yelling, "Shark!" at a crowded beach, waiting for everyone to run away, and then casually taking the best spot on the sand.
That is exactly what it is. The institutions sit at the bottom of the engineered drop-in, this specific case, down at the 60,000 zone.
They quietly absorb the massive wave of panic selling. They execute their massive buy orders by soaking up the cheap liquidity provided by the terrified retail investors.
The intense selling pressure of the panic perfectly masks the immense buying pressure of the institutions,
Keeping the price suppressed until their orders are entirely filled.
Once you understand the mechanics of the burrito, the aftermath of April 2025 makes perfect sense.
The moment the institutions finish their accumulation phase, the artificial downward pressure vanished.
Then the narrative suddenly shifted, and mysteriously, the price began a relentless climb back up the charts.
By March 16th, 2026, it broke right back above that original floor of 74,420, as if the crisis had literally never occurred.
The wealth transfer was complete. The institutions accumulated massive positions at a steep discount.
And the retail investors who relied on obvious support lines were left entirely sidelined, forced to buy back in later at much higher prices if they wanted to re-enter the market.
This analysis is deeply unsettling, honestly, because it suggests the average investor is essentially playing a rigged game against an opponent who can see all their cards.
If the charts are designed to trigger our emotional breaking points, and the obvious support lines are just institutional traps, how does Kava propose we navigate this?
How do you identify where the smart money is preparing to execute their next sweep?
Exactly. If they are invisible, what do we do?
Well, the institutions have immense power, but they are bound by the laws of mathematics. You cannot move billions of dollars without leaving a footprint in the data.
The problem is that retail investors are looking for those footprints in the completely wrong place.
Kava argues you have to fundamentally change which axis of the chart you prioritize.
Let's break this down visually for you. When a novice trader opens a standard candlestick chart, their eyes immediately go to the bottom of the screen.
There is a horizontal row of vertical bars along the x-axis representing trading volume.
The x-axis volume histogram is literally the default setting on nearly every charting software in the world.
But Kava argues it is structurally insufficient for understanding institutional intent. The x-axis plots volume against time.
It tells you that on a specific Wednesday, a massive amount of Bitcoin changed hands.
But time is essentially irrelevant to market psychology. Knowing that a lot of trading happened last week doesn't tell you what is going to happen tomorrow. It lacks context.
Exactly. The critical missing piece of data is not when the transaction occurred, but at what price the transaction occurred.
To find the institutional footprints, Kava ignores the bottom of the chart and focuses entirely on the side of the chart.
He utilizes a tool that plots a volume histogram on the y-axis.
The vertical axis. This completely reorients the data.
Instead of bars shooting up from the bottom based on dates, you have horizontal bars shooting out from the side of the screen based on price levels.
Right. The longer the horizontal bar, the more volume was transacted at that specific price point,
regardless of whether that trading happened yesterday or 3 years ago.
By aggregating volume based on price, you are basically mapping the collective memory of the market.
You are mapping the precise locations where capital is firmly anchored. And Kava has a brilliant, slightly ominous phrase for these high-volume price nodes.
He refers to them as corazones a los que atemorizan, which translates to hearts to frighten.
Hearts to frighten. Let's unpack the psychology of that because it's so dark but so accurate.
If a massive amount of volume occurs at a specific price, it means thousands of investors bought into the asset at that exact number.
That price becomes their psychological baseline. If the market dips below that number, they are officially losing money. They are in the red.
And investors loathe being in the red. It triggers a psychological phenomenon often called break-venitis.
Right. If an investor is holding a losing position, they often refuse to sell, praying for the price to return to their entry point just so they can sell and break even.
Escaping the emotional pain of the loss.
So if you are an institutional market maker planning a burrito, you don't just randomly push the price down.
No, you look at the y-axis, you find the longest horizontal bar on the screen.
You locate the largest cluster of hearts.
You locate the highest concentration of retail buyers, and you deliberately engineer a price drop that drags the market significantly below their specific entry point.
You literally force them into the red. You maximize their emotional pain until they break and capitulate, handing you their liquidity.
And Kava uses this exact y-axis methodology to identify the ultimate battleground of the entire market cycle.
He points to one specific data point on his chart.
He identifies that the absolute highest volume of Bitcoin traded since the profound bear market lows of 2022 and 2023.
The single longest horizontal bar on the entire y-axis sits at exactly $67,100.
That 67,100 level is not just a line on a graph. It is the center of gravity for the current market structure,
It represents the highest concentration of capital deployment by the retail mass.
which perfectly explains the absolute severity of the April 2025 sweep.
The institutions didn't just break the obvious 74-420 support to trigger a few stop losses.
To accumulate the sheer volume of Bitcoin they required, they had to go much, much deeper. They had to inflict maximum systemic damage.
Breaking 74-420 initiated the cascade, but the true objective was 67-100.
To flush out the deeply entrenched capital, the smart money had to smash through that ultimate psychological baseline.
They had to take the largest single cohort of buyers in the entire market and put them in a position of severe financial loss,
They dragged the price all the way down to 60,000.
plunging the 67-100 buyers deep into the red, triggering the final, most desperate wave of capitulation.
They absorbed that panic, and only then did they allow the price to recover.
But the critical takeaway from Kava's methodology is how his interpretation of the 67-100 level completely changes after the sweep.
Because that specific price point was so viciously targeted.
Because it absorbed a massive institutional assault, and the broader market ultimately survived and recovered above it.
That node undergoes a structural transformation in Kava's eyes.
It is no longer just a high-volume target. It has been forged into absolute armor. It is a battle-tested foundation.
Kava now designates 67,100 as the concrete floor for future macroeconomic price movements. It is the absolute anchor.
And having that anchor provides immense psychological armor for you, the investor.
If the market experiences sudden volatility next week and the financial press starts screaming about a crash because the price drops from 80K to 72K,
Kava remains entirely unfazed. He understands that any price action happening above 67-100 is just noise.
just institutions playing games with the x-axis. As long as the y-axis foundation holds, the macro thesis is totally intact.
It allows him to decouple his emotional state from the daily volatility and focus entirely on the long-term trajectory.
So we have mapped the historical imperative, the tax structures, and the psychological warfare.
We know exactly where the concrete floor is built. So the final question to address from Kava's early 2026 analysis is the projection.
If 67,100 is the floor, where is the ceiling? Where is this asset structurally programmed to go in this cycle?
To project the future price, Kava employs a charting technique known as parallel channels.
But consistent with his overarching philosophy, he does not draw these lines arbitrarily at all.
Novice traders often just connect random price wicks, the absolute highest or lowest trades of a given day, to draw their trend lines.
Connecting wicks is inherently flawed because a wick might just represent a single anomalous algorithmic trade or a momentary flash crash.
It doesn't represent sustained market consensus in any way.
Exactly. Kava bases his geometry entirely on the y-axis volume nodes we just discussed.
He only connects points of maximum emotional resonance and capital concentration.
To draw the foundational upward trend line, the core vector of the asset's momentum, he starts at the absolute depths of the previous bear market.
He anchors the starting point at the massive volume node established in the 20,000 zone.
That represents the point of maximum historical despair, the true bottom of the cycle.
And he draws a line connecting that 20,000 node directly to the newly established, battle-tested concrete floor at 67,100.
By connecting those two massive pillars of historical trading volume, he establishes the true angle of ascent.
But a single floor line doesn't provide a target. To find the ceiling, Kava clones that foundational ascending line, maintaining its exact mathematical angle.
And he projects it upward to create a parallel channel.
He takes that clone vector and rests it on top of the localized historical peaks.
He aligns it with the resistance points established in March 2024, March 2025, and January 2026.
When you project that specific localized channel forward in time, it outlines a slow, grinding, structurally sound upward corridor.
In the upper boundary of that corridor, the first major target points directly to $105,000.
So 105K is the immediate structural ceiling. But Kava's analysis doesn't stop at the localized data. He zooms out to view the entire macro cycle.
He takes that same foundational angle of ascent and draws a second, vastly wider parallel channel.
This time, instead of resting it on recent resistance, he aligns the upper boundary with the absolute macro peaks of the massive, euphoric bull runs of 2021 and 2025.
He is mapping the trajectory of peak historical euphoria.
And when you trace that wider, more aggressive macro channel into the future timeline of this cycle, where does the geometry point?
It points to a staggering structural target of $137,000.
We have a conservative structural target of 105,000 and a macro bull run target of 137,000.
But before anyone takes those numbers as gospel, Kava issues a stark and vital warning regarding how to actually use this data.
Right. He emphasizes repeatedly that he is not offering a crystal ball.
He cannot guarantee that Bitcoin will hit 137,000 on a specific date.
Or that another engineered burrito won't temporarily plunge the price. He isn't selling certainty here.
He is offering a framework for critical independent thought.
So, what does this all mean? The ultimate lesson Kava imparts is that success in this market requires you to systematically invert your natural psychological responses.
You must stop acting like the mass. Mass buys when the chart is breaking through the ceiling and the media is euphoric.
Which is precisely when the smart money is preparing to unload their bags on you.
And the mass panics and liquidates their holdings when the chart breaks a support level.
Which is exactly the moment the smart money is deploying capital to accumulate.
To survive, you have to train yourself to look past the x-axis and find the true volume on the y-axis.
You have to locate the hearts to frighten. You must patiently endure the burrito, watch the institutions shake out the weak hands.
And only deploy your capital when there is maximum terror in the market.
It demands an exceptional level of discipline. It requires you to constantly question the prevailing consensus, understand the underlying mechanics of liquidity.
And never allow your financial decisions to be dictated by engineered panic.
It has been a phenomenal intellectual journey today.
Yeah.
We began by walking down Dorothy's yellow brick road, uncovering how a beloved 19th century fairy tale was actually a sophisticated critique of monetary policy, deflation, and wage suppression.
We explored how Kava utilizes specialized ETN structures on platforms like Freedom24 to legally navigate wash sale rules.
Harvesting tax losses while maintaining total market exposure.
We dissected the anatomy of the burrito, learning how institutional capital engineers market panics to hunt retail stop losses.
We learned how to find the true concrete floors of the market using y-axis volume, specifically identifying the 67,100 battleground.
And finally, we looked ahead through the lens of parallel channels to massive structural targets of 105K and 137K.
It truly demonstrates the necessity of looking beneath the surface layer of financial data to understand the human architecture driving the movements.
It really does.
But before we close out this deep dive, there is one final conceptual thread I want to pull, something that builds on Kava's historical framework.
Oh, what's that?
We spent a significant amount of time analyzing how L. Frank Baum used The Wizard of Oz to represent the painful transition to an industrial economy under a strict monetary standard.
Right. The Cowardly Lion was printing money, and the wizard was a flawed technocrat trying to manage the gold standard.
It was a perfect allegory for the era. But if we extend that analogy into the present day, recognizing that we are currently undergoing an equally massive transition from traditional fiat banking to decentralized digital architectures,
The cast of characters has fundamentally changed.
the yellow brick road is no longer paved with physical gold ingots. It is constructed from cryptographic code.
And we are all currently trying to navigate our way out of a system where the Cowardly Lion has absolute control over the Emerald City's printing presses.
This raises a highly provocative question regarding the future of this new financial system. Who or what occupies the role of the modern Wizard of Oz?
In Baum's original text, the wizard is ultimately revealed to be a flawed, ordinary man hiding behind a curtain, projecting an illusion of power.
In the story of Bitcoin, the creator is the pseudonymous entity known as Satoshi Nakamoto. Satoshi wrote the foundational code, launched the network, and then famously disappeared behind an impenetrable curtain of cryptography.
Voluntarily relinquishing all control.
Is Satoshi the modern wizard? Or by designing a completely decentralized open-source protocol governed entirely by unchangeable mathematics rather than human intervention?
Did Satoshi actually engineer a system where society no longer needs a wizard at all?
A monetary foundation that operates without a central authority pulling the levers.
It fundamentally redefines the structure of power in the Emerald City.
Something to think about the next time you look at the y-axis. Thank you for joining us on this deep dive, and remember to always question the consensus. You know, usually when we talk about investing, there's this expectation of a fair game.
Right, like an even playing field.
Exactly. You study the board, you make your moves based on fundamentals, and, well, if your strategy is solid, you win. It feels like chess.
Yeah, and it's a comforting illusion, honestly. I mean, we really crave that kind of meritocracy.
We do.
The whole idea that, rigorous analysis of a company's balance sheet is the ultimate deciding factor of your financial future.
But step into the actual engine room of global finance, and the chessboard just disappears.
It's gone.
You realize you're actually in a casino, and worse, well, the house can see your cards.
Yeah, they really can.
They know your vulnerabilities, they know your psychological breaking points, and the floor you're standing on is literally a mechanical trapdoor.
A trapdoor designed to drop you the exact moment you feel secure.
Exactly. And exposing exactly how that rigged casino operates is our mission today. We're jumping into a really singular, highly provocative deep dive.
The fascinating one.
Yeah, we are working from a transcript by a Spanish financial commentator named Jose Luis Cava. And to set the scene for you listening, it's this energetic Friday morning in Madrid.
Which is such a specific vibe.
It really is. Our source is soaking in this beautiful springtime vibe before, the brutal Spanish heat sets in.
Right, he's in remarkably high spirits.
He is. He even notes that because it's Friday, quote, the body knows it.
Low breath.
And in this kind of euphoric state, he promises to share one of the most, he calls it mischievous or wicked stories he has ever told.
And, the tone of the transcript is fascinating because he is intentionally contrasting this light, breezy Friday morning energy with just an utterly ruthless teardown of global financial structures.
Yeah, he's pulling back the curtain on the things you really aren't supposed to see. So we are going to tear down the popular financial narratives you hear on the nightly news. We're going to look at the supposed AI bubble. We're going to dissect the hidden mechanical traps of market manipulation, and we'll untangle a massive geopolitical web involving Iran, crypto, and the U.S. presidency.
It's a lot of ground to cover.
It is a ton. But before we get into the mechanics of all that, I really need to make something crystal clear to you listening.
Very important point here.
Yeah. Today's source material makes direct, highly specific claims involving highly charged political figures and geopolitical entities.
Specifically Donald Trump, the Iranian Revolutionary Guard, and international financial sanctions.
Right. So I want to state firmly right here at the top that this deep dive does not endorse or take any political side.
Not left-wing, not right-wing, or otherwise.
Exactly. Our sole purpose today is to impartially report and just unpack the exact claims and ideas contained in the original source material.
We are operating strictly as analysts here. We're mapping the architecture of his claims to understand his broader philosophy on how money moves.
Regardless of the political names attached to those movements?
Exactly.
Okay, so let's start mapping. Our source introduces this concept he calls weak hands.
We can't, right.
It's this overarching thesis that the financial market isn't just fluctuating based on, the natural push and pull of supply and demand.
Right, it's not organic.
No, it is actively mechanically engineered to sweep your investments out from under you. And to survive the 2020s, he insists we have to go back and intimately understand the year 2000 dot-com crash.
Yeah, and he frames the year 2000 not just as a historical event, but as a real personal awakening.
Oh, so?
Well, for the average person, the dot-com crash is just a cautionary tale about buying into hype.
Right. Cats.com and all that.
Exactly. But for our source, living through that bubble was the moment the Matrix sort of revealed itself. He explicitly credits the 2000 crash with transforming him into what he proudly calls a good speculator.
I actually find that term good speculator really telling.
It's very deliberate.
It strips away that pretentious veneer of the word investor. Like, an investor pretends they are buying a piece of a company's soul or something.
Right, building the future together.
Yeah. But a speculator acknowledges they are just placing a calculated bet in a system with hidden levers.
Completely.
And he draws a massive, heavy line connecting his awakening in the year 2000 to the current moment we are in right now with artificial intelligence.
And that parallel is pretty unavoidable because both eras share a foundational characteristic, which he calls a productivity miracle.
Right, because every time you turn on the financial news today, the anchors are just shouting that AI is a massive bubble.
They're constantly comparing it to the late 90s.
They draw a straight line to Webvan or, companies with zero revenue and a multi-million-dollar Super Bowl ad.
Yeah, classic dot-com blunders.
But our source rejects the bubble narrative entirely because the underlying technology in both eras fundamentally altered human output.
It wasn't just hype. In 2000, the internet and Microsoft's enterprise tools radically changed how we communicate and process data. The utility was completely real.
And artificial intelligence is providing a genuine leap in human productivity right now. I mean, code writes faster, data is synthesized instantly.
The utility is very real. But, the debate hinges on whether the market is pricing that utility rationally.
Exactly.
If the narrative claims we've lost our collective minds and are overvaluing AI, we have to look at the actual valuation metrics.
So let's look at the price to earnings ratio, right? The PE ratio.
The gold standard for this kind of thing.
Yeah. And for you listening, if you aren't deep into equity valuation, just think of it like this. Imagine your neighbor has a local lemonade stand.
Okay, eliminate step.
And this stand reliably generates exactly $1 in pure profit every single year.
Consistent. I like it.
Right. Now, if your neighbor offers to sell you the entire stand for $10, the PE ratio is 10.
Because you are paying 10 times its yearly earnings.
Exactly. Meaning it will take you 10 years of those profits to break even. Now, if your neighbor demands $190 for that exact same stand that only makes $1 a year...
Well, then your PE ratio is 190.
Right. You are paying a massive premium. You're essentially betting that this lemonade stand is going to magically invent a new flavor of lemon and, take over the global beverage market.
And that analogy perfectly isolates the concept of speculative fever. The higher the PE ratio, the further you detach from the current, grounded reality of the business's actual cash flow.
It's all just hope at that point.
Exactly. And when we apply this metric to the source's data, the AI bubble narrative just shatters.
It really does. I actually pulled the specific numbers he cites, and the contrast is just staggering.
Let's hear them.
So in the year 2000, at the absolute zenith of the dot-com mania, the NASDAQ 100, which tracks the 100 largest non-financial tech companies, it had an average PE ratio of 190.
Think about that. A collective market paying $190 for a single dollar of profit.
It's insane.
Pure, unadulterated speculative mania.
But today, with everyone screaming about an AI bubble, the current NASDAQ 100 sits at a much cooler PE of 36.
Wow. So that alone dismantles the comparison. We aren't even playing the same sport as the year 2000.
No, we really aren't. And let's drill down into the specific companies he mentions, because this is where his argument gets incredibly sharp.
Yeah, he makes some great direct comparisons.
He points to Microsoft in the year 2000. Now, they were the engine of the productivity miracle back then, and their PE hit 57 at its peak.
A very high premium.
Right. Fast forward to today, and the undeniable poster child for the AI boom is NVIDIA.
They make the chips that power the entire revolution.
Everyone just assumes NVIDIA's valuation is completely detached from reality. But the source points out that NVIDIA's PE is actually sitting around 19.
A PE of 19 for a company holding a near monopoly on the foundational hardware of a global technological shift.
It's wild.
It is. The stock price has certainly skyrocketed, but the underlying profits, the actual cash they are pulling in from selling these chips, has surged right alongside it.
So the growth is backed by actual revenue, not just a promise of future dominance.
Exactly. And to put that PE of 19 into perspective, our source makes a brilliant, almost comical comparison.
Oh, I love this part.
Yeah, he doesn't just compare NVIDIA to other tech companies. He looks at traditional, boring retail giants.
He looks at Walmart and he looks at Costco, which he actually refers to as COS in the transcript.
Right. These are companies selling bulk, toilet paper, mayonnaise, and groceries.
And what are their PE ratios?
They are currently hovering in the 45 to 50 range.
So the market is perfectly willing to pay $50 for $1 of Costco's profit, but only $19 for $1 of NVIDIA's profit.
It's wild when you say it out loud.
Yeah.
When you lay those metrics out side by side, labeling AI a bubble becomes, frankly, intellectually dishonest.
Yeah.
A company driving a generational leap in computing power is trading at a significantly cheaper valuation than a big box retailer.
And there is a structural layer to this stability that the source highlights too. He talks about the hyperscalers.
The massive tech conglomerates like Google, Meta, and Microsoft.
Right, the ones building these colossal AI data centers. If we look back at historical bubbles, like the telecom boom in the late 90s or the housing bubble in 2008, the rapid expansion was overwhelmingly fueled by toxic, unstable debt.
Oh, absolutely. Companies are taking out massive loans just to lay fiber optic cable or build subdivisions.
Hoping the future revenue would eventually cover the interest payments.
And when a market is built on leverage like that, any slight disruption in revenue causes the whole debt structure to collapse inward.
Like a house of cards.
Exactly. But our source emphasizes that these hyperscalers are playing a completely different game. They're funding this massive AI infrastructure build-out using their own resources.
Yeah, they're sitting on mountains of cash generated by their existing search engines, their social networks, and software subscriptions.
They aren't going to the bank to borrow money to buy NVIDIA chips. They are writing the check from their own massive reserves.
Which means the foundation of the AI build-out is fundamentally unleveraged. The growth is solid, the valuations are surprisingly conservative, and the debt risk is minimal.
Which forces the good speculator to confront a deeply unsettling paradox.
And this is the pivot for you listening, the realization that changes everything about how you view the market.
Because if the fundamentals of AI are genuinely strong,
If the technology is a real productivity miracle,
and the companies are flush with cash, then why do markets still experience catastrophic crashes?
right. The uncomfortable truth our source reveals is that technological revolutions and strong balance sheets do not actually cause the stock market to rise.
Fundamentals are just a side dish.
Yeah. The main course, the only ingredient that genuinely drives market indices upward, is expansive monetary policy.
Liquidity.
Yes. And we really need to define this because this concept completely shifts how you watch the evening news. Let's use an analogy.
Okay, let's hear it.
Imagine the stock market as an exclusive high-end nightclub. The tech companies, your Microsofts, your NVIDIAs, they are the architects and the venue owners.
They build a gorgeous club.
Exactly. They install a state-of-the-art sound system. They set up incredible laser lights. That is the productivity miracle. The club is structurally flawless.
But a beautiful room doesn't guarantee a party.
No, nobody's going to dance if the room is dead silent and the bar is totally dry.
So who brings the party?
The central bank, the Federal Reserve, they are the DJ and the bartender combined. They control the liquidity.
Okay.
In this analogy, liquidity is the music and the alcohol. When the Fed pumps liquidity into the system, they turn the bass all the way up and start handing out free drinks.
The party explodes.
Right. People are dancing on the tables, throwing money around, and the market soars. But the moment the central bank decides the party is getting too rowdy, they don't just, ask people to calm down.
No, they cut the music.
They turn on those harsh, blinding overhead lights, and they lock the liquor cabinet.
And the party crashes instantly. It doesn't matter that the venue has the best sound system in the world. When the liquidity vanishes, the euphoria evaporates.
And the source has a very specific, slightly adversarial term for the central bankers who control this flow. He calls them the champions of monetary degradation.
Monetary degradation. It sounds like an accusation of a crime.
It really does.
But for speculator, it is simply a mechanical reality. By injecting massive amounts of capital into the financial system, central banks degrade the purchasing power of the currency.
Which pushes that capital into assets like stocks, artificially inflating their prices.
Exactly. He looks at Jerome Powell, the current chair of the Federal Reserve. The source notes that Powell's mandate is nearing its end around the time of this recording and points out that under Powell's watch, the Dow Jones climbed roughly 93%.
A 93% climb is a historic run.
A purely fundamentally driven market would almost never see that kind of aggressive, sustained upward velocity. That is the result of the liquidity faucet being left wide open.
Yet, despite that massive run, our source doesn't actually view Powell as the ultimate architect of this system.
No, he reserves that title for Alan Greenspan.
Yeah, and he gives him a phenomenal sarcastic nickname. He calls him Alan Burbuhita Greenspan, which translates to Alan Bubblemaker Greenspan.
Calling him Bubble Maker isn't just a slight, though. It's a recognition of Greenspan's legacy.
How so?
Well, Greenspan pioneered the modern approach of using massive liquidity injections to smooth over any economic bump in the road. He taught the market that the Fed would always arrive with free drinks if the parties started to lull.
And this brings us back to the great lesson our source learned in the year 2000. Because if the dot-com bubble wasn't just a collection of bad ideas, what actually caused it to burst?
Let's talk mechanics. How does the central bank turn on those harsh overhead lights?
They do it by raising the cost of money. When a central bank wants to inject liquidity, they lower interest rates, making borrowing incredibly cheap.
Right. Companies borrow to expand. Investors borrow to buy stocks on margin. Money is practically free.
But when they want to pull liquidity out, when they see inflation rising or the market getting just too euphoric, they hike the federal funds rate.
And suddenly, the cost of servicing debt skyrockets. That practically free money now comes with a massive monthly interest payment.
Precisely. And in 2000, Greenspan aggressively hiked rates. He pulled the liquidity. The highly leveraged tech companies suddenly couldn't afford their debt payments.
Furthermore, institutional investors looked at those newly raised interest rates and realized they could pull their money out of risky tech stocks and put it into safe government bonds.
Because suddenly bonds were offering a highly attractive risk-free yield.
The capital just flooded the casino. Bubbles don't burst because investors suddenly look at a spreadsheet and realize a PE of 190 is illogical.
Right.
They burst because the central bank alters the mechanical flow of money.
And conversely, if we look at the monumental, unprecedented liquidity injections following the 2008 Great Financial Crisis and the trillions pumped in during the 2020 COVID pandemic.
Those mechanical actions are the only reason the markets are sitting at the elevated levels they are today.
The takeaway for you listening is pretty profound. Stop agonizing over the quarterly earnings report of a single tech company and start watching the macro flow of liquidity from the central banks.
The Fed is the true driver of the market. Everything else is just scenery.
So we've established that the narrative around what drives domestic stock prices is a carefully maintained illusion.
Yes.
But our source argues that these illusions don't stop at the edge of the stock market. They extend deep into global geopolitics.
This is where it gets really intense.
We're constantly told by the media that there is a rigid, rules-based global banking system. But when you look at how shadow liquidity actually moves, the narrative just falls apart.
And this is where he introduces that mischievous story of the highest order. He pivots from domestic monetary policy to the dark, untracked flow of global capital.
He cites a bombshell report from the Wall Street Journal. And again, as a quick reminder to our listeners, we are strictly reporting and analyzing the claims made in this text.
We are looking at the mechanics of these allegations impartially.
The source points to a WSJ report claiming that Iran has essentially constructed the financial architecture for its war efforts, specifically the funding of the Revolutionary Guard, entirely around blockchain technology.
The implications of this are just staggering. The Iranian state, operating under some of the most severe economic blockades in modern history, is allegedly bypassing the entire SWIFT banking system using cryptocurrency.
But I have to push back on the mechanics of this, though. Because as a layman, the prevailing narrative is that crypto is anonymous. But anyone who actually studies blockchain knows it's a public ledger.
Right, it's totally public.
Every single transaction is recorded for eternity. So how does a heavily sanctioned nation-state move billions of dollars to fund military operations in plain sight on a transparent ledger?
This seems impossible.
The U.S. Treasury Department employs armies of analysts whose sole job is to track these exact digital footprints.
It's the great paradox of digital finance, really. The ledger is public, yes, but it is pseudonymized. You see a string of letters and numbers moving money to another string of letters and numbers.
Okay.
State actors use highly sophisticated mixing services to obfuscate the origin of the funds, breaking a single transaction into thousands of microtransactions across hundreds of wallets.
But here's the critical bottleneck, right? Eventually, that digital currency is useless if you can't buy physical goods with it.
Exactly. You can't buy military hardware with a USB drive full of
You
Bitcoin.
have to convert it. You need an off-ramp into usable fiat currency.
Precisely. And to move money at a sovereign scale, you can't just use a local peer-to-peer meetup. You have to move it through a massive, highly liquid exchange.
And according to the source, the exchange sitting at the center of this geopolitical funnel is Binance.
The largest cryptocurrency exchange on the planet.
The source claims that from the year 2024 to the present, over $1 billion in transactions have been processed by Iran through Binance,
$1 billion.
flowing right through the center of the global financial system, while Iran is under total international sanctions.
And here is where the mechanics of the story turn truly wicked. Because Binance is not a scrappy startup operating out of a basement. They have a massive, highly sophisticated compliance division.
They utilize chain analysis software specifically designed to flag OFAC sanctions evasion.
In fact, the source highlights a stunning detail. Binance's own compliance team actually detected these movements.
Oh, really?
Yes. They flagged a massive volume of these transactions as suspicious.
Wait, let's process that. The internal software worked. The compliance officers saw the volume. They saw the digital fingerprints pointing toward Iranian entities. They formally flagged it within their own system, and the transactions still went through.
They were allowed to clear. This is the paradox our source really wants the listener to confront. The United States threatens severe secondary sanctions against any global bank that dares to process a single dollar for Iran. Yet $1 billion of internally flagged, highly suspicious transactions allegedly flow unimpeded through the biggest digital exchange on Earth.
If a traditional bank like JP Morgan or HSBC had internal documents showing they manually approved $1 billion in flagged Iranian transactions, the Treasury Department would have shut down their operations by noon and executives would be facing federal indictments.
Without a doubt.
So how does Binance survive that? What is the mechanical explanation for that level of regulatory immunity?
The source provides a deeply cynical, purely political explanation for why these transactions might have been ignored by authorities. And again, using strictly impartial analytical language here.
Right.
The source claims this blind eye was the result of political leverage and financial quid pro quo.
What are the specific claims he makes?
He points out that the founder of Binance was ultimately pardoned by Donald Trump when he assumed the U.S. presidency.
And a presidential pardon removes the legal jeopardy.
Furthermore, the source explicitly claims that Binance contributed heavily to financing Donald Trump's campaign activities.
Okay.
And he goes a step further, suggesting that Binance likely provided operational or financial aid to the Trump family's own private cryptocurrency business ventures.
Wow. So the source is outlining a transactional mechanism. He is arguing that the severe, supposedly unbreakable rules of global banking are actually malleable.
Highly malleable.
The implication is that regulatory enforcement, even for massive sanctions violations, can essentially be neutralized through strategic political financing and familial business favors at the highest levels of government.
That is the exact narrative architecture he is building. For the good speculator, the lesson here is vital.
Which is what?
The media constructs a narrative of a rigid, rules-based world order, a world of unbreakable sanctions and vigilant regulators. But the reality of how global finance actually operates is highly porous.
It is politically compromised.
Yes, liquidity, whether it's flowing from the Federal Reserve to Wall Street or from illicit accounts through Binance, will always find a path if the right gatekeepers are incentivized to look the other way.
It's an incredibly dark view of global systems. It suggests that laws are just pricing mechanisms for doing business.
That's a great way to put it.
If you pay the toll to the right political figure, the rules basically cease to apply to you.
And the good speculator doesn't waste time debating the morality of the system. They simply observe the mechanical reality of the money flow and position themselves accordingly.
Which brings us to a really critical juncture for you, the listener.
Yes, how does this apply to the individual?
We've established that central banks manipulate domestic markets with liquidity pumps, We've established that massive shadow networks move billions outside the traditional rules using political leverage. So where does this leave the everyday investor?
Right, you don't have a direct line to the Fed chair, and you aren't laundering billions through an offshore exchange. What is your position in this shadow system?
To answer that, our source points to a highly optimistic macro forecast. He references a group he follows closely, referred to as the OPLA team.
The OPLA team, yeah.
And their projection for the near future, specifically targeting the year 2027, is essentially a financial utopia.
A utopia, which feels entirely contradictory to everything we've just discussed about rigged systems and shadow economies.
It really does. What exactly are they projecting?
The OPL team predicts that by 2027, private consumption will be incredibly robust. They forecast that the stubborn inflation we've been battling will finally cool down to that magical 2% target that central banks aim for.
Okay, sound good so far.
They predict a broad acceleration of the U.S. economy, and crucially, they predict that interest rates will be significantly cut by someone the source refers to as Kevin W.
Kevin W., based on the context of aggressive rate cuts in central banking, it's highly probable he is using a shorthand for a figure like Kevin Warsh.
Or at least using that name as a stand-in for a deeply dovish, market-friendly policymaker who will aggressively open the liquidity faucets again.
Whoever Kevin W. represents, the mechanical implication is clear. Cheap money is coming back.
The music is going to get very loud, and the drinks will be free again.
Ultimately, the forecast declares that 2027 could be one of the best years in the life of a good speculator.
It sounds perfect. It sounds like the moment you want to take out a second mortgage and put every dollar you have into the market.
But,
And that feeling of absolute security is exactly the trap.
because we have to return to his foundational concept, the concept of weak hands.
The trapdoor.
If 2027 is destined to be a massive, euphoric run upward, fueled by central bank liquidity, you still have to survive the journey to get there.
And the market makers, the institutional giants who actually control the flow of trades, have absolutely no intention of sharing those massive profits with retail investors.
Let's bring back the casino analogy. The market is a casino where the house can see your cards. Our source calls these market makers completely shameless.
Shameless is the perfect word.
But how does the trapdoor actually function mechanically? How does the house see your cards?
To understand the mechanism, we need to understand how retail trading actually works today. When you place a trade on an app on your phone, your order doesn't just float into the ether.
Right.
It is often routed through a system called Payment for Order Flow, or PFOF. Market makers pay retail brokerages for the right to execute your trades.
Which means these massive institutions get to see the aggregate data of exactly what retail investors are buying.
And crucially, at what price they're placing their automatic sell orders, their stop losses.
So they have a literal dashboard showing them exactly where the pain points are for millions of everyday investors. They know the exact dollar amount where you will panic and sell.
They have level 2 visibility into the entire architecture of retail psychology. And to illustrate how ruthlessly they exploit this, the source uses the ultimate historical example.
The NASDAQ 100 between the years 1998 and 2002.
I actually looked at the charts for this period to see the trapdoor in action.
What did you see?
In 1998, the NASDAQ 100 started at a level of roughly 1,050. Over the next 2 years, fueled by the Alan Greenspan liquidity pumps we discussed, the index inflated massively.
It drew in everybody, the masses. Dentists, teachers, cab drivers. Everyone was buying tech stocks because the line only went up.
The euphoria phase.
Yeah.
The index peaked in early 2000 at an astounding 4,800.
A monumental gain. Everyone holding those stocks feels like a financial genius. But then Greenspan pulls the liquidity.
The interest rates rise, and the crash begins.
Now here is where the shameless market makers execute their strategy. They didn't just let the market fall to a natural resting place.
They actively, algorithmically drove the price down to a highly specific, calculated target.
They drove it to just below 1,050.
1,050 is exactly where the rally started in 1998.
Exactly. They intentionally drove the price slightly below the exact floor where the masses originally bought in.
We really have to analyze the psychology of that specific number. Why drive it below the origin point?
To engineer maximum capitulation. Think about the emotional journey of an investor who bought in at 1,050. You watch your investment rocket to 4,800.
You feel rich.
Then it starts crashing. At 3,000, you hold on, convinced it's just a dip. At 2,000, you're sweating, but you are still technically in profit from your original investment.
You tell yourself, well, at least I haven't lost my principal.
But once it hits 1,000, Once it drops below your initial buy-in price, the psychological dam breaks.
The illusion shatters. You realize you haven't just lost years of imaginary gains. The market is now actively eating your original savings.
Panic overrides logic. You hit the sell button. Your stop-loss orders trigger automatically. You say, get me out of this nightmare at any cost. You liquidate your position at rock bottom.
And who is standing right there at the bottom, waiting with open arms to buy your shares for pennies on the dollar?
The very market makers who engineered the drop.
This is the mechanical definition of shaking out the weak hands.
They use their visibility into the order book to force the price below the psychological threshold of the masses.
They trigger a cascade of automatic sell orders, wipe out the retail investors entirely, and then sweep up the heavily discounted assets right before the central bank turns the liquidity faucet back on for the next cycle.
That is incredibly dark. It transforms the market from an engine of wealth creation into a highly tuned extraction machine.
It's ruthless.
And the most terrifying part is that our source insists this isn't just a historical anecdote from the year 2000.
No, he says this is the fundamental operating system of modern finance. He claims this mechanism is deployed systematically every single day across almost every major asset class.
He specifically names them. He says, we see this algorithmic stop-loss hunting in Bitcoin, we see it in the S&P 500, we see it in U.S. Treasury bonds, and we see it in the oil markets.
The invisible hand simply waits for the masses to take their positions, maps where the retail money is clustered, and then forces a sudden, sharp, inexplicable drop just below the buy-in price.
They trigger the panic, force the weak hands to drop their assets, the institutions take over, and then the asset magically rebounds.
So when you were watching the financial news and an anchor says, Bitcoin inexplicably dropped 10% today due to broad market jitters before recovery.
The good speculator knows that market jitters is a fairy tale.
Exactly. What actually happened was a deliberate algorithmic raid on retail stop-loss orders. They shook the trees specifically to see how many apples they could force to drop.
Let's take a breath and synthesize the immense ground we've covered today.
It's been a lot.
We started by dismantling the narrative of the AI bubble. We looked at the hard data, the PE ratios, and realized that paying 19 times earnings for NVIDIA, the foundational hardware of a global productivity leap, is entirely reasonable.
Especially when compared to paying 50 times earnings for a big box retailer like Costco.
The fundamentals of AI are incredibly strong, funded by cash, not toxic debt.
But we also learned that fundamentals are just the venue. Central bank liquidity, the expansive monetary policy of figures like Alan Greenspan and Jerome Powell, is the actual energy that drives market valuations.
When the Fed cuts rates, the market soars. When they hike rates, the bubble bursts.
We then explored how shadow liquidity moves globally, completely bypassing the supposedly rigid rules of international sanctions.
We looked at claims of Iran moving $1 billion through Binance using blockchain architecture, and how severe regulatory enforcement can allegedly be neutralized by political alliances and campaign financing.
And finally, we confronted the brutal mechanical reality of the retail investor.
We examine how market makers use their visibility into the order book to engineer price drops specifically designed to break human psychology.
To shake out the weak hands and extract wealth from the masses right before the next major bull run predicted for 2027.
It is a massive amount of complex interlocking systems to digest. And to wrap up his broadcast, our source leaves his audience with a truly bizarre, almost cryptic parting sign-off.
Yeah, this part was wild.
He tells his listeners to go meditate on this final thought. He says, quote, "Cold coins are pure trash."
Cold coins are pure trash. It's a fascinating, loaded statement to end on, especially given everything he just laid out about crypto, liquidity, and inflation. We have to dissect what he means by that.
Let's debate it. My immediate thought is that he's talking about physical fiat currency, literal cold coins in your pocket.
That makes sense.
If the entire global system relies on central banks relentlessly pumping liquidity, which inherently degrades the purchasing power of the currency, then holding on to physical cash or money stuffed in a mattress is financial suicide.
It is pure trash because inflation is actively destroying its value every single day.
That is very strong interpretation. But consider an alternative, especially since he spent so much time discussing Binance and blockchain.
In the crypto world, a cold coin often refers to cryptocurrency held in cold storage, a hardware wallet completely disconnected from the internet and the exchanges.
Disconnected from the flow.
Exactly. If the entire premise of the good speculator is to ride the waves of central bank liquidity and shadow capital flows, then an asset sitting frozen in cold storage isn't participating in the game.
It isn't generating yield. It isn't being leveraged.
In a system entirely defined by the velocity and flow of money, a static, frozen asset, even a digital one, might be viewed by a ruthless speculator as totally useless.
Both interpretations point to the same underlying philosophy, though. In a rigged casino, stagnation is death.
You either learn to ride the engineered waves of liquidity, or the system slowly grinds your purchasing power to dust.
It really forces you to reevaluate what actually holds value. But I want to leave you, the listener, with a final provocative thought to mull over on your own. It builds directly on this terrifying idea of the weak hands trap.
What is the scenario?
We establish the mechanics. The market makers algorithmically drive prices just below the public's initial buy-in point to trigger panic selling and sweep up automatic stop-loss orders.
They are hunting for the exact mathematical moment where human psychology breaks.
But what happens if the psychology fundamentally changes?
A shift in retail behavior.
Exactly. What happens when the masses, the retail investors, realize the game is rigged and they simply stop using traditional stop-loss orders?
What if, fueled by internet communities, massive decentralized coordination, and a deep ingrained cynicism of institutional finance, they adopt a collective, entirely irrational, hold-at-all-costs mentality?
We've seen brief, explosive flashes of this with the meme stock phenomena.
The GameStop and AMC events. Retail investors essentially weaponize their own stubbornness against institutional short sellers.
Right. If the Wall Street algorithm is meticulously designed to shake the tree until the apples fall, what happens when millions of apples collectively refuse to let go, even as the branch is cracking under the pressure?
Could the sheer irrational willpower of the masses ever actually break the sophisticated algorithms of the shameless big players?
Or, by virtue of having near infinite access to central bank liquidity, will the House always, inevitably, find a way to win the war of attrition?
It's the ultimate standoff. The unpredictable chaos of human stubbornness versus the cold, calculated mechanics of institutional capital.
It really is. So the next time you open your brokerage app, and you see that jagged red line dipping just below the exact price you paid for it, remember the mechanical trapdoor we discussed today.
Take a breath, look at the macroeconomic flow of liquidity, and ask yourself a question.
Are you making a rational, fundamental decision to sell? Or are you just dropping your cards exactly when the house engineered you to? Thanks for joining us on this deep dive. We'll see you next time.
If you look at those old pirate movies, there's always this moment where the captain unrolls this worn, faded parchment map.
Oh, yeah, and there it is, right? The big red X.
Exactly, the big
Yeah.
red X. And it's a completely binary situation. You dig exactly there, and you find the chest of gold.
Right, and if you dig like 10 feet to the left, you just get a pile of dirt and a broken shovel.
Yeah, it's a static reality.
Yeah.
Which is comforting, I guess. The map doesn't change, the island doesn't move, you just follow the instructions.
But the thing is, in modern financial markets, the island is basically an active volcano.
Totally. The tides are shifting every 5 seconds, and that red X is a constantly moving target. Yet millions of people log on to social media every single weekend and buy exactly those static maps.
They do. They buy the illusion that the market is just a simple puzzle waiting to be solved.
And today, we're taking a sledgehammer to those illusions. Welcome to the deep dive, everyone. We are digging into the unvarnished analysis of Spanish financial analyst José Luis Cava.
Our mission here is to look at what is actually happening in the plumbing of global finance. We really want to cut straight through the flashy influencer noise and the central bank doublespeak.
Right, because there's so much noise out there. So we need to tear down the facade on multiple fronts today.
We do. We have to look at the psychological warfare happening at the micro level with retail traders, and then the systemic panic currently gripping central banks over digital currencies.
Not to mention the actual mechanical forces, like massive IPOs and institutional hedging, that are violently driving the stock market right now.
Oh, definitely. It's a lot to cover.
Okay, let's unpack this. Let's jump right into the deep end, starting with that weekend scrolling habit.
I know exactly what you're talking about.
Right. Picture this. You're having your morning coffee on a Saturday, you're flipping through your feed, and you were immediately bombarded by ads.
Always the guy leaning against a rented Lamborghini, right? Or sitting on a beach in Bali with a laptop.
Yes, promising you a foolproof trading system. And our source zeroes in on this specific, aggressive weekend advertising push and just eviscerates it.
And rightfully so, because they all peddle one incredibly dangerous message. They tell you that speculating is easy.
Which is the ultimate siren song for human psychology, isn't it?
It really is. I mean, our brains are hardwired to seek maximum reward for minimum caloric output.
So when an influencer tells you that all you have to do is, like, watch for a simple moving average crossover.
Right. They say, just wait for the 50-day moving average to cross above the 200-day moving average, and then you just buy and get rich.
They're essentially hijacking your biological desire for efficiency. They present it as a mathematical certainty.
But let's actually pull that apart mechanically, because I look at those charts and I have to admit, it's tempting.
Line A crosses line B. It looks like a super clear signal.
Yeah, but if we think about the reality of the market ecosystem, if I'm sitting at home in my pajamas executing that trade, who is actually on the other side of it?
That is the perfect question to ask. Because if a simple inefficiency exists in the market, like a basic momentum crossover that anyone with a free charting tool can see, you aren't just competing with other people in their pajamas.
No, you are competing with algorithmic, high-frequency trading firms.
Right. These are institutions spending billions of dollars to lay fiber optic cables straight through mountains just to shave a microsecond off their execution time.
It's wild to think about. They have supercomputers analyzing that exact same moving average crossover.
Which means by the time I actually click buy on my retail brokerage app, that opportunity's already gone.
Long gone. The algorithms have identified it, traded it, extracted the profit, and shifted the market price before your screen even refreshes.
Wow. So that is why the source vehemently rejects the idea that a simple indicator equals a trading system.
Exactly. The market is an adaptive, hyper-competitive ecosystem. It actively punishes static rules.
So true knowledge in speculation isn't about memorizing a pattern. It requires constant, often painful adaptation to new market realities.
It is immense grinding effort. You are entering an arena where the rules of engagement are being rewritten by the minute.
Which brings us to a statement in the source material that genuinely made me stop reading and do a double take.
Oh, I think I know which one you mean.
The source states point blank, good speculators do not have monetary goals.
Yeah, that one hits hard.
I mean, let's be real. If you aren't in the market to make money, what on earth are you doing?
It sounds completely paradoxical until you look at the neuroscience of cognitive load. Let's step out of finance for a second to really get this.
Okay, I'm with you.
Think about a professional golfer standing over a 12-foot putt on the 18th hole to win a major championship.
Talk about pressure.
Right. If that golfer's standing there thinking, if I sink this, I win $3 million, I secure my tour card, and I get that massive Nike endorsement, what happens biologically?
Oh, their heart rate spikes, their hands probably get a little sweaty, their muscles tense up.
They completely lose that smooth, natural stroke. They experience an amygdala hijack.
Because their brain is processing the massive dopamine hit of the reward or the cortisol spike of potential failure instead of just processing the physical mechanics of the stroke.
Exactly. And the same biological process applies to trading. If you sit down at your terminal and say, I need to make $500 today to pay my car lease, you have already corrupted your decision-making process.
Because suddenly you aren't looking at the chart objectively anymore. You start seeing things that aren't there.
You force a trade just because you need the outcome, not because the data actually supports the entry.
You bend your own rules to fit your financial anxiety.
Precisely. The source argues that the singular objective, the absolute only thing a speculator should focus on, must be developing, refining, and fully internalizing a consistent system.
By removing the monetary goal, you shift your entire psychological framework. The goal is no longer the money. The goal is the flawless execution of your process.
It's the difference between asking, did I make $1,000 today, versus, did I execute my entry criteria perfectly?
Right, like, did I respect my stop loss? Did I manage my risk exactly as my system dictates?
And that reframing is a superpower. Because if you execute your system flawlessly and the trade still loses, which happens constantly in a probabilistic environment, you have still succeeded.
Because your primary goal was following your process. You didn't let emotion override your discipline.
The core argument here is that money is merely a lagging byproduct of executing a mathematically sound system over a long period of time.
Which naturally leads us to the absolute nucleus of any functional system. The source doesn't mince words here at all.
No, they don't. The foundation is risk and reward management, which they frame as the mathematics of survival.
And there is a very strict, non-negotiable rule laid out. You must never, ever tolerate a 15% or 20% loss on a trade. and especially not on your total account balance.
We really need to unpack the brutal math behind that specific threshold, because human intuition is terrible at understanding compounding losses.
It's definitely not a linear relationship, is it?
Not at all. If you have $10,000 and you lose 20%, you are down to $8,000.
And your intuition tells you, okay, I just need to make 20% to get back to even.
But 20% of 8,000 is only 1,600. That only gets you to $9,600. You're still in the hole.
So to recover from a 20% drawdown, you actually need a 25% gain on your remaining capital.
Exactly. And the math turns exponentially hostile the deeper you go.
Yeah, if you stubbornly hold on to a losing position and your account drops by 50%, you don't need a 50% gain to recover.
You need a 100% gain. You have to double your money just to get back to the starting line.
That's crazy. So mathematically, you are effectively kicked out of the market.
Right, because generating a 100% return requires taking on massive reckless risk, which usually just blows up the rest of the account anyway.
It's like falling into a pit where the walls get greasier and steeper the further down you slide.
That is a great way to put it. But the source points out that it's not just the mathematical destruction of your capital.
It's the psychological destruction. It's the total annihilation of your self-confidence as a decision maker.
That is the invisible killer that ends careers. Let's say you take a devastating 25% hit because you ignored your stop loss.
You are reeling.
Yeah. And the next day, your system flags a mathematically perfect, highly probable entry signal. What do you do?
Honestly,
Yeah.
I hesitate. I'm terrified. I stare at the screen thinking, what if this one goes against me too?
You suffer from battered trader syndrome. You second-guess the very system you spent months building.
You are basically paralyzed by the trauma of the previous loss.
So you skip the valid trade, watch it run to your profit target without you, and then the frustration just compounds. You have entirely lost your ability to execute naturally.
And this is where the source draws a vital line in the sand between unmanageable risks and manageable risks.
Which is an important distinction because a lot of people defend their huge losses by saying, well, the market just went crazy, I couldn't control it.
And it's true, you can't control the macro environment. The source specifically mentions the very real risk of a sudden market-tanking post on social media by a major political figure.
Right. You can't predict a Sunday night geopolitical crisis. Those are unmanageable risks, and they are a permanent feature of the landscape.
What you can control is your insulation against those events.
Yes. You control where you place your stop-loss order in the market, ensuring that even if a politician says something crazy and the market gaps down, you are automatically pulled out of the trade.
So you get out before it hits that 15% death spiral. You control your position sizing.
Meaning you never put so much capital into a single trade that an unpredictable event ruins you.
You build a bunker, basically. And speaking of capital allocation, the source gives a very explicit directive for people trying to build these systems.
They say you have to start with incredibly small amounts of money.
Now, on a logical level, that makes sense while you're just testing the waters. But here's the paradox that I want us to figure out.
Okay, let's hear it.
Why do trading systems that work flawlessly in a paper trading simulator or with like 20 bucks certainly implode the minute someone puts $10,000 on the line?
It's the ultimate question.
Because a chart is a chart, right? Support and resistance don't change just because my account size did.
The chart doesn't change, but your biological reality does. The source points squarely at emotional friction.
Emotional friction.
Yeah. When you are trading with an amount of money that holds no psychological weight, say, risking the cost of a cup of coffee, your nervous system doesn't register a threat.
Your amygdala stays quiet. You watch the price action objectively.
Exactly. If the trade hits your stop loss, you shrug and move on. You are operating in a state of natural, frictionless execution.
Because losing that coffee money doesn't alter my life. I'm not going to miss rent over it.
But what happens when you scale up and suddenly you are risking a month's mortgage payment on that exact same chart pattern?
The biological reality of stress takes over. Adrenaline flows. Cortisol spikes.
Suddenly you aren't trading the chart. You are trading your own anxiety.
I felt that. You watch a green candle tick up, you have a tiny bit of profit, and you panic sell to close the trade way too early just to secure a win.
Completely cutting off your potential upside. Or the flip side, which is far worse, the trade goes against you, it approaches your stop loss, and the emotional pain is just too much.
The pain of realizing a massive financial loss is so acute that you literally cannot bring yourself to click close.
You freeze. You move your stop loss down, hoping the market turns around. You let hope replace your system.
The emotions entirely sabotage the internalized logic. That's why the source insists that scaling up your capital cannot happen until the system is so deeply internalized.
It has to neurologically override your natural fight-or-flight response.
Okay, so we've mapped out the brutal, unglamorous realities facing the individual retail trader down in the trenches.
The fight against the illusion of the static treasure map, the math of drawdowns, and their own biology.
But we need to look at the bigger picture, because the retail trader isn't the only one susceptible to these illusions.
Right. Right now, at the highest levels of global finance, central banks are desperately seeking their own easy systems to mask severe structural weaknesses.
So we are shifting from the micropsychology of the individual to the macro mechanics of the global currency war.
And the source opens the section with a remarkably definitive claim. They argue that the European Central Bank, the ECB, has fundamentally already lost the war against what they call the digital dollar.
That is a staggering statement to make about one of the most powerful financial institutions on Earth.
It really is. And the source anchors this claim in a very real, very tense moment.
They detail a recent warning from ECB President Christine Lagarde, who was speaking directly to EU finance ministers.
She explicitly warned them that stablecoins are actively threatening the foundation of the European financial system.
Here's where it gets really interesting. To understand why a central bank president is sounding the alarm, we have to precisely define the weapons in this war.
Good point. When the source talks about stablecoins, specifically naming Tether and Circle, we aren't talking about volatile crypto assets like Bitcoin.
Right, a stablecoin is a digital token that is pegged one-to-one with the US dollar.
But the critical mechanism here is the collateral. To maintain that peg, the companies behind these tokens hold massive reserves of U.S. public debt U.S. treasuries.
So they are essentially decentralized digital proxies for the US dollar operating on blockchain rails, fully backed by US government debt.
And accessible to anyone with a smartphone anywhere on the planet. And that accessibility is what terrifies the ECB.
Let's break down the exact plumbing of why this is an existential threat.
Okay, let's imagine a hypothetical town's water supply to understand fractional reserve banking.
I love a good analogy.
The local European bank is the town's central reservoir. Everyone deposits their euros into this reservoir.
Now, the bank doesn't just let that water sit there.
Exactly. They pipe it out to irrigate local farms, to build new businesses, to fund mortgages. This is financial intermediation. They lend out the deposits to keep the economy growing.
Okay, I'm following. So what happens when stablecoins enter the chat? Let's say I live in Madrid, I look at the inflation rate of the euro, and I decide I'd rather hold digital dollars.
Makes sense.
I take my paycheck out of Banco Santander and I buy Tether.
You just pump your water out of the town reservoir and put it into your own private tank.
Wow. And you multiply your action by millions of European citizens and businesses.
The euros literally leave the European banking ecosystem and cross the digital border into the stablecoin ecosystem.
Which means the local bank suddenly has a massive collateral problem.
Yeah,
The reservoir is draining.
exactly. The deposit base shrinks. And because of fractional reserve banking, if a bank has fewer deposits, it legally and structurally has less capital available to lend out.
So the supply of credit in the broader European economy tightens.
Oh, wow. So this isn't just about some abstract digital ledger. If deposits flee to stablecoins, the actual physical supply of loanable money in Europe dries up.
And we know the basic laws of supply and demand. When credit becomes scarce, the price of borrowing that money must go up.
So the ultimate real-world result of people fleeing to digital dollars is that interest rates for regular people in Europe must rise.
Like someone seeking a car loan or a business seeking capital to expand.
It actively damages the entire mechanism of financial intermediation. The banking engine starts to seize up because it's running out of oil.
And the source notes that the ECB isn't entirely helpless in the short term. They have a temporary band-aid.
Right. If local banks are running out of deposits, the central bank can step in and inject artificial liquidity.
They can just create reserves out of thin air and loan them to the banks to keep the engine running.
They can, but the source is adamant that this is mathematically unsustainable over the long term.
You cannot permanently replace organic deposit capital fleeing your borders with freshly printed central bank money without severely devaluing your currency.
It just creates an inflationary death spiral.
Which explains why the ECB is desperately trying to build their own alternative, the digital euro.
They want to create a central bank digital currency, or CBDC, to compete with these private stablecoins.
But the source has an incredibly sharp, almost cynical critique of this plan. And this is where the text gets really fiery.
It really does.
The source calls both the proposed digital euro and the current stablecoin digital dollar pure trash. In Spanish, they literally say basura pura.
But then in the very next breath, the source makes it clear they vastly prefer the US digital dollar over the digital euro.
Right, so if they're both trash, how can one be significantly better?
This raises an important question, and it really comes down to a deep understanding of the fiat currency hierarchy.
When the source calls them both trash, they are acknowledging a fundamental reality. Neither of these currencies is backed by hard physical assets like gold or silver.
They are both fiat. Their value is intrinsically based on trust, on numbers on a screen. But within the realm of fiat currency, all trash is not created equal.
The hierarchy is determined by the quality and the liquidity of the underlying collateral.
Right. It's about what you are actually holding when you pull back the curtain.
Exactly. When you look at the U.S. digital dollar tether, or circle, the collateral backing it is the U.S. Treasury market.
Now, the source might view U.S. public debt cynically, given the massive national deficit. But the undeniable objective reality of global finance is that the U.S. Treasury market is the deepest, most liquid form of collateral on the planet.
It is backed by the sheer economic output, the tax base, and ultimately the military supremacy of the United States.
But when you pull back the curtain on the proposed digital euro, what's there? The source is scathing here.
They argue it wouldn't have that kind of robust, unified sovereign debt backing it. Instead, they say the digital euro is essentially backed by nothing but politicians.
They specifically call out elites, like Lagarde, managing it by committee across a fragmented European political landscape.
So when faced with a choice between a digital token backed by the world's primary reserve asset U.S. bonds and a digital token backed by the promises of a fragmented European political committee,
The source, and likely the global market, chooses the US dollar every single time.
and this exposes a massive, glaring hypocrisy in the ECB's entire argument, doesn't it?
It really does. Lagarde is standing in front of finance ministers, sounding the alarm that private stablecoins will drain bank deposits.
And cripple the ability of European banks to lend.
But consider the mechanics of a central bank digital currency. If the ECB rolls out a digital euro, they are offering a direct digital liability of the central bank to the public.
So if European citizens decide they want the safety of the digital euro, they pull their money out of their local private bank deposits like Banco Santander or Deutsche Bank.
And hold it directly in digital euros.
Wait, it would do the exact same thing. It would drain the private banking system of its deposits just as fast, if not faster, than Tether would.
Precisely. It is a monumental turf war. The central bank's primary concern isn't actually about saving the deposit base of the private banking system.
It is about ensuring that they are the ones controlling the monetary plumbing of the future. They want a monopoly on the digital rails.
But the source is deeply skeptical that European bureaucrats can actually pull off a successful CBDC.
And they point to a massive historical precedent that we rarely talk about in the West: the failure of the digital yuan.
It's the perfect case study. China was years ahead of the rest of the world in pushing for a central bank digital currency.
They had the technological infrastructure, and they had the authoritarian leverage to try and force adoption.
Their goal was total surveillance and control over their monetary ecosystem.
But the source points out it has been a total failure in achieving widespread organic global adoption compared to decentralized alternatives or even existing payment apps. Why?
Because of trust and network effects, people, and especially international businesses, don't want a programmable currency where a central government can track every microtransaction.
Or arbitrarily freeze funds with a keystroke.
Exactly. If given a choice between a heavily surveilled CBDC and a highly liquid, easily transferable US dollar stablecoin, capital will flow to the stablecoin.
The source believes the digital euro will face the exact same organic rejection.
Okay, so we've explored the retail trader fighting the micro war against their own psychology and the central banks fighting a macro war for global liquidity against digital dollars.
Now, we have to look at the actual battleground where all of this collides.
Yeah.
The stock market. Because right now, the stock market is presenting us with an incredible logic-defying paradox.
It is arguably the most confusing market environment in modern history for anyone trying to trade based on traditional economics.
It really is. If you turn on any financial news network, you are hit with a tidal wave of apocalyptic warnings.
We are constantly told a recession is imminent due to escalating interest rates. We hear about devastating global tariffs threatening supply chains.
We hear about the very real threat of a widening war in the Middle East involving Iran. The fundamental picture looks incredibly bleak.
Yet, if you close your eyes to the news and just look at the charts, the S&P 500, the Nasdaq, the Nikkei in Japan, they just keep marching upward.
Hitting new all-time highs week after week. So what does this all mean? How can a market completely ignore such terrible, world-altering news?
To understand this, we have to fundamentally divorce the stock market from the real economy. The stock market is not a real-time reflection of economic health.
It is a highly complex machine driven by positioning, liquidity flows, and institutional mechanics.
The structural reality behind this massive, relentless rally, according to our source, is not driven by investor optimism. Nobody is buying stocks because they think the global economy is in great shape.
Then who is doing all the buying?
The institutions that got trapped. Specifically, massive hedge funds that looked at all those apocalyptic headlines, did the fundamental math, and positioned themselves heavily for a market crash.
They got aggressively short. We need to break down the exact mechanics of being caught short because it is the hidden engine driving this entire paradox.
Walk me through the life cycle of a short position. If I'm a hedge fund manager and I think the S&P 500 is going to tank, what do I actually do?
Well, you don't just sell stocks you own. You borrow stocks you don't own.
You go to a prime broker, you borrow a massive block of shares, and you immediately sell them onto the open market at today's high price.
Your goal is to wait for the apocalypse to happen, watch the price crash, and then buy those shares back at a huge discount.
You return the borrowed shares to broker and pocket the massive difference.
Okay, sounds like a great plan if the world is ending. But what happens if the world doesn't end? What if the market doesn't crash, but instead it just kind of drifts upward slightly?
Then the math turns against you violently. You sold borrowed shares at $100. If the price drifts up to $105, you are losing money on paper because it will cost you more to buy them back.
If it drifts up to $110, you are bleeding capital. Eventually, your risk management department or the prime broker who lent you the shares steps in.
They issue a margin call. They say, your position is too toxic. You don't have enough collateral to cover these losses. You must close this position immediately before we go under.
And here's the mechanical crux of the whole thing. How do you close a short position?
You have to buy the stock back at market price, whatever the cost.
So you have thousands of heavily short hedge funds, all bleeding money as the market drifts up, and suddenly they are all forced by their risk departments to buy millions of shares at the exact same time just to stop their losses.
Precisely. It creates an avalanche of artificial, panic-driven buying pressure. This is a short squeeze.
These institutions aren't buying because they believe in the future earnings of the companies. They are buying because a computer is forcing them to cover their exposure.
And here is the brutal feedback loop. That forced, massive buying drives the price of the stock even higher.
Which then triggers the pain thresholds and margin calls for the next tier of short sellers, forcing them to buy, pushing the price higher again.
It's a violent mechanical cascade upward. It is a rally built entirely on institutional pain, not economic prosperity.
And the source points to a very specific, recent geopolitical rumor that acted as the spark for one of these cascades.
The source mentions a rumor circulating among institutional desks about a potential early agreement or back-channel understanding between Donald Trump and the Iranian regime regarding regional stability.
Now, we need to clarify that these are the geopolitical views expressed in the source, focusing strictly on their mechanical market impact.
Absolutely. Whether this rumor is true, false, or completely fabricated is entirely irrelevant to the market mechanics. The market doesn't care about the truth. It cares about the perception of risk.
The rumor just provided the excuse.
Exactly. It was a tiny spark of potentially stabilizing news in a highly volatile region. And that tiny spark was all it took to ignite the dry tinder of all those heavily short hedge funds.
The market twitched upward on the rumor, the algorithms detected the momentum, the shorts started bleeding, the margin calls hit.
And the forced buying pushed the indices to new all-time highs. The macro narrative is just a thin veil over the mechanical reality of trapped liquidity.
Which brings us to the ultimate, incredibly specific mechanical warning our source wants to give us. They are looking ahead to a massive, disruptive event on the calendar.
The upcoming IPO of SpaceX, explicitly cited by the source as happening on June 12th. Now, companies go public all the time.
But the source breaks down exactly why this specific public offering is incredibly dangerous for the short-term stability of the entire market. There are two huge structural factors. First, they note there is no lockup period.
And that is a massive anomaly that completely alters the supply dynamics. Typically, when a major company goes public, there are strict legal agreements.
preventing the insiders, the founders, the early venture capitalists, the employees, from selling their shares for a set period, usually 90 to 180 days.
This is designed to prevent them from dumping all their equity on day one and instantly crashing the stock price.
It maintains an artificial scarcity of shares.
Exactly. But according to the source, this SpaceX IPO will hit the market without a lockup period.
That means the moment the stock begins trading, there is the potential for an immediate massive wave of what the source calls paper pressure.
Insiders who've been holding illiquid private shares for a decade might rush to cash out all at once, creating immense, sudden selling volume.
And that alone would make the stock incredibly volatile. But then you combine it with the second, much larger structural factor.
Immediate, high-weight inclusion into major market indices, because SpaceX is an absolute mammoth of a company in terms of valuation.
It's not just going to float out there independently. It is going to be injected directly into the core indices like the S&P 500 or the NASDAQ 100 almost immediately.
And this is where the micro event becomes a macro earthquake. Think about the entire passive investing industry.
Think about every Vanguard mutual fund, every BlackRock ETF, every 401k plan that is mandated by its prospectus to perfectly track the S&P 500.
They don't have human portfolio managers deciding what to buy based on valuation. They are algorithms.
So if SpaceX is added to the S&P 500 at, let's say, a 2% weight, those passive funds don't have a choice.
They are structurally obligated by law to instantly buy tens of billions of dollars worth of SpaceX stock to match the index weighting.
Regardless of what the price is doing, and regardless of that massive wave of insider selling pressure we just talked about.
It's a collision course. You have a wall of insider selling meeting a forced wall of passive index buying.
If we connect this to the bigger picture, what about the active fund managers, the guys who actually have to manage risk?
How do they protect themselves when a massive, highly volatile new asset is suddenly shoved into their benchmark index? The source details the specific mechanics of this, and they aren't just crossing their fingers.
No. They are going to use the derivatives market to build a fortress around their portfolios, and in doing so, they're going to drastically alter the gravitational pull of the broader market.
The source explicitly outlines 3 things these institutional managers will do. First, they will aggressively buy puts on the broader market indices.
Okay, let's break that down for absolute clarity. A put option is essentially an insurance policy.
It gives the buyer the right, but not the obligation, to sell an asset at a specific price by a specific date.
So if I manage a billion-dollar fund, I buy puts on the S&P 500. If the SpaceX IPO chaos causes the whole market to tank, the value of my puts skyrockets, offsetting the losses in my portfolio.
Precisely. It's crash insurance. The source also notes they will sell calls, which means they are selling the rights for someone else to buy stocks from them at a higher price,
generating immediate cash premium to help pay for those expensive puts while effectively capping their upside if the market rallies.
But the third action is the most critical. They will heavily buy VIX futures.
The VIX, the volatility index, often called the fear gauge. It measures how much turbulence the market expects over the next 30 days based on options pricing.
Exactly. So these institutions are literally placing massive leveraged bets that market chaos is imminent.
But here is the secret mechanic that most people miss, and why this hedging actually causes the drop they are afraid of. It's called dealer hedging or gamma hedging.
When a massive mutual fund buys $1 billion worth of put options, who is selling them that insurance?
Wall Street market makers. The dealers.
Right. And those dealers are in the business of collecting premiums, not taking directional risk. When the dealer sells that put option, they are taking on the risk that the market might crash.
To neutralize that risk, the dealer immediately goes into the open market and shorts the underlying index.
Wow. So by simply buying insurance against a crash, the institutions force the dealers to aggressively short the market.
Which creates massive structural downward selling pressure.
Yes. The entire plumbing of the market becomes heavily skewed for a downward move. The hedging itself becomes a self-fulfilling prophecy.
This massive web of derivatives exerts a massive gravitational pull downward.
So the source's ultimate conclusion on this specific June 12th SpaceX event is that the combination of unrestricted insider selling, forced index inclusion chaos, and this massive heavy web of institutional derivative hedging will cause a sharp, violent drop in the broader market.
It's going to look incredibly ugly on the surface. Retail investors are going to see a sea of red on their screens. They're going to look at the high interest rates and the geopolitical news, and they're going to panic.
They're going to think, this is it. The apocalypse the media warned us about is finally here. The multi-year bear market has begun.
But this is where the source makes a vital, crucial distinction that separates the amateur from the professional speculator.
They draw a hard line between a sharp mechanical correction and a true structural market top.
Let's define that difference. A correction is a fast, painful drop, often 10% or more, that clears out excess leverage, resets the derivative positioning, but ultimately leaves the long-term upward trend intact.
A market top is the definitive end of a macro bull cycle, leading to a grueling multi-year bear market driven by fundamental economic deterioration.
And the source asks a brilliant rhetorical question based on deep historical data. Has a massive, hyped-up IPO ever actually caused a true structural market top?
And the answer is incredibly illuminating. The source says only once. In the year 2021, when the market was saturated with speculative excess and free money.
In virtually every other historical instance across decades of market data, a massive public offering causes a violent short-term disruption in the mechanical plumbing, not the beginning of a long-term macroeconomic downtrend.
Therefore, the source's final perspective is entirely contrarian to the widespread panic they predict will occur on June 12th.
They view this upcoming violent drop not as the end of the world, but as a prime mechanical buying opportunity.
It is a moment where the structural plumbing of the market, the IPO flow mechanics, and the dealer hedging temporarily overrides the long-term trend. It creates a severe mispricing.
And if you are that disciplined speculator we talked about in the very beginning,
The one who has abandoned monetary goals, who has internalized their risk management, who doesn't let cortisol dictate their trades.
you can step in and take advantage of the chaos while everyone else is panicking.
Precisely. You fade the mechanical panic.
This has been an incredible unspooling of how the financial world actually operates beneath the headlines. Let's synthesize this journey.
We started all the way down in the psychological trenches, looking at the vital, highly unglamorous discipline required to simply survive as an individual retail trader.
We dismantled the illusion of the easy, static treasure map sold by influencers, highlighting the absolute necessity of abandoning monetary fixation in favor of ruthless risk management and emotional control.
From there, we scaled up to witness a massive macroeconomic conflict, observing how central banks are facing an existential threat to their fractional reserve systems from decentralized U.S. debt-backed stablecoins.
We saw the hypocrisy of the digital euro and the battle over who gets to control the future of global liquidity.
And finally, we brought those micro and macro forces together to examine the cold, hard mechanics of the stock market itself.
We saw how apocalyptic geopolitical rumors merely serve as sparks to ignite structural short squeezes, and how the upcoming massive SpaceX IPO threatens to create a violent, derivative-driven market drop that looks like an apocalypse, but is actually just a mechanical mispricing.
The undeniable common thread running through every single one of these pillars is that things in finance are rarely, if ever, what they appear to be on the surface.
The social media guru is selling a dangerous psychological trap. The central bank is masking its systemic vulnerability behind attacks on private digital currencies.
And the stock market rally is built on the forced buying of trapped hedge funds rather than genuine economic prosperity. True financial literacy requires constantly looking past the narrative and studying the unvarnished mechanics beneath.
Which brings us to a final thought for you to take away from this deep dive. We started by talking about that static pirate map and how it's a total illusion in a market that is constantly shifting and adapting.
But let's extrapolate based on everything we've unpacked today. The ultimate goal of a good speculator is to build a flawless, entirely emotionless system to navigate this chaos.
Meanwhile, we are rapidly entering a macro world where human central bankers are fundamentally losing control of global liquidity to decentralized, automated digital currencies and algorithmic stablecoins.
It begs a fascinating question about the future architecture of finance.
Exactly. So here's the question to leave you with. Will future market shocks, like the volatility we expect surrounding the SpaceX IPO, eventually become completely disconnected from human emotion altogether?
As stablecoins drain traditional banks and passive index flows blindly drive trillions of dollars based on math rather than analysis.
Are we heading toward a reality where the stock market is entirely driven by automated systems hedging against digital currency flows? Will human beings analyzing traditional company valuations become entirely obsolete in a market governed purely by algorithmic physics?
A market where the machines are the only ones left reading the map.
Something to think about the next time you look at a chart and wonder who is on the other side of your trade. Thank you so much for joining us on this deep dive. Keep questioning the mechanics, and we'll see you next time. Picture this. It's a beautiful, crisp, totally sunny morning in Madrid.
Oh, sounds perfect.
Right. The skies are completely clear. It is the absolute perfect day to just go outside, grab an espresso, take a long walk through the Retiro Park, just enjoy the city.
Yeah, that's what any normal person would do.
Exactly. But veteran Spanish financial analyst Jose Luis Cava, he looked at that beautiful day outside his window, and he just closed the blinds. He deliberately barricaded himself indoors.
He basically put himself into voluntary solitary confinement.
Yeah, exactly.
And honestly, when you look at the sheer density of the charts he was dealing with, you totally understand why he did it.
Oh, for sure.
Because, I mean, we live in this environment where we are constantly bombarded by, 15-second financial hot takes and algorithmic noise on our phones.
It's exhausting.
It really is. So isolating yourself to just stare at raw data and historical context, that's really the only way to isolate the actual signal from all that noise. He wasn't interested in the daily chatter. He was looking for macrostructural truth.
Right, and he was doing it with a very specific mission in mind, which is what we're going to get into today. Because today, we are doing a deep dive into the third installment of a video series he produced. And it's bluntly titled, Why I Am Bullish.
A very to-the-point title.
Very. Now, the first two installments of this series, they broke down his thesis on gold and the S&P 500. But today's focus, today we are talking about Bitcoin.
Specifically looking at the landscape after those really intense price shakeouts we saw in February of 2026.
Right. And the framing he uses for this analysis is what makes it so vital, I think, for anyone listening to this.
Yeah, because he isn't analyzing Bitcoin as like a speculative tech play. He's not talking about getting rich quick.
No.
He frames this entire exercise as a defense mechanism.
Yeah, defense mechanism. That's a great way to put it.
He uses terms like, he literally calls it monetary degradation, and he refers to fiat currency as fiat trash.
Fiat trash, yeah. He does not hold back.
No, he doesn't. And his stated goal, the reason he's locked in that room, is to teach younger generations, and really anyone paying attention to him, how to use these assets as money-making machines to fight back against what he views as a systematic grinding impoverishment.
It's essentially a survival guide for modern economics.
Exactly.
Because, let's face it, when the currency in your bank account literally buys tangibly less at the grocery store every single month,
Which everyone is feeling right now.
everyone is feeling. When that happens, financial literacy stops being about, figuring out how to buy a yacht, and it starts being about just keeping your head above water.
Right, just surviving.
So to understand Kaba's hyper-digital defense against this fiat degradation, we actually have to take a massive detour away from cryptography entirely.
Yeah, this is the wildest part of his thesis.
It's so cool. He anchors his entire 2026 macroeconomic thesis on a children's book, a book that was published all the way back in the year 1900.
He uses L. Frank Baum's classic, The Wonderful Wizard of Oz.
The Wizard of Oz.
Yeah, but he completely strips away the fairy tale veneer, right? He treats the book as this gritty, super sophisticated economic allegory about the gold standard
Right.
and about the massive structural upheaval the United States was going through in the late 19th century, because they were transitioning from a very rural agricultural society to an industrial powerhouse.
I always knew there were some political undertones to Oz,
Yeah.
but mapping it directly onto 19th century monetary policy is just fascinating. So let's decode the metaphor Kava lays out here.
Let's do it.
Starting with the name of the fantasy land itself, right? Oz. It literally stands for ounce.
Yeah, OZ.
The Troy ounce.
Yeah.
The standard unit of measurement in precious metals markets.
It literally hides right in plain sight.
It's crazy.
And then, the path through this land of the ounce, the yellow brick road.
Gold bars.
Exactly. A very literal representation of gold bars. It represents the gold standard, which Dorothy is forced to walk on to reach the Emerald City.
Which is green.
Right. The green-tinted center of power representing Washington, D.C., where the currency and the economy are ultimately managed.
Okay, so that's the setting. But then the companions she meets along the way, they are the core demographic and economic blocks of that era.
Oh, yeah. They all map perfectly.
Take the Scarecrow, for example. He represents the agricultural sector, right? The Midwestern farmer from Kansas. Kava points out that during the late 1800s, specifically around the Panic of 1893, farmers were just being crushed by deflation.
Yeah, and we should clarify why that happens, because deflation under a strict gold standard is a brutal, brutal mechanic if you hold any debt.
Right, because the money becomes too valuable.
Exactly. Economic output and the population were growing so much faster than the global supply of mined gold. Because the money was tied strictly to that scarce gold, the money itself became more valuable over time.
Which means the prices of everyday goods plummeted.
Right. So put yourself in the shoes of a farmer back then. If you borrowed money to buy land or to buy seed, you have to sell your crops to pay back that loan.
Right.
But when the price of wheat collapses because of currency deflation, you suddenly have to harvest and sell twice as much wheat just to service the exact same debt.
You're working twice as hard just to stand still.
Exactly. So the scarecrow represents that hollowed out, desperate agricultural worker who the Eastern bankers basically treated as having no brain for falling into these debt traps.
Wow. And then we have the Tin Woodman, representing the industrial worker. He's rusted, he's hollow, his heart has literally been removed.
Yeah, he's lost his humanity.
And Kava connects this to the massive influx of immigrant labor during industrialization.
Right, because you had a massive labor surplus just flooding into the manufacturing centers. And in a purely free market, when you have a labor surplus, wages absolutely plummet.
Supply and demand.
Exactly. And unscrupulous industrial employers took full advantage of this. So the Tin Woodsman, he is working harder, he's swinging his axe faster, but he is becoming poorer and losing his humanity in this mechanized, unregulated industrial machine.
So he's suffering from falling wages, the exact same way the scarecrow is suffering from falling crop prices.
Spot on. They're both victims of the structure.
Which brings us to the political savior of the story. Or, well, at least the one who wants to be the savior. The cowardly lion.
The cowardly lion.
Kava identifies the lion as the populist politician of the era, which is widely considered to be William Jennings Bryan. The lion roars loudly, but he lacks real courage, and his primary platform is bimetallism.
Right, bimetallism, which was the ultimate populist economic policy of the 1890s.
Can you explain that for those who might not be familiar?
Sure. The lion basically wants to inject liquidity into the system. He wants the government to print money backed not just by scarce gold, but by abundant silver.
Oh, so he wants to inflate the money supply.
Exactly. He wants to deliberately inflate the money supply to ease the debt burden on the scarecrows, the farmers, and to raise the nominal wages for the Tin Woodsmen, the industrial workers.
It was an inflationary tactic to just buy the votes of the struggling working class.
Exactly that.
And finally, we have the wizard himself, this terrifying, all-powerful floating head who demands obedience, representing the gold standard or the Eastern banking establishment that controlled it.
Right, the guy pulling the levers behind the curtain.
But when Toto pulls back the curtain, the illusion shatters.
Yes.
It's just an ordinary, flawed man pulling levers.
Right. And Baum's original intent with the book was clearly a critique of the gold standard. He was arguing that this rigid monetary policy was a destructive illusion created by elites, and it was causing widespread suffering.
But, and this is where it gets really interesting, Kava introduces a pretty severe analytical twist here.
He really does.
He looks at Baum's historical allegory, and he argues that Baum fundamentally misdiagnosed the problem.
Yeah, Kava takes the position that deflation was actually a positive force.
Which goes against the grain of the book's whole message.
Entirely, because Kava argues from a very Austrian school economic perspective. He believes that the deflation caused by the gold standard was quote-unquote good deflation because it preserved the purchasing power of the currency.
So the money the workers did have actually held its value.
Exactly. According to Kava, the villain wasn't the hard money. The villains were the monopolistic, exploitative employers who used the labor surplus to drive wages into the ground.
So Kava argues the political class should have regulated the labor abuses rather than attacking the structural integrity of the currency itself.
Right. Now, we should point out that this is a highly contested economic philosophy.
Oh, absolutely.
The debate between Austrian economists who favor rigid, hard money constraints and Keynesians who believe the government must manipulate the money supply to alleviate immediate economic suffering. I mean, that is essentially the defining economic argument of the last century.
Yeah, and just to be totally clear to you listening, we aren't here to take a side or declare a winner in that debate. We're just imparting Kava's views. But we have to understand Kava's worldview to understand his charts.
Right, because he firmly believes that hard money is the only defense against structural impoverishment.
And he bridges that 1900 allegory to the year 2026 by declaring that today, the cowardly lion has won.
Yeah, the populists have taken over the Emerald City.
They have unmoored the currency from any hard constraint and are just running the fiat money printers continuously to paper over economic structural issues and buy votes.
And to Kava, this endless printing is the actual mechanism of monetary degradation that slowly drains the purchasing power of the working class.
The imagery of the cowardly lion just running the central bank printing press is, I mean, it's hard to shake. It's a great visual.
It really is.
But okay, if we operate under Kava's premise that our fiat currency is being relentlessly degraded, how do you actively protect yourself? Because you and I, we can't carry troy ounces of silver to pay our taxes or, buy groceries.
Right, it's not practical. And this is where Kava transitions from macroeconomic theory to tactical execution.
Okay, let's get into the tactics.
Because in a digital, globalized economy, if you want a non-sovereign hard asset with a fixed supply cap that the cowardly lion absolutely cannot inflate, you arrive at Bitcoin.
Right. But Kava goes way deeper than just telling his audience to, like, buy crypto.
Oh yeah. He outlines a highly specific acquisition strategy built around tax optimization and market structure.
Which I found fascinating. Let's get into the actual mechanics of that.
Yeah.
Because he completely ignores the traditional crypto exchanges.
Mm.
He isn't telling people to set up cold storage wallets and manage private keys, which is usually the advice you hear.
Right, the whole not your keys, not your coins thing. He skips that.
He advocates using a traditional brokerage platform, Freedom 24, to buy ETNs, exchange traded notes.
Uh-huh.
Now, I understand avoiding the counterparty risk of some sketchy offshore crypto exchange, but an ETN is essentially an unsecured debt security. You are trusting the issuer to pay you the return of the index.
It's a big trust exercise, yeah.
So why is Kava taking on that specific counterparty risk instead of just holding the underlying asset himself?
It comes down to the specific structuring of the ETNs he selects. Kava isn't just buying synthetic ETNs that use derivatives to track price. He specifically targets ETNs where the management company holds physical Bitcoin in cold storage on a one-to-one basis to back the issued notes.
Okay, so it's backed by actual Bitcoin.
Exactly. The price of the ETN directly tracks the dollar value of the sequestered Bitcoin. And for a traditional investor like Kava, analyzing charts in Madrid, this offers a lot of benefits. It offers regulatory clarity, ease of access through existing brokerage accounts, and it completely eliminates the technical risk of, losing a private key or getting hacked.
Okay, so the custody aspect makes total sense. But the real tactical maneuver here, the absolute cheat code he reveals, is that he doesn't just buy one Bitcoin ETN.
No, he splits it.
Right. He splits his focus across two mathematically identical but fundamentally different ETNs. One trades under the ticker BTC, which has massive liquidity and trading volume, and the other trades under the ticker WBTC, which is slightly less liquid but compensates by having lower management fees.
Right.
But why overcomplicate the portfolio by holding two different tickers for the exact same underlying asset?
Because he wants to legally circumvent the wash sale rule and harvest tax losses.
That's so sneaky, but so brilliant.
It really is. This is where Kava proves he is a pragmatic market operator, not just some ideological purist. He knows Bitcoin is going to suffer agonizing 20%, 30%, or even 40% drawdowns.
Because volatility is the toll you pay for the performance in this asset class.
Exactly. But he wants to make that volatility work for his annual tax return.
Okay, so walk me through the exact mechanics of how he executes this between the two tickers. Let's say I'm the investor.
Okay, so let's say you buy the highly liquid BTC ticker and the market suddenly suffers a severe correction.
Yeah.
Your position is now significantly underwater.
Which hurts.
It hurts, yes.
Yeah.
Now, you want to realize that paper loss, so you can deduct it against your other capital gains or your regular income, which lowers your overall tax burden for the year.
Makes sense.
But tax authorities globally have variations of a wash sale rule, what Kava calls the 2-month rule. If you sell an asset at a loss and buy that exact same asset back within a short window, the tax authority invalidates the loss.
We act like you never sold it.
Exactly. They treat it as a wash.
So you can't just bounce out and bounce right back in to grab a tax receipt.
Right. So what Kava does is he sells the BTC ticker, realizing the paper loss legally, but he is still fundamentally bullish on Bitcoin, right? He wants exposure to the inevitable rebound.
He doesn't want to miss the rally.
Exactly. So instead of waiting out the 2-month penalty bucks in cash and missing the pump, he immediately takes that capital and buys the WBTC ticker.
And because it's a different management company and a different legal ISIN number, the tax authority views it as a completely different financial instrument. even though it tracks the exact same Bitcoin price action.
Precisely. It is a completely different security in the eyes of the law. So he maintains uninterrupted exposure to the asset class, but he successfully harvests the fiscal loss to lower his tax base.
It is a brilliant clinical strategy. It bakes the inevitability of market crashes into a mathematical advantage.
Yeah, he's making the volatility pay him.
But, mitigating your tax bill on a loss is essentially putting a bandage on a wound, right?
Huh.
Kava's deeper analysis is about avoiding the wound entirely by understanding why these massive crashes happen in the first place.
Right.
Which brings us to a very specific, terrifying window in April of 2025. And this introduces the concept of la barrida,
Or the sweep.
the sweep.
The sweep is basically the dark art of market mechanics.
Yeah.
It exposes exactly how institutional capital weaponizes the psychological fragility of retail investors.
The setup for this trap is fascinating, so let's walk the listener through it. In early April 2025, Bitcoin establishes what looks like an ironclad floor at $74,420.
Right.
For the retail novices, the people Kava calls the weak hands, this
Mhm.
specific number becomes a psychological safety blanket.
Mm.
They look at the chart, they see it bouncing off 74K a few times,
Mhm.
and they logically place their stop-loss orders just a fraction below that level.
Because the stop loss is an emotional circuit breaker. The retail investor is telling their broker, look, if the price falls to 74,400, automatically sell my position at market price so I don't lose everything. It is a totally defensive maneuver.
It makes sense on paper.
It does. But the institutions, the strong hands, the market makers, the hedge funds, they have access to order book data. They can literally see massive clusters of liquidity sitting right below that $74,420 line.
They can see the vulnerability.
Exactly. They know exactly where the novices have parked their defensive sell orders.
And the strong hands need those sell orders to execute their own strategy, don't they?
Oh, absolutely.
Because if a massive institution wants to accumulate $1 billion worth of Bitcoin, they can't just hit buy on the open market.
No way. The sheer size of their order would consume all the available sell orders on the books and just rocket the price upwards, meaning they'd be paying massive premiums for their own demand.
So to accumulate massive size without causing that kind of slippage, institutions need a massive concentrated pool of sellers who are willing to hand over their assets at a cheap price.
And as you just pointed out, the biggest, most predictable pool of sellers is that cluster of automated stop-loss orders sitting just below the perceived floor.
So they hunt them.
They absolutely hunt them. The strong hands will deliberately deploy capital to aggressively short the market, or maybe they just dump a huge block of spot inventory into a low liquidity window, say on a Sunday night when retail isn't watching.
Right.
And they artificially push the price down just enough to break that $74,420 floor.
And the moment the price ticks to $74,419,
The cascade begins.
it's an avalanche.
It is a purely mechanical avalanche. The first layer of stop losses trigger executing market sell orders. Those automated sales push the price down further, which then triggers the next layer of stop losses, which pushes the price down even further.
And the institutions just step back and watch the algorithmic slaughter.
Basically, yeah. While simultaneously placing massive limit buy orders at the bottom to absorb all the panic selling.
Which is how we get the crash all the way down to $60,000. And Kava is very critical of the financial media's role in this whole process, right?
Oh, he loathes it.
Because once the price breaks 74K and starts cascading to 60K, the media narrative instantly shifts. They start publishing all these articles about how the halving cycle has failed. Analysts come on television projecting a drop to 40,000 or lower.
Adding fuel to the fire.
Exactly.
Yeah.
So the retail investors who didn't use stop losses are now sitting at home watching their portfolios bleed out while the news tells them it's going to zero. So they capitulate manually. They just hit the sell button in pure terror.
Which is exactly what the sweep is designed to achieve. The strong hands sweep the weak hands entirely out of the market. The retail investor sells their asset at $60,000 in a state of manufactured panic, and the institutional whale happily buys it from them at a massive discount.
And the charts absolutely prove the manipulation here, because Kava shows that once the institutions absorb that liquidity, the price magically V-shaped right back up.
Yep.
By March 16th, 2026, it swept completely back above the original $74,420 safety line. And by April 13th, it was establishing higher lows and continuing the macroeconomic bull trend.
Right, because the underlying reality of the asset never changed. The only thing that changed was that the Bitcoin moved from the wallets of the terrified working class into the vaults of the institutions.
It's infuriating. But this is the critical asymmetry Kava wants his audience to understand. The uninformed retail herd typically buys when a resistance level breaks upwards. They chase the green candles, buying the euphoria.
Buying the top.
Right, but the professional strong hands do the exact opposite. They buy the breakdown. They wait for a key support level to fail, they wait for the blood in the streets, and they buy the fear.
But if the institutions are invisible and their algorithms are operating at millisecond speeds, how does a retail investor in Madrid or anywhere else defend against this?
That's the million-dollar question.
Well, Kava says they always leave footprints, but you have to know how to look for them. He suggests a complete paradigm shift in how we read a chart.
Okay, so moving away from traditional volume and focusing entirely on what he calls volume by price.
Exactly, because traditional volume, those little vertical bars at the bottom of a standard price chart, that only tells you how many units were traded on a specific day.
It's just tracking the x-axis, the time axis.
Right. It tells you when the market was active. But Kava argues that knowing when capital moved is totally useless if you don't know where it got trapped.
Okay, so to find where capital is trapped, you have to look at the y-axis. You have to look at volume distributed horizontally across the price levels.
Exactly. Volume by price maps out a histogram on the side of your chart. It visually demonstrates exactly how many coins were traded at every single specific price interval over a given period. It completely strips away the concept of time and focuses entirely on capital commitment.
Cava drops a brilliant quote here from José de la Vega, who was a 15th century merchant who wrote about early stock exchanges. De la Vega said the market is a business of people with the excuse of economics.
It is a phenomenal insight to apply to a 2026 digital asset chart. Because when you look at a massive spike on a volume by price profile, you are not looking at a statistical anomaly. You are looking at a psychological monument.
A monument, I like that.
You are seeing the exact price level where thousands of human beings experienced FOMO and bought in, or experienced terror and sold out. You are looking at where the highest concentration of human conviction lies.
And when Cava runs this volume by price metric across the massive multi-year timeline, from the depths of the 2020-2023 bear market all the way through 2026, one specific price level towers over everything else, the $67,100 node.
The point of control. Over that entire multi-year span, more capital exchanged hands at exactly $67,100 than anywhere else on the chart. That level represents the ultimate consensus of fair value for that era.
And if we combine this volume data with our understanding of the sweep we just discussed, the institutional cruelty becomes even more apparent, doesn't it?
Oh, it's brutal.
When they broke the $74,420 floor in April 2025, they didn't just stop at $70,000. They deliberately drove the price all the way down through that massive $67,100 volume node, ultimately bottoming out at $60,000.
Right, because they weren't just hunting the stop losses of the short-term speculators at 74K. By driving the price below 67,100, they were deliberately inflicting maximum financial pain on the largest cohort of buyers in the entire market.
It's psychological warfare.
It really is. Think about it. If you bought at the point of control at 67K and held through years of chop, seeing the price get dragged down to 60K with the media screaming about a crash, that is the ultimate test of conviction. The strong hands wanted to break the spirit of the long-term holders and force them to capitulate too.
Wow. But the silver lining in Kava's analysis is what happens after a level like that is swept and reclaimed. Because they flushed out all the weak hands at 67,100 and replaced them with institutional diamond hands who accumulated the dip, that price node fundamentally changes its molecular structure.
It ceases to be a vulnerability and becomes an absolute fortress. The people who hold the asset at 67,100 now are the strong hands. They are not going to be shaken out by a bad inflation print or a scary headline. They bought the bottom. Therefore, Kava identifies that $67,100 volume node as the ultimate tested foundational floor for the next leg of the macroeconomic cycle.
Okay, so we have survived the historical context of the cowardly lion inflating the currency. We have built our tax-optimized ETN shield. We understand the predatory mechanics of the algorithmic sweep. And we have found our fortified floor at $67,100 by tracking the human heartbeat of the order book.
We've covered a lot of ground.
We really have. But the final question Kava addresses is, where does the chart project we go from here?
Right, and here he shifts from forensic analysis to geometric projection. Kava builds a roadmap using channels, and he anchors them to those exact points of maximum institutional accumulation.
Walk me through the actual geometry of these trend lines. How is he determining the trajectory?
He starts by identifying the floor of the macroeconomic trend. He draws a bullish directrix line, basically an upward sloping trend line, that connects the absolute capitulation bottom in the $20,000 zone directly through the newly fortified volume node we just discussed at $67,100.
Okay, so connecting the two zones of maximum fear and institutional buying.
Exactly. By doing that, he establishes the fundamental vector of the current market structure.
That upward slope makes sense as a support channel.
Yeah.
But how does he extrapolate the ceiling? Are we just cloning the angle and placing it on top of the peaks?
Yep, exactly. He takes the precise angle of that foundational directrix line and creates a parallel line above the price action. He anchors this upper parallel line to the recent cyclical peaks, the localized tops in March 2024, March 2025, and January 2026,
Creating a channel.
creating an ascending channel. The price is oscillating within this massive, upwardly tilted corridor. And based on the velocity of the current trend, if the price pushes to the top of that specific channel in the near term, Kava projects an intermediate target of $105,000.
$105,000. That is a massive psychological barrier. But his macro projection goes even further than that, doesn't it?
It does. He pulls the lens all the way back. If you draw a macro parallel line connecting the absolute structural peak of the 2021 bull market with the cyclical peak of 2025, the geometry of that overarching channel projects an ultimate upper boundary of $137,000.
Now, when we start talking about targets like 105,000 and 137,000, we have to tread very, very carefully.
We do.
Because this is the exact kind of moon math that triggers retail FOMO. It's the kind of euphoric projection that makes novices mortgage their houses to buy the top of green candle right before the institutions orchestrate another sweep.
And Kava is hyper-aware of that danger. His delivery of these targets is incredibly grounded. He does not present 137,000 as a guaranteed prophecy or a strict timeline. He presents these channels as mathematical framework for the listener to critically evaluate.
He is essentially giving us a map, but demanding that we continually check the compass ourselves.
That's a great way to put it.
He explicitly tells his audience not to act like the herd.
Because a skilled speculator doesn't trade blindly off a single projection. A skilled speculator builds a matrix of knowledge. If the price approaches 105,000, they don't just blindly hold and hope.
Right, they look at the volume profile to see if capital is trapped.
Exactly. They watch for the footprints of the strong hands preparing a sweep. They manage their tax liabilities using those ETN structures we talked about. And fundamentally, they remain anchored to the macro reality, the ongoing degradation of purchasing power by central authorities.
It's really about systemic awareness.
Right.
And that brings us to the core value of this entire deep dive. Let's synthesize what Kava actually handed us today, because we covered a lot.
We really did.
We started in a locked room in Madrid and traveled back to 1900 to use Dorothy and the Wizard of Oz as this profound lens for understanding the eternal battle between constrained hard money and inflationary populist politics. We recognized the modern cowardly lion running the central bank printing press.
Then we moved into tactical execution, right? Learning how to weaponize the inevitable volatility of the market by utilizing the WBTC and BTC dual ETN strategy to harvest legal tax losses, all while maintaining our market exposure.
We stared directly into the predatory mechanics of the market. We dissected how institutions hunt retail stop losses and orchestrated sweeps, artificially driving prices down to levels like 60,000 just to steal assets from terrified, weak hands.
And we learned how to counter that manipulation by ignoring the x-axis and reading the y-axis, using volume by price to map out the psychological graveyards of the market, identifying where true institutional accumulation builds fortified floors like that massive node at 67,100.
And finally, we looked to the geometric horizon, tracing the ascending directrix channels toward potential macro targets of 105,000 and 137,000, equipped not with blind greed, but with critical, calculated foresight.
And, the underlying lesson here goes far beyond Bitcoin or any single asset class. Whether you were trading digital assets, equities, or real estate, markets are fundamentally driven by human psychology and structural mechanics.
Yeah, the asset might change, but the game doesn't.
Exactly. If you do not understand how liquidity is hunted, if you do not understand the macro forces degrading your purchasing power, and if you blindly react to media headlines, you will inevitably be swept away by players who understand the game better than you do.
You either learn to read the footprints, or you become the prey, which is a sobering thought. But I want to leave you, the listener, with one final thought to mull over today, tying it back to Kava's brilliant use of literature.
L. Frank Baum was able to look at the immense, chaotic economic upheaval of the 1890s and distill it into a children's story that perfectly captured the monetary struggles of the scarecrow and the Tin Woodsman.
Right.
If an author were to sit down today and write the defining children's book of the 2020s, what exactly would it look like? Who is the modern protagonist trying to navigate this bizarre landscape of invisible digital ledgers, algorithmic stop-loss sweeps, institutional whales hunting liquidity, and central banks continuously diluting the money supply?
It's a profound question. I mean, the architecture of the financial system has become so abstract that it almost requires a fantasy novel to explain it.
And perhaps more importantly, when you evaluate your own financial story and the decisions you make under pressure, which character are you playing?
Well, that's good.
When the market drops violently and the headlines scream that it's all over, are you playing the part of the weak hand abandoning your position in terror?
Yeah.
Or are you learning to read the structural environment, utilizing the volatility to your advantage, and calmly following the footprints of the strong?
That is definitely something to keep at the forefront of your mind the next time you look at a red chart. Thank you for joining us on this deep dive. Keep questioning the narrative, keep looking past the noise, and we will see you next time.
So, in the year 2000, right at the absolute peak of the dot-com mania.
Right, the peak of the bubble.
Exactly. Microsoft was trading at like roughly 57 times its earnings. And I mean, the entire financial world looked at that and basically screamed that it was a bubble.
Oh, yeah. It was the classic warning sign.
Yeah, but okay, today, look at Costco, a company whose primary innovation is, selling you bulk toilet paper and a $1.50 hot dog.
Right.
They are trading at 50 times their earnings. Meanwhile, NVIDIA, the company building the literal hardware architecture of the artificial intelligence revolution, they're sitting at a PE of around 19.
It's kind of wild when you frame it that way.
It is. So if you were looking at your portfolio right now and thinking, the tech sector is caught in this massive speculative bubble, well, our source material today suggests you were just like entirely misreading the board.
Yeah, it's a complete inversion of the accepted narrative.
Yeah.
Because we are constantly told to be wary of tech valuations, right?
Yeah.
To look for those warning signs of 2000 or 2008.
We're told to be terrified.
Exactly. But the metrics underlying the current market structure, they tell a drastically different story, provided, which numbers to actually look at.
Right.
And honestly, more importantly, which numbers to ignore.
And figuring out what to ignore is exactly the mission of today's deep dive into the source material.
Mm-hmm.
We are essentially stepping inside the incredibly cynical, highly lucrative, and honestly just ruthless mindset of what Aristotle calls a good speculator, or a speculado de bien.
I love that term.
Yeah. We're unpacking a Friday morning broadcast by the Spanish financial commentator José Luis Cava. He recorded this on this really beautiful spring morning in Madrid.
Right, you can kind of hear the nice weather in his voice.
You really can. And he uses this opportunity to essentially just dismantle how you and I are taught to view global finance.
What's fascinating here is how the contrast between his tone and the subject matter, it's what makes this so compelling. I mean, he's practically energized by the weather, talking about the weekend, and then he just seamlessly pivots into outlining, like, massive geopolitical crypto laundering operations.
Oh, yeah. It escalates quickly.
Right. He goes right into the deliberate subversion of global sanctions and the systematic algorithms designed to basically wipe out the retail investor. He is blending dense macroeconomic theory with raw, unfiltered market psychology.
Okay, let's unpack this, because if you want to understand how the market actually functions, not how the textbooks say it functions, you have to follow his logic from the very top.
Yeah, you have to track the whole argument.
And strangely enough, before he gets into what he literally calls the maldades, like the evil deeds or secrets of the market, he actually starts with this shockingly utopian vision of the near future.
Right. He opens by referencing a video forecast by a group called the OPLA team. And this forecast is projecting a massive, almost unprecedented economic boom, arriving specifically in the year 2027.
Yeah, the specificity of it is really what caught my attention. I mean, they aren't just saying, like, things will get better generally.
No, they're laying out exact metrics.
Exactly. They are predicting a massive surge in private consumption. They are projecting that inflation will drop to exactly 2%. They even name a specific figure, someone named Kevin W., who they claim will be orchestrating interest rate cuts by 2027.
It's incredibly precise.
Right. They see U.S. economic growth just accelerating wildly, making 2027 one of the most profitable years imaginable for a good speculator. But I mean, if you understand macro forecasting, predicting the exact actions of central banks and like private consumption habits 3 years out, it's statistically absurd.
It basically borders on financial astrology. But let's
Mhm.
look at that specific 2% inflation target they're anchoring this on. 2% is the holy grail.
Oh, absolutely.
It's the explicit target for the Federal Reserve and the European Central Bank. But hitting exactly 2% and sustaining it while simultaneously experiencing a surge in private consumption and accelerating economic growth.
It doesn't make sense.
No, it defies the standard Phillips curve logic. Usually, if growth and consumption are running that hot, the labor market tightens, wages go up, and inflation naturally rises above 2%.
Exactly. You just don't get massive consumption booms without demand pull inflation. So to predict both simultaneously, it requires a massive leap in underlying productivity, basically assuming that technology or AI will make supply so efficient that it just absorbs all that massive demand without raising prices.
Which is theoretically possible, I guess.
Mhm.
But to bank on it by 2027 is a staggering assumption.
Right, so my question is, why is the source, who is incredibly cynical and who we know is about to drop these evil market truths, why is he highlighting this utopian OPLA forecast at all?
Yeah, it feels like a setup.
It really does. If you see a weather report promising 75 degrees and pure sunshine on a Tuesday 3 years from now, you might smile, but you don't actually plan your life around it. You keep an umbrella handy because it sounds too good to be true.
And neither does he. He actually admits he reviewed the data and enjoyed it like a dwarf.
Wait, enjoyed it like a dwarf.
It's Spanish idiom. It basically means having an incredibly good time.
Yeah.
But the point is, he isn't buying the utopia.
Yeah.
He's showing you the narrative that is actively being constructed by macro forecasters right now.
Ah, I see.
He is setting up a baseline of mainstream optimism, and he's doing that just to contrast it with the incredibly dark reality of how capital is actually moving behind the scenes right now.
Huh.
Because he pivots immediately from this bright 2027 sunshine to what he calls his worst maldad yet.
And this pivot is jarring. I mean, we go from discussing interest rate cuts in 2027 to the geopolitical reality of Iran, cryptocurrency, and the architecture of modern war.
It's a hard left turn.
Very hard, because if 2027 is a mirage, how are these big players actually moving their money in the real world today? We don't have to look at the future. We just have to look at the blockchain.
Exactly. This raises an important question about decentralized finance. The source cites a very specific Wall Street Journal report detailing how the Iranian regime is actually financing the Revolutionary Guard.
Right.
And the architecture of that financing isn't moving through shadowed Hawala networks or, briefcases of physical cash. It is built entirely on blockchain technology, specifically moving through the Binance crypto exchange.
And the scale here is really what breaks the conventional narrative. From 2024 to the present, the transaction volume they are tracking is over $1 billion.
$1 billion. It completely subverts our understanding of international diplomacy and economic warfare.
Yeah, because for decades, the ultimate weapon of the U.S. Treasury has been the economic sanction.
Right. If you cut a nation-state off from the SWIFT banking system and freeze their dollar reserves, you essentially paralyze their ability to function in the global economy, because SWIFT is the central nervous system of global finance.
But decentralized ledgers were explicitly engineered to be borderless and censorship-resistant.
Exactly. They don't care about SWIFT.
But here is where the source's analysis gets truly sinister. Decentralized or not, to move $1 billion and actually use it to buy weapons or fund military operations, you need fiat off-ramps. You need actual liquidity. The source even quotes this line to open his broadcast. He says, "Cold coins are pure trash."
That is such a profound statement regarding crypto utility. $1 billion sitting on a hardware wallet that is completely disconnected from the internet.
Yeah.
It has zero geopolitical power.
Nothing. You can't buy anything with it.
Exactly. It only gains power when it interacts with an exchange where it can be liquidated or transferred at scale.
Exactly. So it has to go through an exchange like Binance. But according to the Wall Street Journal report the source is citing, the internal compliance team at Binance actually flagged these specific Iranian accounts.
They knew about them.
Yes. The source points to a graph from the report highlighting a literal red line that tracks these trades. The compliance team, the people utilizing Chainalysis and forensic accounting to prevent this exact scenario, they knew these addresses were violating international sanctions.
They flagged the addresses. I mean, the internal systems worked as designed to identify illicit flows.
And yet the transactions were executed anyway. $1 billion moved right through the red tape.
Unbelievable.
If you're looking at the mechanics of this, it's not a failure of detection, it's a failure of enforcement. It's like a bouncer at a VIA club who checks an ID, announces loudly that it's a fake, but then just unhooks the velvet rope and lets the person in anyway while the authorities are standing right there watching.
Which completely shatters the illusion of regulatory control. We are constantly fed a narrative about the iron grip of international sanctions. But the good speculator, they ignore that noise.
Right. They look at the actual flows.
Exactly. They look at the blockchain, they see the $1 billion moving. For them, the geopolitical narrative is just a facade. The reality is the liquidity flow.
But you have to ask, why would a massive, globally scrutinized exchange allow flagged billion-dollar transactions for a heavily sanctioned entity to just sail right through? The liability risk is astronomical.
Unless they don't care.
Right. Unless, of course, they feel entirely insulated from that risk. Which brings us to the political bombshell the source drops to explain this exact mechanical breakdown.
Yes, he moves directly from the geopolitical to the political to explain the why.
Now, before we get into this next part, we need to make something crystal clear to you. The source material contains some politically charged claims about U.S. politics. We are not taking sides here, nor are we endorsing these viewpoints. We're simply reporting to you exactly what the original source material states to understand the speaker's argument.
Absolutely.
Yeah.
We're just analyzing the mechanics of his argument, not litigating the politics behind it.
Right. So to explain why an exchange would blatantly ignore flagged sanction violations, the source points directly to political patronage.
Mm.
He claims that the founder of Binance was pardoned by Donald Trump when he took office as U.S. president. Furthermore, the source explicitly claims that Binance helped finance Trump's campaign activities and likely assisted his family's own crypto enterprise.
What's fascinating here is how the source utilizes these claims to construct a unified theory of regulatory immunity. He isn't making a moral judgment at all. He is just outlining a mechanical reality.
It's the mechanics of power.
Right. In his view, the threat of international sanctions and the rigors of financial compliance are entirely malleable. They are not absolute laws of physics. Political patronage, campaign financing, and strategic alignments, they create an impenetrable shield against regulatory enforcement.
It really defines the pure cynicism of the good speculator. I mean, they don't watch the news and say, oh, well, the Treasury Department sanctioned Iran, so their capital flows are cut off.
No, they don't care about the press release.
Exactly. They look at the power dynamics, they trace the campaign donations, they analyze who holds the pardoning power, and they calculate that the money is going to flow regardless of the law.
Because alpha-like, true market advantage isn't generated by assuming everyone follows the rules. It is generated by identifying who is structurally exempt from the rules and modeling how their capital will move as a result.
That makes total sense. So if political armor protects the hidden, illicit flows of capital, where is the legitimate capital actually going in the public markets? Because if you turn on any financial network today, the overwhelming consensus is that we're living through a massive, precarious, artificial intelligence bubble.
Right. Everyone is screaming AI bubble.
But the source aggressively dismisses this. He says the entire AI bubble narrative is fundamentally flawed.
He dismisses it with the authority of someone who survived the actual trauma of the year 2000 .com collapse.
Yeah, he lived it.
He explicitly states that living through that crash is what changed his life and officially forged him into a good speculator. He knows what structural market risk actually looks like.
Right, so he isn't just throwing out opinions. He is comparing the underlying balance sheets and valuation metrics of 2000 against today. Which brings us back to that staggering statistic I mentioned at the top of the deep dive. Let's really dig into the price-to-earnings ratios he uses to dismantle the bubble myth.
Okay, so if we connect this to the bigger picture, in the year 2000, during the height of the tech mania, the PE ratio for the entire NASDAQ 100 index, that's the top 100 non-financial companies, was an astronomical 190.
Meaning investors were literally willing to pay $190 for a single dollar of trailing profit.
Precisely. The market was completely detached from fundamental earnings. Investors were buying the conceptual promise of the internet. I mean, many of the companies driving that valuation had zero earnings.
Right, just burning through cash.
Yeah, they were operating entirely on debt and venture capital burn rates.
Now, compare that to the source's data for today. The PE ratio for the NASDAQ 100 currently sits at 36. We've compressed from 190 down to 36. But the aggregate index doesn't even tell the whole story.
No, you have to look at the individual players.
Exactly. The source drills down into the bellwethers of both eras. In 2000, Microsoft was the undisputed engine of the boom. Its PE hit 57. Today, the darling of the AI hardware revolution, NVIDIA, is trading at a PE of around 19.
And this is where the bubble narrative completely fractures. If we connect this to the broader market, investors are currently pricing NVIDIA, a company with a near monopoly on the computational hardware required for AI, significantly cheaper relative to its immense cash flow than they priced Microsoft in 2000.
Here's where it gets really interesting, though. Just to humiliate the bubble theorists, the source compares NVIDIA's 19 PE to legacy retail. He points out that Walmart and Costco are currently floating in the 45 to 50 PE range.
It's crazy.
It is mathematically cheaper, relative to profit generation, to buy a piece of the world's most advanced semiconductor designer than it is to buy a wholesale grocery warehouse.
But we really need to explain why NVIDIA's PE has compressed to 19, despite the stock price exploding upward. Because a lot of people might misunderstand that. It's not because the stock is falling, it's because their earnings are expanding at a violent, unprecedented rate.
All right, the profits are catching up.
The denominator in that PE equation, the earnings, is growing faster than the numerator.
But wait, let me push back on this for a second. The source argues this proves there is no bubble. The burbuja, nada de nada, no bubble at all. But isn't NVIDIA's current PE essentially a lagging indicator?
How do you mean?
Well, sure, they are printing cash right now because every major tech company is hoarding their GPUs. But what happens if the downstream software companies, the SaaS providers buying these chips, can't actually monetize the AI? If consumers refuse to pay a premium for AI integration, the hyperscalers stop ordering chips, NVIDIA's forward earnings collapse, and that PE of 19 suddenly shoots up to 100 overnight.
That is the crucial counterargument, right? The risk of a CapEx digestion cycle. But the source addresses the structural difference in how this infrastructure is being funded. He emphasizes that the major tech companies, the hyperscalers like Meta, Google, and Microsoft, are funding this massive AI build-out using Recurso's Propios.
Their own resources, like cash.
Exactly. Free cash flow. This isn't the year 2000, where companies were floating junk bonds or doing secondary offerings to fund server space. The hyperscalers today are generating tens of billions of dollars in free cash flow from their existing, highly profitable web and cloud businesses.
So they aren't borrowing to build this.
Right. And they are redirecting that cash into AI infrastructure. The structural balance sheet risk is entirely different. Even if the AI monetization is delayed, these companies aren't going to go bankrupt servicing debt because there is no debt.
Wow, so they already have the money in the bank. The foundation is solid. The source also points out that AI, much like the internet in 2000, is a genuine miracle of productivity. It fundamentally alters the cost of cognitive labor.
Absolutely.
So we have solid fundamentals, massive corporate cash reserves, and a true technological paradigm shift. It sounds like the perfect environment for a perpetual bull market. But, and here's the catch, the source's experience in 2000 taught him a brutal lesson.
He learned that strong earnings, technological miracles, and massive productivity are necessary, but they are completely insufficient to actually drive a prolonged market rally.
Right, because productivity alone doesn't move the S&P 500. To do that, you need something else. You need the master puppeteers. You need the central banks.
This is the core thesis of his macroeconomic worldview. The source notes a fascinating timeline alignment. His broadcast actually coincides with the end of Jerome Powell's term as Federal Reserve Chairman. He notes that under Powell's watch, the Dow Jones has rallied roughly 93%. That is a historic expansion.
Huge.
But the source doesn't view Powell as the ultimate architect of this dynamic. The true pioneer, the hero of the good speculator, is Alan Greenspan.
Right, he mockingly but kind of affectionately refers to him as Alan Burbahita Greenspan, little bubble Greenspan.
Because Greenspan normalized the mechanism that currently defines global finance. The source argues that while the internet introduced productivity in the late 90s, the actual accelerant that caused the stock market to go parabolic was expansionary monetary policy.
Injecting cash.
It was the deliberate injection of macro liquidity into the financial system.
If you look at the mechanics of this, it completely reframes how you view asset prices. We are taught that a stock price goes up because a company creates value. But the source argues that a stock price goes up primarily because the central bank has degraded the purchasing power of the currency used to buy that stock.
He refers to this as monetary degradation. When the Federal Reserve engages in quantitative easing, or interventions in the repo market, they are fundamentally increasing the supply of base money.
And that money has to go somewhere.
Exactly. This liquidity has to go somewhere. It seeks yield. And inevitably, it flows into financial assets, inflating their nominal value regardless of the underlying corporate productivity.
It's the difference between a rising tide and a growing ship. If the central bank floods the system with liquidity like a giant swimming pool, the water level rises.
Great analogy.
Right. Every asset, from tech stocks to real estate to fine art, gets lifted. The market feels like a genius-making machine, but the flip side of that mechanism is absolute carnage.
Because if the central bank controls the water level, they also have the power to drain the pool. The source asks a rhetorical question. What actually popped the dot-com bubble in 2000? It wasn't a sudden collective realization that Pets.com was a bad business model.
No, he states explicitly that the bubble popped simply because Alan Burbahita Greenspan decided to withdraw the liquidity. He tightened monetary policy, raised rates, and drained the capital from the system. When the water vanished, it didn't matter if you were a fundamentally sound company or vaporware. Every swimmer hits the concrete.
And this cycle of monetary degradation and subsequent tightening has only violently accelerated.
Yeah.
We saw it post-2008, and we saw it on an unprecedented historic scale during the 2020 COVID-19 crisis.
Right.
The central banks are now trapped in a cycle where they must constantly inject liquidity to prevent systemic collapse, which perpetually inflates asset prices.
Which means the speculators aren't really analyzing companies anymore. They are analyzing central bank balance sheets. They are trading the liquidity flow. But here is the massive contradiction that leads to the darkest part of the source material.
Yeah, this gets grim.
If everyone knows the central banks are injecting liquidity and everyone knows the market trends upward over time because of monetary degradation, why doesn't everyone get rich?
If the macro trend is engineered to go up, why do retail investors consistently lose money?
Exactly. How do the massive institutional players, the hidden hands, actually make their billions off the everyday investor? This brings us to Section 6 of the outline, detailing the sheer brutality of market mechanics. The source calls this tactic expulsar las manos débiles, expelling the weak hands.
This is where we move from macro liquidity down to the microstructure of order books and algorithms. The source dissects the anatomy of the 1998 to 2000 market manipulation to show exactly how retail investors are methodically slaughtered.
He uses the exact numerical levels to illustrate the psychology. He notes that the NASDAQ 100 began its historic run in 1998 at an index level of roughly 1,050. Fueled by Greenspan's liquidity, it went completely parabolic, hitting a peak of around 4,800 in early 2000.
At 4,800, retail participation was at maximum saturation. The psychological euphoria was absolute. People were quitting their jobs to day trade tech stocks.
And then Greenspan pulled the liquidity and the market collapsed. But the critical insight from the source isn't that the market crashed. It is where the market was deliberately driven to bottom out. It didn't just retrace to a historical moving average. It was driven down to the 1,000 level.
Right. It started the bull run at 1,050, and it crashed to 1,000.
So what does this all mean? Why drive it precisely to that level? If the market was corrected, why not stop at 1,500? Why push it just below the origin point of the entire multi-year run?
Because it is a targeted, algorithmic, psychological strike. It is designed to trigger maximum emotional and financial surrender. Think about the order book dynamics. Institutional players know exactly where retail investors place their protective stop-loss orders.
Oh, of course.
They cluster just below major psychological support levels, like the origin point of a breakout.
Right. If you bought in at 1,100, you probably put your stop loss at 1,040, thinking, as long as it doesn't drop below where it started, I'm safe.
Exactly. So the market drops from 4,800, it hits 2,000. Retail is terrified. But they are holding because they are anchored to the past prices. It hits 1,500. They are praying for a bounce. But when the institutional players use their massive capital weight to force the price down through that 1,050 support level, it triggers a catastrophic cascade.
All of those retail stop-loss orders are automatically triggered. It creates a massive wave of forced selling.
And suddenly, the retail investor who held on for years isn't just watching their profits evaporate. They were actively losing their initial principal. The psychological pain becomes unbearable.
They just give up.
They capitulate. They sell everything at the absolute bottom just to stop the bleeding. They have officially been swept out.
And who is standing on the other side of that forced selling? Who is providing the bids when the retail investor is desperately hitting the ass?
The hidden hand. The institutional capital. They deliberately engineer the price drop to trigger your automated panic selling. They absorb all of your liquidated assets at a massive generational discount. And then, magically, the market finds a bottom and begins the next liquidity cycle upward.
You essentially get robbed legally by the structure of the market itself. It's just ruthless. And the terrifying part is that the source insists this isn't some relic of the dot-com era. He emphatically states that this exact mechanism, liquidity hunting, stop-loss cascading, expelling the weak hands, it happens systematically every single day in modern markets.
He points out that we see this exact algorithmic behavior in Bitcoin, in the S&P 500, in U.S. Treasury bonds, and in global oil markets. The asset class doesn't matter. The mechanics of human panic and institutional liquidity absorption are universal.
It is entirely predatory. Synthesizing this entire deep dive into the source material really leaves you with a radically altered perspective of global finance. I mean, we started with this pristine utopian 2027 forecast where inflation is perfectly balanced and growth is surging.
Right.
And the source used that just to show us the glossy brochure before taking us into the factory.
We moved into the geopolitical reality of blockchain-based shadow finance, where billion-dollar transactions flow through sanctioned Iranian accounts, completely subverting the global order because of alleged political shields and campaign finance.
We looked at the hard structural data proving that the AI bubble narrative is vastly overblown, comparing the massive free cash flow of modern hyperscalers to the debt-fueled vaporware of 2000.
And we tied it all together by exposing the dual mandate of the market's true masters, the central banks who control the macro liquidity that inflates the system, and the institutional algorithms that control the micro movements to systematically sweep retail investors out of their positions.
The overarching theme here is that the world of the good speculator is one completely devoid of the narratives you see on financial television.
Yeah, they ignore all of that.
The debates over whether a company has a good product or whether a geopolitical sanction is morally justified, it's all noise. It is a distraction designed for the retail public. In the speculator's worldview, political rules are bypassed with capital and access. The only true, unbreakable laws of the universe are the flow of macro liquidity and the brutal, mechanical algorithms designed to shake you out of your money.
It is a sobering lens through which to view your own capital.
Right.
Whether you are actively managing a portfolio, passively contributing to a retirement account, or just trying to understand the macroeconomic news cycle, you have to look past the sanitized narrative.
You have to.
You have to locate the hidden hand. When a market drops violently, you have to ask yourself, is the fundamental value of this asset actually changing, or are the algorithms just hunting for retail liquidity to sweep?
Which brings us to a final, very provocative thought to leave you with. If we accept the source's premise, if central banks entirely control the macro liquidity that dictates whether the broader market goes up or down,
Right.
and if the institutional hidden hands systematically manipulate the micro movements of individual assets specifically to trigger your stop losses and absorb your wealth, then the concept of traditional investing is entirely compromised.
Right. Are you ever actually investing in the fundamental value of a company's technology? Are you actually investing in the future of AI or the strength of the U.S. economy? Or are you simply sitting down at a rigged casino, gambling entirely on your ability to outsmart the puppet masters before they pull the liquidity strings? Something to think about the next time you look at a stock chart.
So imagine you're sitting at a cafe on a beautiful spring Monday morning in Madrid.
Oh, that sounds perfect.
Right. The temperatures are perfect. The sun is shining. And there's just this general palpable sense of optimism in the air. People are drinking their espresso, going about their day, totally trusting that the ground beneath their feet is solid.
Which, it's a nice feeling.
It is. But sitting right in the middle of all this pleasantness is financial commentator Jose Luis Cava. And he isn't looking at the sunshine.
Not at all.
No, he's looking at the global financial system, and he has decided that he is going to deliver what he calls las verdades del barquero.
The truths of the boatman. It's such a visceral phrase, honestly.
It really is. It immediately evokes this idea of uncomfortable, unvarnished realities.
Yeah, the kind of gritty, survival-level truth you face when you're crossing a rough, turbulent river.
Exactly. Completely disconnected from the safety of the shore. You don't want comforting lies from the boatman, right? You need to know if the boat is taking on water.
Because if it is, you need to be prepared.
And that is exactly our mission for this deep dive today. We are unpacking a single, incredibly dense piece of market analysis from our source that basically cuts through all the illusions we hold about how money, markets, and human psychology actually work.
And what makes this particular analysis so compelling is how it connects the micro to the macro.
Right,
We aren't just talking about abstract economic theory here.
right.
The core question driving all of this is, how do the hidden mechanical realities of the financial system completely defeat our human intuition?
That is the perfect way to frame it because, well, we're going to start with the brutal psychological realities of individual day trading, like why human intuition fails us there.
Hmm.
Then we're going to follow that thread up to a massive structural currency war happening right now between the European Central Bank and digital dollars.
Which is a huge deal.
It really is. And finally, we are going to look at a very specific, purely mechanical prediction about an upcoming SpaceX IPO that will literally force institutional giants to blindly sell off assets.
It's a fascinating dissection of the system's plumbing. But before we get into the mechanics of central bank panic and hedge fund traps, we should probably address the elephant in the room regarding our source material.
Yeah, we definitely should.
Because Kava is not someone who couches his language.
No, he is delightfully blunt. I mean, he has some incredibly aggressive takes in this piece regarding European politicians, Christine Lagarde, global conflicts, and just the fundamental value or lack thereof of fiat currency.
Very strong opinions.
Right. So to you listening right now, we just want to be clear. We are analyzing the architecture of his financial arguments. We are not here to co-sign his political viewpoints or his economic ideologies.
Exactly. We're impartially breaking down the math.
Yeah, regardless of where you fall on the political spectrum regarding central banks, the mathematical and structural mechanics he's pointing out are undeniable. We are just here to act as your guides through the psychology, figuring out how he arrives at his rather shocking conclusions.
Which is crucial, because he begins his analysis by violently tearing down one of the most pervasive illusions in modern finance.
Oh, the idea that speculation is easy.
Yes, the absolute myth that it's easy.
Okay, let's unpack this. Because if you spend any time on Instagram or YouTube or Twitter, you have been bombarded by these advertisements.
Constantly.
It's always some guy leaning against a rented sports car, promising that if you buy his $500 course, you can master day trading in a weekend.
It's the monetization of hope, really.
That's a great way to put it. They sell this narrative that the market is a puzzle that has been solved, and they're just, handing you the answer key.
And Kava takes direct aim at this. He points out that beginners enter the market desperate for a treasure map.
Right.
They want an absolute fixed set of rules. They think, if the 50-day moving average crosses the 200-day moving average on this chart, I buy.
And if the momentum indicator flashes green, I sell.
Exactly. They view these technical indicators as a secret code.
And Kava flat out says that speculating is absolutely not just the crossing of moving averages. But why is that such a dangerous trap for a beginner? I mean, intuitively, if a mathematical indicator shows a trend, shouldn't you follow it?
Well, the trap lies in what those indicators actually represent.
Okay.
A moving average is nothing more than historical data smoothed out over time. It tells you exactly what happened yesterday or last week.
But not tomorrow.
Right. It tells you absolutely nothing about what the collective chaotic psychology of millions of market participants will do tomorrow.
So it's looking backward.
Exactly.
Yeah.
If you rely purely on a lagging indicator, you're essentially trying to drive down a twisting, treacherous mountain road while staring exclusively into your rearview mirror.
Oh, wow. That makes perfect sense. The road behind you doesn't predict the hairpin turn coming up in 20 feet.
Exactly. And the deeper psychological trap is that knowing a technical trick or recognizing a chart pattern does not mean you have an internalized, adaptable system.
Like, you might know what a hammer candlestick looks like on a chart.
Yeah, but that is just surface-level knowledge. It doesn't mean you know how to react when the market violently rejects that pattern.
I think about it like professional sports, honestly. Like, if you, listening to this right now, decide you want to be a world-class tennis player, you might go out and buy the exact same high-end graphite racket that Novak Djokovic uses.
Sure, you can buy the gear.
You might even hire a coach to teach you the exact angle of his grip. But holding the racket correctly doesn't mean you can play at Wimbledon.
No, not at all.
The racket is just a piece of sporting equipment. The actual game, the instinct, the reaction time, the muscle memory, the ability to read your opponent's hips before they swing, all of that takes years to internalize.
That analogy hits the nail on the head. You can buy the tools, but you cannot buy the internalization of the game.
Right.
And Kava adds another layer of complexity to this that just completely destroys the treasure map illusion. He talks about the concept of the daily reset.
Oh, this was one of the most sobering points in his analysis. Walk us through the daily reset.
So beginners assume the market is a static physics equation. They assume that if they find a strategy that generates profit in January, it will naturally generate profit in February.
Which seems logical at first.
It does, but Kava argues that the environment is constantly, fundamentally shifting. The market is a living ecosystem.
Okay.
A trading strategy that works beautifully in an environment of, say, low interest rates and high optimism will absolutely obliterate your portfolio in an environment of rising interest rates and geopolitical fear.
Because the underlying physics of the market have changed.
Yes. The serious speculator wakes up every single morning recognizing that the board has been wiped completely clean.
The variables are different.
The variables have changed, the liquidity has changed, the dominant narrative has changed. You have to constantly adapt your internal system to this new present reality, rather than rigidly forcing yesterday's strategy onto today's market.
So this presents a massive paradox for the listener. If the treasure map is a myth, if moving averages are just rearview mirrors, and if the environment is constantly shifting under our feet to the point where yesterday's rules don't apply today,
Yeah.
what on earth is the goal? If you sit down at your trading desk to be what Kava calls a speculator of the good, what are you actually trying to achieve? Because intuitively the answer is to make money.
And this is exactly where Kava completely flips conventional wisdom. He argues that if your primary goal when you sit down is a specific monetary target, you have already lost.
Wait, hold on. I want to challenge that. The entire purpose of participating in financial markets is capital appreciation, is to make a profit. How can the goal not be money?
It sounds totally counterintuitive, I know, but think about the psychology of a monetary goal.
Okay.
Let's say you tell yourself, I need to make $500 today to pay my car lease. Your emotions are now inextricably tied to that specific dollar amount. If the market is flat and presents no good opportunities, you will feel the pressure of that $500.
Oh, I see. You'll start forcing it.
Exactly. You will force trades that don't fit your criteria. You'll take on excessive risk to hit your target. You'll break your own rules.
Because you're desperate for that specific number.
Yes. So Kava argues that the true goal of a speculator is simply the flawless execution of a deeply internalized system where your singular obsessive focus is risk management.
So the goal isn't profit. The goal is survival.
Survival through mathematics. He says the absolute nucleus of a speculation system is the risk-to-reward ratio.
And he draws a very hard mathematical line in the sand here. He states that a speculator can never, ever tolerate a 15 to 20% loss on a trade, and certainly not on their overall account.
Never.
But why that specific percentage? Why is 20% the point of no return?
It's what we call the drawdown death spiral, and it operates on two levels, mathematical and psychological.
Let's tackle the math first, because it is remarkably unforgiving.
It really is. If you start with $100,000 and you take a 20% loss, you are down to $80,000.
Right.
Human intuition tells us, okay, I just need a 20% gain to get back to even, but that's fundamentally wrong.
Because 20% of 80,000 is only 16,000. That only gets you to 96,000.
Exactly. You're still in the hole. To recover from a 20% loss, you actually need a 25% gain on your remaining capital.
Wow.
And the deeper the hole, the more exponential the math becomes. If you let a loss run to 50%, taking your 100,000 down to 50,000,
You now need a 100% gain just to get back to the starting line.
exactly. You have to double your money just to break even. Kava's point is that if you don't ruthlessly cut your losses early, you will mathematically be kicked out of the market.
You just won't have enough capital left to play the game no matter how good your system is.
Right. But the math is only half the tragedy. Kava argues the psychological damage of a large loss is actually worse than the financial damage.
Without a doubt. Because when you take a massive uncontrolled loss, it completely destroys your self-confidence.
It really does. You stop trusting your system. You start questioning your own judgment.
And when you lose that trust, fear takes the wheel.
Yes. And fear makes you do irrational things. You start taking profits too early out of fear they'll turn into losses, or you hold on to losing positions hoping they'll magically bounce back.
The psychological foundation required to execute the system just collapses,
Entirely.
which perfectly sets up his philosophy on what a trader can and cannot control. He gives a brilliant example in the text. He says you could do everything right. You could have the perfect setup, flawlessly execute your entry, follow all your rules, and then suddenly someone important publishes a random tweet and the market violently plunges.
The random shock.
Yeah.
It's totally inevitable.
You cannot control the tweet. You cannot control the geopolitical flashpoint that happens while you're holding a position. So, if the market is that chaotic, how do you manage the risk?
You accept the chaos, and you control your exposure to it.
Okay.
You cannot control what Elon Musk or the chairman of the Federal Reserve says at 2 p.m. But you absolutely can control your entry points, your position sizing, and most importantly, your stop losses.
Right, the stop loss.
The stop loss is your circuit breaker. It is the pre-programmed emotionless order that automatically sells your position if it drops to a certain level.
It ensures that the random tweet results in a manageable 2% loss rather than the 20% death spiral.
Precisely.
Okay, so the logic is bulletproof. Set your rules, respect the math, use stop losses to protect yourself from chaos. But here's where Kava's analysis gets really fascinating to me because it delves into the neurology of a trader.
Yeah, this is a great point.
He says that when beginners start out, assuming they follow the golden rule of starting with very small amounts of money, they actually don't struggle with these emotional problems.
They don't. And it makes perfect sense biologically.
How so?
When you are trading with pennies or trading in a simulator with fake money, your mind is perfectly calm. The primitive, fear-driven part of your brain, the amygdala, does not register a $5 loss as a threat to your survival.
Oh, that makes sense.
Because there is no fear,
Yeah.
you can execute the system mechanically and flawlessly. You take the $5 stop loss without a second thought.
But then the trader proves to themselves that their system works. They've tested it, they've refined it, they are disciplined. So they decide it's time to scale up.
And that's when the trouble starts.
Right. They fund the account with their actual savings. Why is it that traders who are objectively good at the mechanics suddenly blow up their accounts when they start trading real money?
Kava calls it the emotional scaling problem. It is a massive psychological hurdle. When the numbers transition from pennies to very important quantities, quantities that represent months of salary or the down payment on a house, the psychological stakes shift drastically.
The fear hijacks the prefrontal cortex.
Utterly and completely. The exact same trader who calmly took a small mechanical stop loss yesterday will suddenly freeze when that stop loss represents $3,000.
They will physically be unable to click the sell button.
Exactly. They will start rationalizing, the market is just testing my conviction. It will bounce back.
And they manually move their stop loss lower and lower.
Yes, giving the loss room to grow. The fear of realizing a significant monetary loss and the greed associated with massive potential gains completely overwhelms the logical, systematic part of the brain that knows the math of the 20% death spiral.
So his point is that starting small isn't just a quaint piece of advice to protect your wallet. It is a mandatory neurological training ground.
100%.
You are quite literally trying to train your brain to operate devoid of emotion, to view money as mere data points in a system of probabilities.
Precisely. You are trying to become a machine in an environment designed to exploit human emotion.
Which paints a rather intense picture of the ideal speculator. Emotionless, mathematically rigid, ruthlessly protecting their capital from the chaos of random events.
It's a tough standard.
It is. But even if you achieve this Zen state of perfect discipline, you are still just a tiny organism swimming in a massive macroeconomic ocean.
Yes.
And according to Kava, the very currents of that ocean, the fundamental plumbing of the global banking system, are undergoing a violent structural shift.
He zooms out from the psychology of the individual trader to a massive macro-level currency war.
Right.
The environment that the disciplined speculator has to navigate is facing an existential threat.
And to understand the scale of this threat, Kava brings our attention to a meeting of the European Union finance ministers.
Yeah, this is huge.
During this meeting, Christine Lagarde, the president of the European Central Bank, essentially made a stunning admission. She admitted that stablecoins pose a direct systemic threat to the European financial system.
And Kava reads between the lines here. He argues that the ECB hasn't just identified a threat. They are acknowledging they have already lost a massive war against the digital dollar.
To fully grasp the gravity of Kava's claim here, we really need to put on our macroeconomic hats and meticulously break down the mechanics of what a stablecoin actually does to a traditional commercial bank.
Let's do it, because it's a slow-moving avalanche that most people are completely unaware of.
He specifically points to stablecoins like Tether and Circle, also known as USDC.
Right. Let's define them first for context. A stablecoin like Tether or USDC is a digital currency designed to maintain a one-to-one peg with the US dollar.
So one Tether equals $1.
Exactly. If you have one Tether, it is supposed to be worth exactly one US dollar. Now, how do they maintain that peg? They back it up.
Okay.
The companies issuing these coins take the dollars you give them and buy U.S. public debt, mostly short-term treasury bills, to hold in reserve as collateral.
Okay, so they aren't volatile like Bitcoin. They are digital proxies for the dollar, backed by U.S. government debt.
Hmm.
And Kava emphasizes that these aren't fringe experiments anymore. They process trillions of dollars in volume. They are deeply integrated into the plumbing of global finance.
Everywhere.
But here's the crucial question for you, the listener. How does your ability to buy a digital dollar token on your phone threaten the foundational stability of European banking? Let's trace the exact path of the money.
Let's do a thought experiment. Imagine a business owner in Spain, or simply a regular citizen in France who is worried about inflation or the geopolitical stability of Europe.
Sure.
They decide they want to hold a portion of their savings in a digital asset that tracks the US dollar because it yields a high interest rate and offers a perceived safe haven.
Makes sense.
So they log into a platform, take 10,000 euros that is sitting in their local commercial bank, say Santander or BNP Paribas, and they convert it into 10,000 euros worth of Tether.
They swap traditional bank deposits for digital stablecoins.
Yes. Now, let's look at the mechanics of what just happened to the European banking system.
This is the key part.
When that citizen converted their money, that 10,000 euros physically left their deposit account. It exited the European banking ecosystem.
Wow.
It is now sitting in the reserve accounts of the stablecoin issuer, like in a different jurisdiction, invested in U.S. Treasury bills.
The deposit has fled.
Exactly. Deposit flight. And this is where the structural damage occurs, because we have to understand how banks actually make money and function in the economy.
Right. They operate on a system called fractional reserve banking.
Which is absolutely foundational. A bank doesn't just put your 10,000 euros in a vault and leave it there.
No. When you deposit 10,000 euros, the bank might keep 1,000 in reserve, and they lend the other 9,000 out to someone else who wants to buy a house or start a bakery or expand a factory.
Exactly. Deposits are the raw material, the foundation of a bank's ability to lend.
So if we connect the dots, wait, let me rephrase. If we connect the dots here, if European citizens and businesses start moving billions of euros out of their local bank accounts and into digital stablecoins, the traditional banks are literally being drained of their raw material.
They are being hollowed out. If the deposits flee the system, European banks suddenly have significantly less capital available to lend. Their balance sheets shrink.
And what happens when a bank has less money to lend? Let's bring this back to the real-world impact for the listener.
It comes down to basic supply and demand. If banks have less capital to lend, money becomes scarce in the economy.
And when any commodity becomes scarce, its price goes up.
Exactly. In finance, the price of money is the interest rate. So because capital has fled into Tether and USDC, the cost to borrow money skyrockets for the average European.
Oh, man.
The family trying to get a mortgage will face higher rates. The small business seeking a loan to buy new equipment will be rejected or charged exorbitant fees simply because the local bank doesn't have the deposits to fund the loan.
That is staggering. We aren't just talking about a niche debate among crypto enthusiasts. We are talking about the fundamental capability of the traditional banking system to finance the real economy drying up.
It is a slow, structural strangulation of financial intermediation.
Yeah.
That is why Christine Lagarde is panicking.
Now, I want to push back slightly, or at least look for the central bank's defense mechanism here. Kava does mention that the European Central Bank isn't completely powerless, right?
True.
They could theoretically step in and act as a band-aid. If commercial banks are losing deposits, the ECB can just print money and give it to the banks to keep them afloat.
Yes, theoretically, the ECB can create liquidity. They have lending facilities. They can inject capital into the commercial banks to replace the deposits that fled into digital dollars.
Right.
But Kava dismisses this as a purely temporary, highly inflationary band-aid. It is treating a gunshot wound with a band-aid.
It doesn't fix the underlying issue.
Exactly. It doesn't solve the structural problem. European citizens and global capital prefer holding a digital US dollar over holding euros in a traditional bank account.
Which brings us to an incredibly provocative part of his argument regarding the intrinsic value of these currencies.
Oh, yeah.
Cava uses some very strong, very colorful Spanish to describe this. He calls physical fiat currencies, physical dollars, physical euros, and even the proposed digital euros, he calls all of them basura pura, pure trash.
It is a remarkable paradox he sets up. He calls fiat currency pure trash, but he is simultaneously arguing that the digital dollar is decisively winning the global war.
So he prefers one type of trash over the other.
Pretty much.
How does he justify that? If it's all trash, why is the digital dollar dominating the euro?
It all comes down to the underlying collateral. What is the currency actually backed by? We established that stablecoins are backed by U.S. public debt.
Right.
Now, Kaba is fiercely critical of U.S. debt. Given the massive deficits and the sheer volume of money printing, he considers U.S. treasuries to also be fundamentally trash.
He is an equal opportunity cynic.
He truly is. But in his framework of global finance, U.S. public debt is the deepest, most liquid, and historically most resilient form of collateral in the world.
It's the cleanest dirty shirt.
Exactly. It is the lesser of two evils. He says he would much rather hold a digital currency backed by the entire economic and military apparatus of the United States, even with all its massive flaws, than hold a digital euro.
Why is he so opposed to the digital euro? What is it backed by in his view?
In his view, a digital euro is backed by nothing more than the promises of EU politicians and the European Central Bank.
Ah.
He specifically calls out politicians who serve what he terms the dominant elites. He lacks zero faith in the political structure of the Eurozone to manage a digital currency responsibly.
Again, we are imparting his unvarnished perspective here just to understand his economic thesis. His argument is essentially that global capital trusts American debt far more than it trusts European political cohesion.
Precisely. And this sets up his absolute favorite part of the analysis, which is a critique of the ECB that relies on pointing out pure, unadulterated hypocrisy.
The hypocrisy argument is fascinating. Let's break down the logic here.
Sure.
Lagarde goes to the finance ministers and says, private stablecoins are a threat because they pull deposits out of our commercial banks and damage our ability to lend. That logic, based on the mechanics we just walked through, is totally coherent.
Yes, it is.
But then, in the next breath, the ECB says their solution is to launch their own official central bank-issued digital euro.
This is where Kaba points out the massive contradiction. If you are a European citizen and you move your money from a commercial bank deposit into an official ECB digital euro wallet, what happens to that money?
It still leaves the commercial bank.
Exactly. The mechanism is identical. Whether you buy a private stablecoin or an official digital euro, that capital still drains out of the traditional banking system.
It still empties the vaults of local banks.
Yes. It still damages financial intermediation. It still drives up the cost of loans for the average citizen.
So if I'm understanding Kava's logic correctly, the ECB isn't actually trying to stop the structural damage to commercial banks.
No, not at all.
They are just complaining that private American companies are stealing their business model. They want a monopoly on the deposit drain.
What you're doing is dangerous, but when we do it, it's innovation.
Wow.
Kava views this as a desperate power grab by an institution that realizes it is losing control. And he strongly predicts the digital euro will fail, pointing to historical precedent.
Right. He mentions the digital yuan.
Yes. China has made a massive coordinated push to implement a central bank digital currency, the digital yuan. But despite the immense power of the Chinese state, adoption has been shockingly sluggish compared to existing private payment systems like WeChat Pay or Alipay.
Because people just prefer the private options.
Exactly. People don't want a currency directly controlled and surveilled by a central bank if they have faster, more efficient private alternatives. Kava implies the ECB's digital euro is headed for the exact same fate of irrelevance.
So we have this picture of massive structural panic. Central banks are realizing they can't control the flow of capital in a borderless, digitized world.
Yeah.
They are watching the foundational plumbing of the 20th century financial system become obsolete, and their proposed solutions seem to only accelerate that obsolescence.
It is a terrifying macro environment if you are a traditional banker.
It really is. And if you are a normal person reading the financial news, you see all of this. You see existential threats to the banking system. You see headlines about inflation, trade wars, tariffs, fears of an escalating conflict with Iran.
You'd expect a bloodbath.
You would naturally expect the stock market to be reflecting this terror. You'd expect everything to crash.
But the reality of the market is doing the exact opposite.
It's defying the apocalypse. Kava pivots his analysis from the slow-moving currency war to the hyper-fast equity markets. He points out that the S&P 500, the tech-heavy NASDAQ, the Nikkei in Japan, they have all been hitting new, staggering record highs. And they are doing this while the media warns of every apocalypse imaginable.
This is where Kava's genius for understanding market mechanics really shines. Because to the intuitive, logical observer, a market hitting record highs amidst terrible macroeconomic news makes absolutely no
It
sense.
feels irrational, like the market is just completely disconnected from reality.
But to the disciplined speculator we talked about earlier, it makes perfect mechanical sense.
Exactly, because markets aren't always driven by fundamental reality. They are often driven by forced mechanics.
Right.
Kava points to a specific catalyst for a recent surge to illustrate this. It was a rumor circulating in the market about a potential early agreement between Donald Trump and the Iranian regime regarding geopolitical stability.
Okay, so a piece of potentially stabilizing geopolitical news hits the wire. It's a good rumor.
Yeah.
But how does one positive rumor translate into explosive, record-breaking market highs when the rest of the world seems to be burning?
Good question.
To understand this, we have to look under the hood at how massive hedge funds position themselves. We have to understand the mechanics of a short squeeze.
This is crucial. We need to do a deep dive into the plumbing of a short trade.
Let's do it. Let's walk the listener through it step by step.
Okay, let's imagine you manage a multi-billion-dollar hedge fund. You read the same apocalyptic headlines everyone else does.
Right, the banking threats, the tariffs, the geopolitical tension.
You logically conclude that the stock market is overvalued and is going to crash. So you decide to profit from that crash by taking a massive short position against the S&P 500.
Now, for anyone who needs a quick refresher, how exactly do you bet against a stock mechanically?
Mechanics are everything here. To short a stock, you don't actually own it. You go to a prime broker, like a massive investment bank, and you borrow shares of that stock.
Okay.
You immediately sell those borrowed shares on the open market at the current high price, say $100. Your goal is to wait for the price to drop to, say, $80.
So you want it to tank.
Right. When it drops, you buy the shares back at the cheaper price, return the borrowed shares to your broker, and you pocket the $20 difference as profit.
It's a brilliant strategy if you're right, but your entire premise relies on the price going down.
Yes.
And here's where Kava makes his point. It wasn't just one hedge fund doing this. A massive, disproportionate number of American hedge funds were heavily shorting the market.
They were all crowded on the exact same side of the boat, betting heavily on the apocalypse.
And this creates a massive vulnerability in the market plumbing. Because what happens when you are short a stock at $100, and instead of dropping, the price goes up to $110?
You are losing money. And theoretically, your losses are infinite because the stock price can keep going up forever.
Exactly. And your prime broker knows this. If the price goes up too much, your broker gets nervous that you won't be able to buy the shares back.
So they step in.
Right. They issue a margin call. They tap you on the shoulder and say, put more cash in your account to prove you can handle this loss, or we will force you to close your position right now.
Okay, so the hedge funds are highly leveraged, massively short, and sweating bullets. And then the rumor hits. The geopolitical news about Iran.
The news hits the wire. It's perceived as slightly positive. Normal investors see it and buy a little bit of stock. The market ticks upward, just a fraction.
But for a hedge fund that is massively short and heavily leveraged, that small upward tick is incredibly painful.
Yeah, they start getting margin calls. They realize the apocalypse isn't happening today. So what is the mechanical action they are forced to take to stop their bleeding?
To stop the bleeding, you have to cancel or cover your short position. And how do you mechanically cover a short?
You have to buy the asset back.
Yes, you are mechanically, desperately forced to become a buyer.
It makes me think of trying to hold a massive inflated beach ball underwater.
That is the perfect visualization. The hedge funds are pushing the market down with the sheer weight of their massive short positions, holding that beach ball deep underwater. But the moment a bit of good news hits and the market ticks up, their arms get tired, they get margin called. They start to lose their grip.
And when they lose their grip, the beach ball doesn't just casually float to the surface.
Yeah.
The pressure is too great, it rockets violently out of the water.
Because their forced buying creates a chain reaction.
Exactly. Let's trace the chain reaction. Hedge fund A gets squeezed, panics and buys a massive block of shares to cover their short.
Right.
That massive buy order pushes the price of the stock up even higher. Now, because the price is higher, hedge fund B, who is also short, gets a margin call.
So they panic too.
They panic and buy to cover their short, which pushes the price up even higher, triggering hedge fund C.
It is a domino effect of pure panic and force mechanics.
It is a violent cascade of buying that has absolutely nothing to do with the fundamental value of the companies in the index. The companies didn't suddenly become 10% more profitable overnight.
No, of course not.
The market didn't suddenly decide the economy was booming. It is simply the mechanical plumbing of the market, clearing out offsides, heavily leveraged, pessimistic positioning.
The market isn't necessarily optimistic, it's just violently correcting the overconfidence of the pessimists.
Yeah, that's a great way to summarize it.
It completely reframes how you look at a record high. It's not a celebration, it's an execution of shorts.
That is exactly how a disciplined speculator views it. They don't buy into the media narrative of a booming economy. They look at the positioning data.
But according to Kava's analysis, this relentless, mechanically driven upward momentum is about to hit a very specific structural roadblock.
Yeah, things are about to change.
He shifts from explaining the recent past, making a very firm prediction about the near future, and he circles a specific date on the calendar, June 12th.
Yes. He points to the anticipated stock market debut, the initial public offering of SpaceX.
Now, intuitively, this seems contradictory to the average person. SpaceX is arguably one of the most successful, visionary, technologically advanced companies on the planet.
Absolutely.
They are landing reusable rockets, they are building satellite internets. You would naturally think that a company of that magnitude going public would be a massive cause for celebration in the market.
It should bring excitement and capital.
Right. But Kava predicts the exact opposite. He says the SpaceX IPO will act as a shockwave that causes a sharp, brusque market drop.
And once again, Kava ignores the compelling narrative of space exploration and focuses entirely on the cold, hard mechanics of how large blocks of stock are integrated into the financial system.
So why would a great company hurt the market?
He gives two very specific, deeply structural reasons.
Let's unpack the mechanics of this drop. Reason number one, the lack of a lockup period.
We'll understand why this matters. We have to look at how a traditional IPO works. Usually, when a company goes public, the insiders, the founders, the venture capitalists, the early employees who have been paid in stock options are subject to a legally binding lockup period.
Which means what, exactly?
They are prohibited from selling their shares on the open market for a set period, usually 6 months.
Which makes sense. You do that to prevent a flood of supply from hitting the market on day one and crashing the price of the newly listed stock. It stabilizes the debut.
Exactly. It creates an artificial scarcity of shares. But Kava notes that for this highly anticipated SpaceX liquidity event, there is an understanding that there will be no lockup period for many insiders.
Why would they do that? Why bypass standard procedure?
Because of the maturity and size of the company. SpaceX has been private for over 2 decades.
Oh, wow. That's a long time.
Right. There are early employees and investors who have massive paper wealth tied up in this company, and they have been waiting a very long time for a liquidity event to cash out and buy a house or retire. If the structure allows it, they're going to sell immediately.
Meaning on June 12th, or whenever the exact date of integration hits, anyone on the inside who wants to hit the sell button can.
Yes. And this creates what Kava calls massive paper pressure. It is an immediate, heavy wave of selling hitting the market.
So supply drastically outweighs demand, creating a downward drag on the stock price.
Correct. But that is only the first reason, and frankly, it's the smaller one.
There's more.
The second reason he gives is far more systemic, and it has to do with the mechanical, unthinking nature of index funds.
The index rebalancing, this is the part of the analysis that completely blew my mind because it exposes how blindly robotic the stock market has become.
It really does. Think about the massive passive investment industry. Millions of people, probably including many listening right now, have their retirement accounts automatically invested in passive index funds, like those tracking the S&P 500 or the NASDAQ 100.
And a passive fund doesn't have a manager picking good stocks and avoiding bad ones. It just blindly buys every single company in the index.
Exactly. But it doesn't buy them in equal amounts. It buys them based on their weighting, which is usually determined by their market capitalization, their total size.
Okay, so a bigger company gets a bigger price.
Exactly. Apple is massive, so it makes up a huge percentage of the index. A smaller regional bank makes up a tiny fraction of a percent. The index fund's only job is to mathematically mirror those exact proportions.
It's like a bartender making a massive cocktail. The recipe strictly calls for 10% Apple, 8% Microsoft, and 5% Amazon. The fund has to follow the recipe perfectly.
That's a great way to put it. Now enter SpaceX. SpaceX is a behemoth of a company. When it goes public and is deemed eligible to be incorporated into these major indices, it is going to command an elevated weighting. It isn't going to be a drop in the bucket. It's going to take up a significant percentage of the index.
It demands a large space in the cocktail recipe.
Right. Up here is the mechanical friction. Passive index funds do not have unlimited cash sitting around. They are fully invested.
Oh, I see where this is going.
So if the index provider suddenly dictates SpaceX is now 3% of the index, the passive funds are mathematically forced to immediately buy billions of dollars worth of SpaceX stock to match that 3% weighting.
But if they have no cash, where do they get the billions of dollars to buy SpaceX?
They are forced to sell. To make room for the 3% weighting of SpaceX, they have to blindly mechanically sell 3% of their holdings in Apple, Microsoft, Amazon, Nvidia, and every other company in the index.
That is wild. They aren't selling Apple because Apple had a bad earnings report. They aren't selling Microsoft because they think AI is a bubble. They're selling them purely because they need to free up cash to follow the new recipe.
Exactly. It creates a mechanical wave of selling pressure across the entire broader market. The largest, most stable companies in the world will face downward pressure simply to accommodate the sheer mass of SpaceX entering the ecosystem.
So, if we know this is coming, if Kava can see this mechanical roadblock approaching on June 12th, then surely the massive institutional players, the hedge funds, and the investment banks can see it too.
They definitely see it.
How did the professionals react when they know a tidal wave of forced selling is about to hit the market?
They don't just sit there and absorb the losses. They are professionals. Their job is to protect their portfolios.
Yeah.
So they proactively cover themselves in advance.
They build defensive positions.
Yes. And Kava lists the specific derivative tools they use to do this.
Let's go through the toolbox. How does a billionaire fund manager prepare for June 12th?
The primary tool is the options market. They buy puts.
Explain a put option for the listener who might not trade derivatives.
Think of a put option like an insurance policy on your house. You pay a small premium up front. If your house burns down, or in this case, if the stock market crashes, the insurance policy pays out a massive sum, offsetting the loss of your home's value.
Makes sense.
Fund managers buy millions of dollars in put options on the broader indices. If the forced selling of the SpaceX IPO drags the market down, their stock portfolios will lose value, but their put options will explode in value, balancing them out.
Okay, so they buy puts. What else?
They also sell calls. A call option is a bet that the market will go up.
So selling them is the opposite.
Right. By selling calls, they're essentially taking the other side of that bet, collecting a premium from overly optimistic retail traders, and capping their own upside while providing a cushion against a drop.
Smart.
Furthermore, they sell futures contracts, locking in current prices before the anticipated drop. And finally, Kava notes they buy futures on the VIX.
The VIX, that's the volatility index, right? Often called the fear gauge.
Yes. The VIX measures how violently the market expects prices to swing in the near future. It usually spikes when the market drops rapidly.
Right.
So by buying futures on the VIX, institutions are literally placing a bet that fear and chaos are about to increase.
This sounds incredibly sophisticated, but it also sounds like a self-fulfilling prophecy. If all the massive institutions are actively buying insurance against a crash and selling futures and betting on fear, doesn't that very positioning create a downward drag on the market before SpaceX even debuts?
It absolutely does. The mechanics of the options market dictate that when institutions buy massive amounts of puts, the market makers who sell them those puts have to hedge their own risk.
How do they do that?
By selling the underlying stocks.
Hmm.
So the mere act of institutions preparing for a drop mechanically initiates the drop. It is a perfect storm of market plumbing.
So Kava predicts the storm will hit, and it will cause a brusque, painful drop in the markets. But here is the crucial distinction he makes, and it brings us back to the psychology of the speculator.
This is a vital distinction.
Kava differentiates between a market correction and a market ceiling.
Yes, and understanding this difference is what separates the amateur who panics from the professional who profits.
Right.
A market ceiling implies a fundamental long-term shift. It implies the bull market is dead, the economy is broken, and we are entering a multi-year bearish trend where assets will lose value for a decade.
But a correction is different.
A correction is a sharp, violent, but ultimately temporary drop. It is the market clearing out excesses, resetting its plumbing, and digesting a massive event like the SpaceX index rebalancing.
And Carver firmly believes the SpaceX IPO will trigger a correction, not a permanent ceiling.
Right. He warns that the drop will be sharp enough to terrify retail investors.
Mhm.
It will give the powerful illusion of a long-term bearish trend.
Especially with all the other bad news floating around.
Exactly. This illusion will be especially convincing if, coincidentally, inflation data comes in hot and interest rates rise at the same time.
Mm.
The financial media will scream that the sky is falling.
But the reality is different.
Yes, because Kava looks at historical precedent. He notes that massive IPOs fundamentally rarely trigger permanent market ceilings. The underlying companies in the S&P 500 will still be generating billions in profit.
The only exception he noted was the year 2021, right?
Yes, he points out 2021 as an anomaly, but that was driven by unique pandemic-era excesses, zero interest rates, and a complete detachment from valuation fundamentals.
A completely different environment.
Entirely. In a normal environment, the mechanical selling of an IPO is eventually absorbed by the immense liquidity of the market. The index funds finish their forced rebalancing, the selling pressure exhausts itself, and the market stabilizes.
So let's bring this all the way back to the beginning. Let's return to the speculator sitting at their desk in Madrid.
The one who's survived the daily reset.
Exactly. The one who has abandoned the illusion of the treasure map. The one who has mathematically structured their risk so they never take a 20% loss. The one who has neurologically trained themselves to stare at a red screen without their amygdala hijacking their brain. For that disciplined speculator, this terrifying, mechanically driven drop on June 12th isn't a reason to despair, is it?
Not at all. For the disciplined speculator who understands the macro plumbing we just discussed, a mechanical drop driven by forced index rebalancing and institutional hedging is exactly the kind of dislocation they patiently wait for.
It isn't a crisis, it's a buying opportunity.
Exactly. While the amateurs are panicking because they're watching their portfolios drop and listening to apocalyptic media narratives, the true speculator understands why it's dropping.
Because they see the mechanics?
Right. They know it's force mechanics rather than a fundamental economic collapse. So they sit patiently, they manage their risk, they wait for the selling pressure to exhaust itself, and they execute their system to capitalize on the fear of others.
That is profound. It brings this entire massive analysis full circle in such a deeply satisfying way.
It really does. Because it all comes down to understanding the invisible architecture beneath the surface of the news.
Let's briefly retrace the staggering amount of ground we've covered today, because Kava's truths of the boatman really do weave together into a cohesive worldview.
It's quite the journey.
We started with the harsh reality of the individual trader, the illusion that technical indicators are a cheat code, and the reality that trading requires an adaptable, deeply internalized system where survival strict risk management is the only true goal.
Yeah, that emotional scaling problem is the first massive filter.
We explored that neurological barrier, proving that mastering your own fear is just as important as mastering the math.
And from the micro, we zoomed out to the macro environment that the speculator operates within. We saw a global banking system facing a slow, existential threat.
The stablecoins.
Right. We walked step by step through how stablecoins, acting as digital dollars backed by U.S. debt, are silently but steadily draining deposits out of European banks.
Which threatens lending.
It threatens the core economic function of lending, driving up borrowing costs and forcing central banks like the ECB into a state of hypocritical panic as they try to launch their own digital currencies to monopolize the very deposit drain they claim to fear.
And finally, we brought it back to the cold, hard mechanics of the equity markets. We saw how seemingly irrational market highs are often just the explosive beach ball underwater result of highly leveraged hedge funds getting caught on the wrong side of a short squeeze.
Forced to buy by the unforgiving math of margin calls.
Exactly. And we looked ahead to June 12th, exploring how the massive SpaceX IPO will force a wave of blind mechanical selling through passive index funds.
Creating that sharp drop.
A drop that will terrify the unprepared public, but offer a highly calculated opportunity for the disciplined few who actually understand the plumbing.
It is a masterful look at how rigid systems, whether they are the biological systems of human fear, the fractional reserve systems of a commercial bank, or the algorithmic weighting systems of an index fund, actually govern the outcomes of the financial world, entirely regardless of the narratives we try to spin around them.
It is. And as we wrap up this deep dive, I can't help but go back to Kava's blunt, unapologetic phrasing regarding fiat currency.
The trash comment.
Yes, cold coins are pure trash. It is such a perfect encapsulation of his unvarnished, unsentimental approach to stripping away the comforting illusions of finance.
He demands that you look at the underlying collateral, the underlying math, and the underlying reality, no matter how uncomfortable the boat ride gets.
And that leaves us with a final, provocative thought for you to mull over as you go about your day. We spent all this time dissecting how the massive titans of the financial world, the multi-billion-dollar hedge funds, the passive index behemoths, even the central banks themselves, are often mechanically forced into their actions.
They really are.
They are forced to buy during a short squeeze. They are forced to blindly sell Apple to make room for SpaceX. They are forced to react to digital deposit flights. If the supposed giants of the game are constrained by these rigid, predictable mechanics,
Yeah.
is it possible that the small, solitary, deeply disciplined speculator, the one who has truly mastered their own emotions and risk, actually holds a tactical advantage of agility over the very institutions that supposedly run the world?
It's a fascinating inversion of power. The freedom of being small and adaptable versus the burden of being massive and mechanically bound.
Something to think about the next time you look at a stock chart or check your bank account or see a headline predicting the end of the world. Thank you so much for joining us on this deep dive. Keep questioning the consensus, keep looking beneath the surface narratives, and never stop exploring the hidden mechanics of the world around you. We'll see you next time. Imagine a really brilliant financial analyst.
Okay.
He's out on this beautiful morning stroll in Madrid. The sun is shining, the air is crisp, and he tells us he's just getting ready to sit down for a cold beer, a little cañita, just to enjoy the spectacular spring weather.
Sounds idyllic, honestly.
Right. But then he just stops. He looks directly into the camera, and his tone shifts from this casual warmth to something entirely chilling, and he says, "What I'm about to tell you is not a wickedness. It is something much worse."
Yeah, it is an incredibly jarring opening. I mean, you're lulled into the sense of European leisure, and suddenly, boom, you are staring down the barrel of a meticulously calculated destruction of retail wealth.
Exactly. So today, we are pulling apart a deeply provocative thesis by that very analyst, Jose Luis Cava. We're going to look at the terrifyingly calm, deliberate, and engineered sinking of the S&P 500 and the NASDAQ.
It's a heavy topic.
It is. And to you listening, whether you are managing a modest 401k or you're actively trading tech stocks, or maybe you're just fascinated by the sheer, unadulterated power dynamics of global capitalism, well, this is a deep dive you cannot afford to miss. We are getting inside the minds of the strong hands.
Right, and that distinction, the strong hands versus the weak hands,
Yeah.
that is the absolute foundation of everything we're going to explore today.
We hear those terms a lot, but let's define them.
Sure. So the strong hands are the colossal institutional powerhouses. I mean, the market makers, the sovereign wealth funds, the algorithmic titans who don't just react to the market. They literally create the weather.
They make it rain or they bring the drought.
Exactly.
And the weak hands, that's the everyday retail investor. It's the person reading earnings reports, looking at profit margins, trying to make rational decisions based on the actual health of the company.
Which, ironically, is their fundamental vulnerability.
Yeah.
The weak hands assume the market is a rational mechanism for pricing assets.
It's supposed to be, right?
In theory. But the strong hands, they view the market as a psychological battlefield. Their primary objective is to force the weak hands into absolute terrified capitulation. They want you to throw in the towel at the absolute worst possible moment.
Okay, let's unpack this. Because, you're making this sound like a Bond villain pressing a red button in a volcano lair.
I know it sounds dramatic.
It does. The market is made up of millions of independent actors, algorithms, institutions. You're telling me this isn't just natural market physics, but a coordinated, deliberate attack. How do you even distinguish between natural volatility and this supposed manipulation?
That's a critical distinction to make. We aren't talking about a smoky back room where a dozen guys in suits agree to crash the market.
Because that would be highly illegal.
Highly illegal, and frankly, it's entirely unnecessary. The strong hands don't need a group chat to coordinate. They rely on shared quantitative risk models, highly predictable statistical distributions, and a deep, deep understanding of market microstructure.
Okay, so how do they actually do it?
They manipulate the market, not by pushing it down, but by deliberately stepping away.
So they create a vacuum.
Precisely. In modern markets, liquidity is provided by algorithms, When the institutional powerhouses simultaneously recalibrate their buy-side algorithms to, just step back from the order books, the market suddenly enters a void.
Wow.
Yeah. So the slightest bit of retail selling, say on a slightly bad news day, it triggers a cascading drop because there is literally no institutional net to catch the falling knife. They just let the market free fall until it hits their exact calculated target.
And the source material argues that there is a very specific catalyst that prompts the strong hands to initiate this vacuum, a trigger that sets this entire sweeping maneuver into motion. And it's tied directly to the Federal Reserve.
Yeah, according to Kava's historical analysis, the trigger is an institutional ritual, the inauguration of a new Federal Reserve chairman.
A hazing ritual for central bankers.
Pretty much. The markets don't just welcome a new Fed chair with a polite round of applause, they stress test them.
Which brings us to the immediate relevance of this entire discussion. Kevin Warsh just took the oath of office at the White House last Friday. He is the brand new Fed chair.
Right. And we are currently inside the historical 1 to 2 month window where that stress test occurs. The market wants to see the new chairman's pain threshold.
Like how much heat he can take.
Exactly. If the market starts violently plunging, will Warsh panic? Will he instantly inject liquidity and lower rates? Or will he stand firm and let the system burn a little? The strong hands need to map his psychological profile because at the end of the day, he is the guy controlling the money printer.
But let's look at the actual mathematics of this test, because this is where the source makes a fascinating analytical pivot.
The numbers are wild.
Right. Historically, when a new Fed chair takes over, the resulting engineered market drop averages out to a 12% decline in the S&P 500. A 12% drop is a massive event. It erases trillions in value.
Huge.
But Kava deliberately discards that 12% mean and instead points us to the median, which is an 8% drop.
And that choice to focus on the median rather than the mean is what separates amateur analysis from institutional reality.
I have to challenge this, though. Is taking the median just a convenient way to cherry-pick a number that fits his current 2026 narrative? I mean, 12% is a much scarier headline. Why ignore the average? If we're looking at a historical data set, shouldn't we consider the whole picture?
Well, we are considering the whole picture by looking at the statistical distribution of the data.
Eh.
If you look at the history of these Federal Reserve transition tests, the data is incredibly noisy.
Noisy how?
You have left-tail events, like extreme outliers. There are times the market only drops 2%.
Yeah.
But then you have historical anomalies where the market has plunged by practically 33%.
Wow. A 33% drop is not a test. That is an apocalyptic generational wealth wipeout.
And that is exactly the point. When you have an extreme multi-standard deviation outlier, like a 33% crash, pulling the mathematical average upward, the mean becomes distorted. It no longer represents the typical calculated behavior of the market. It represents an average heavily skewed by chaos.
Ah, I see.
Yeah, in a data set with massive extremes, the median is the true center of gravity. It represents the highest probability outcome.
So the 8% target isn't him downplaying the risk. It's him identifying the surgical strike zone.
It is the calculated threshold. For the perspective of the institutional powerhouses, a 33% drop is a disaster for them, too. It risks breaking the entire financial plumbing, triggering cascading counterparty defaults, and just causing uncontrollable macroeconomic chaos. They absolutely do not want a systemic collapse.
They want a controlled demolition.
A controlled demolition of retail confidence. The 8% median represents the minimum viable panic.
Minimum viable panic. That's a terrifying phrase.
It's accurate, though. It is deep enough to trigger the automatic stop-loss orders of retail investors. It's severe enough to generate terrifying, blood-red headlines across the financial media. But it's shallow enough that the strong hands maintain total control over the ultimate recovery.
So they engineer an 8% drop, the weak hands panic and sell their shares at a loss, and the strong hands swoop in, turn their buy algorithms back on, and just absorb all those discounted assets.
That is the mechanical reality of the transition test. But to truly grasp how this is going to play out for Kevin Warsh right now, the source insists we have to examine the architecture of past crashes. We have to look at the most famous historical example of a new Fed chair being tested.
Okay, 1987. Alan Greenspan takes office, and 2 months later, the market completely breaks.
Black Monday, October 19th, 1987. A 22.6% drop in the Dow Jones in a single trading session. But what is critical here isn't just the size of the drop, it is the specific mechanism of failure. Kava lived through this, And he emphasizes that this wasn't just a day where selling pressure outweighed buying pressure. It was a day where liquidity ceased to exist.
Let's break down that mechanism. Because liquidity drying up is a phrase that gets tossed around on financial television constantly, but it often sounds abstract. How does a market literally stop functioning?
Think about liquidity like a modern automated matchmaking app. In a functioning market, you swipe right to sell 100 shares of IBM, and the algorithm instantly matches you with a buyer who swiped right at your price. The market makers act as the server, ensuring millions of these matches happen smoothly every second.
But on Black Monday, what happened to the server?
Imagine logging into that matchmaking app, and suddenly, every single other user deletes their profile the exact same second.
Oh.
You are frantically swiping to sell, offering lower and lower prices, but the algorithm is just returning a blank screen. The counterparties didn't just disagree on the price, they vanished from the digital order book entirely. Market makers physically stopped answering their phones on the exchange floor.
Why? What caused them to unplug the servers, so to speak?
It was driven by an early form of algorithmic trading called portfolio insurance. It was a primitive hedging strategy utilized by massive institutional funds.
So it was just code running wild.
Basically, the computer models were programmed for the simple, brutal logic. If the stock market drops by X%, automatically sell futures contracts to hedge against further losses.
A doom loop.
An absolute doom loop. The market dropped slightly, which triggered the portfolio insurance algorithms to automatically sell. That massive wave of automated selling pushed the market down further, which triggered more algorithms to sell.
And the humans.
The human market makers saw this mechanical tsunami coming, realized they didn't have enough capital to catch the falling knives, and they simply stepped away. They refused to provide quotes.
So if I'm a retail investor in 1987, I can't even lock in my losses. I literally cannot get rid of my assets at any price because the entire counterparty system has evaporated.
It is the purest manifestation of financial terror. And this is the environment Alan Greenspan inherited. He had been in the job for 8 weeks.
8 weeks?
Yeah. The market is in total freefall, liquidity is gone, and the entire global financial system is staring into the abyss.
This is the ultimate stress test. What does the new guy do?
He fundamentally alters the role of the central bank. On October 20th, the very next morning, Greenspan issues a terse, one-sentence statement. He essentially announces that the Federal Reserve will serve as the source of liquidity to support the economic and financial system.
So he manually turned the matchmaking servers back on.
More than that, he forced the participants back to the table. The Fed aggressively bought government bonds, pushing cash into the banking system. They get on the phones with the major banks and heavily pressured them to keep extending credit to the brokers and market makers.
Twisting arms.
Big time. Greenspan essentially guaranteed that the financial plumbing would not freeze.
And the strong hands see this. They see the Federal Reserve publicly backstopping the system.
Exactly. They see the floor being established, the vacuum has been filled,
Yeah.
and once that floor is in place, what do the strong hands do? They unleash their capital and start scooping up the massively discounted blue-chip assets that the panicked retail investors had just desperately thrown away.
So that is the 1987 scenario, a sudden, violent, algorithmic liquidity failure, followed by a swift, massive rescue from a brand new Fed chair. But if we follow the logic of the source material, Kava immediately pivots to contrast this with another catastrophic event, the bursting of the dot-com bubble in the year 2000.
And this transition is crucial because the year 2000 presents a totally different macroeconomic puzzle. By 2000, Alan Greenspan is no longer the new guy being tested. He is the established maestro.
Right.
And the problem isn't a sudden lack of liquidity. The problem is an absolute gluttony of it.
Yeah, the Nasdaq had gone completely parabolic. You have companies with zero revenue, no business model other than adding .com to their name, and they are commanding multi-billion-dollar valuations. Greenspan famously labels this irrational exuberance.
And to combat that exuberance, Greenspan doesn't wait for a market failure. He initiates the pain.
He pops the bubble himself.
Deliberately. He methodically begins raising interest rates, actively contracting the massive liquidity pool that he had been essentially pumping into the system for a decade.
And the resulting crash looks nothing like Black Monday.
It is the polar opposite in terms of market physics. 1987 was a sudden single-day heart attack, The crash of 2000 was a slow, agonizing bleed. The liquidity wasn't sucked out in an afternoon. It was drained away drop by drop over the course of 2 excruciating years, from early 2000 until roughly late 2002.
You know, it's funny. If 1987 is a crowded theater where someone pulls the fire alarm, causing a terrifying instant stampede toward a locked exit, then the year 2000 is like being locked in a room where someone is turning up the thermostat by 1 degree every hour.
That's a great analogy.
At first, you don't even realize you are cooking. You think it's just a warm afternoon, you take off your jacket, but eventually the heat becomes so oppressive, so inescapable, that you eventually just pass out.
That is a phenomenal way to understand the retail psychology of the dot-com crash.
Mm-hmm.
The everyday investors kept holding on. The market would drop 10% and they would buy the dip, assuming the tech revolution was just taking a breather.
Because that's what they had been trained to do.
Exactly. But the structural liquidity was gone. The strong hands had already exited. The retail investors were just trading the remaining shares among themselves in a room that was slowly running out of oxygen until the Nasdaq had collapsed by nearly 80%.
An 80% wipeout over 2 years. It's almost unfathomable. So we have established two completely different crises. 1987 is an accidental, sudden death liquidity vacuum caused by primitive algorithms. 2000 is a deliberate, slow-motion strangulation initiated by central bank policy. If I read any standard economic history textbook, they are treated as two distinct phenomena.
What's fascinating here is there's a deeper connection.
Let's hear it.
What's fascinating is Kava's true revelation. He argues that the macro causes of these crashes are ultimately irrelevant. If you look past the headlines and study the actual price charts, the behavior of the strong hands, the market caretakers, was mathematically identical in both scenarios.
I need you to reconcile that for me. How can a one-day 20% crash and a 2-year 80% bleed represent identical institutional behavior?
You have to look at the destination. Where did the strong hands finally decide to arrest the fall? Where did they re-enter the market and establish the absolute bottom?
Okay, where was it?
In 1987, after the violent drop, the market didn't just stabilize at a random technical support level. The caretakers allowed it to fall precisely to the lows established in the previous year, 1986.
How? Think about the psychological impact of that. By deliberately guiding the floor down to the 1986 lows, they are methodically erasing every single cent of profit made by anyone who entered the market over the last 12 months.
It is a targeted, engineered sweep. The objective is to sweep out everyone who had enthusiastically bought during the prior year's momentum run.
The latecomers.
Right. If you were a retail investor who finally got off the sidelines and bought into the hype in late 1986 or early 1987, that specific floor pushed your entire portfolio deep into the red. It broke your spirit, terrified you, and forced you to capitulate.
They clear the board of all the latecomers. They punish the people who chase the trend.
Exactly. Now, apply that same forensic lens to the year 2000. It was a slow 2-year bleed, but the destination was calculated with the exact same ruthless logic. The strong hands allowed the Nasdaq to bleed out, absorbing retail selling along the way until the index hit the 1,000 level.
Let me guess, the 1,000 level wasn't just a round number.
It was the exact price level the Nasdaq was trading at in 1998, right before the massive, euphoric waves of dot-com exuberance truly decoupled from reality.
Unbelievable.
Just like in 1987, the caretakers swept the market completely clean of everyone who had jumped on the bandwagon during the final irrational stage of the bull market. They bar the latecomers from participating in the eventual recovery until they've accumulated their shares at the absolute bottom.
But wait, if panic and sudden liquidity loss caused 1987, why did the exact same sweeping maneuver happen in 2000 when there was no sudden panic? How do strong hands achieve the exact same structural result in a totally different macro environment?
Because the mechanics of order flow allow for it. Whether the market is crashing in a day or bleeding over 2 years, the strong hands control the major support levels through the density of their buy orders.
Meaning they just wait at the bottom with a giant net.
Yeah. In 2000, they simply positioned their massive accumulation algorithms at the 1,000 level. They let the market slowly fall through empty space, offering no resistance, until the price hit their 1998 target. Once it hit that psychological floor, their algorithms kicked in, absorbed the final wave of retail despair, and the sweep was complete.
It is a chillingly methodical process. The catalyst doesn't matter. The destination is always a return to the origin of the last wave of optimism. Which leads to a massive question. 1987 and 2000, I mean, we're talking about the era of fax machines, dial-up internet, physical trading pits. We are now in an era of global, decentralized liquidity, zero-day options trading, entirely new digital asset classes. Can the strong hands still execute this vintage sweeping playbook in a modern, hyper-financialized world?
The microstructure of the market has evolved, but human psychology, that predictable interplay of fear and greed, it has not changed one iota.
Hmm.
And because of the transparency of modern data, this sweeping strategy is actually easier to execute today than it was in 1987.
Really?
Oh, absolutely. The source pointed the most modern, hyper-speculative asset on Earth to prove it, Bitcoin.
Bitcoin, the ultimate barometer of pure retail speculation and momentum trading. I mean, there are no earnings reports for Bitcoin. It is entirely driven by sentiment, adoption narratives, and liquidity.
Which makes it the perfect laboratory for the strong hands. Kava highlights a very specific technical maneuver executed in the Bitcoin market beginning in October 2025.
Walk me through the mechanics of this, because the crypto market operates differently than traditional equities.
It operates 247, and crucially, its ledger and order books are highly transparent. The massive institutional players, the whales as they call them, they can use on-chain analytics to see exactly where retail investors are positioning themselves.
So they can see everyone's cards.
Pretty much. They can see where the leverage is building up, and they can see exactly where the retail stop-loss orders are clustered.
So they have an x-ray of the weak hands pain points.
Precisely. In early 2025, there was a massive wave of retail euphoria that drove Bitcoin up to the $74,000 mark in April. A massive influx of weak hands jumped in at the top, terrified of missing out on the next paradigm shift.
The classic FOMO trade. Fear of missing out.
The whales let them buy. They let the leverage build. And then in October 2025, the strong hands initiated the sweep. They didn't just passively sell, they aggressively dumped spot Bitcoin onto the market, specifically targeting the price levels where they knew retail stop losses were sitting.
Triggering a cascading liquidation event.
Exactly. When the price hits a cluster of stop losses, those automated sell orders execute, pushing the price down further, which triggers the next cluster of stop losses. The strong hands essentially push the first domino, and the mechanics of the market do the rest.
And where did this engineered cascade finally stop? Where did the whales place their massive buy orders to catch the bottom?
Well, let's look at the chart.
Wait, I bet it retraced perfectly. It swept all the way back down to wipe out the exact entry point of the April 2025 surge.
Spot on. They erased the entire $74,000 narrative. They expelled the April buyers from the market. The source uses that word deliberately. Expelled. They shake the tree, trigger the automated liquidations, force the remaining weak hands to sell at a loss in pure panic, and the whales accumulate the coins at a massive discount.
Here's where it gets really interesting. Because the crypto market is famously the Wild West, we expect that kind of predatory whale behavior there. But the source claims this exact same targeted sweeping maneuver is actively happening in the highly regulated traditional equity markets right now.
It absolutely is. The blueprint is entirely asset agnostic. Kava details identical patterns in the S&P 500 and the NASDAQ occurring in April 2025, and again just recently in March 2026.
Break down the mechanics of those specific drops, because dropping the entire S&P 500 requires significantly more capital and coordination than pushing around the crypto order books.
It does, which is why it requires the coordination of macroeconomic narratives. In both April 2025 and March 2026, we saw sudden, sharp drops in the major indices, but these weren't random pullbacks.
They never are they?
Not at this level. If you map the geometry of those drops, they found their ultimate floor at the precise origin point of the previous upward momentum wave.
Think about your own 401k right now. Put yourself in that scenario. You watch the market climb steadily for 6 months. You finally feel confident enough to deploy some of your savings into an index fund. You log in a month later, and not only has the market dropped, but it has retraced perfectly to the exact point where the rally started half a year ago.
Wiping out everything.
Wiping out months of broader market gains, but more importantly, putting your specific investment instantly into the red. What is your gut reaction? That sickness in your stomach, that realization that you are exactly wrong.
That sickness is the objective. That psychological leverage is what the strong hands are harvesting. They're trying to manufacture the feeling that your entire investment hypothesis was fundamentally flawed.
It's psychological warfare. It is designed to make you feel stupid.
It is designed to induce capitulation. And consider how this psychological pressure is amplified by the broader ecosystem. The strong hands don't operate in a vacuum. They rely on the financial media and the central banks to provide the soundtrack of fear.
Right, because when the market starts violently sweeping downward, the headlines aren't saying, oh, institutional algorithms are returning to the origin of the last wave to accumulate cheap shares. The headlines are screaming about impending recession, geopolitical collapse, or inflationary spirals.
And often, the Federal Reserve unwittingly plays the role of the ultimate amplifier. When the central bank officials start taking the podium, expressing deep concern over sudden market volatility, hinting at emergency meetings, well, it validates the panic of the weak hands.
Yeah, if the chairman of the Federal Reserve looks terrified, the retail investor assumes the world is ending.
And the moment that retail investor logs into their brokerage account, stares at the sea of red, and hits the sell all button just to make the emotional pain stop, the trap snaps shut.
The weak hands surrender their assets at the exact mathematical floor. And precisely at that moment of maximum despair, the liquidity miraculously returns. The strong hands turn their accumulation algorithms back on, absorb all the discounted shares, and the market begins its inevitable recovery.
It is a brutal transfer of wealth from the impatient to the patient, from the emotionally driven to the mathematically disciplined.
And that brings us to the most urgent part of Kava's thesis. This isn't just a historical postmortem. This is a predictive model. If we accept this framework, that the market is a carefully managed ecosystem where the caretakers initiate calculated median percentage drops to shake out recent buyers, then what is the master plan for right now?
Exactly. Kevin Warsh is in the big chair. The transition window is wide open.
So what exactly are the strong hands orchestrating for the S&P 500 and the Nasdaq in the immediate future?
Kava shifts here from historical macro analysis to highly specific quantitative forecasting. He analyzes the current order book structure and technical charts for the S&P 500, and he identifies a massive block of institutional resistance.
Resistance meaning a ceiling of limit sell orders that the market simply cannot chew through.
Correct. Currently, the S&P 500 is banging its head against major resistance in the 7,500 to 7,550 zone. The retail momentum is trying to push it higher, but the strong hands have established a wall. They're not going to let the index break out to new highs yet.
Because the new Fed chair needs to be tested and the latecomers need to be swept out.
So they initiate the vacuum from that 7,500 level. They step away. And based on the historical distribution we discussed earlier, that median transition test, we are looking for a calculated drop of 8%.
If you model an 8% algorithmic decline originating from that 7,500, 7,500, and 550 resistance zone, it provides a very specific surgical target. It drags the S&P 500 down to precisely the 7,046 or 7,000 zone.
7,000. It's a nice, round, terrifying number to flash across the ticker tape.
But I know enough about this strategy now to know that 7,000 isn't just an arbitrary result of the 8% math. There is a structural, psychological reason for that specific floor.
The math and the psychology align flawlessly. The 7,000 zone is the exact starting point of the last major upward wave that began in April 2026.
History repeating in real time.
It is the identical 1987 and 2000 playbook executed on a modern timeline. By creating a liquidity vacuum and guiding the S&P 500 down to 7,000, the strong hands will systematically target and expel every single retail buyer who chased the market during the recent spring rally. They wiped the slate completely clean back to April 2026.
If I bought in May, June, or July, assuming the bull market was unstoppable, my entire position is suddenly underwater. The financial networks are running 247 coverage about Kevin Warsh failing his first stress test. I am psychologically primed to believe a multi-year bear market has just begun.
And you will capitulate. Your stop-loss orders will trigger, your emotional resolve will break, and the strong hands will be waiting at 7,000 to quietly absorb your portfolio.
That is the grim forecast for the broader S&P. Does the Nasdaq, which is heavily weighted toward high beta technology stocks, have a similar target painted on it?
The source provides a parallel forecast for the Nasdaq. But because tech stocks naturally carry higher volatility and a higher concentration of retail speculation, the required sweeping mechanism is slightly deeper. The strong hands are expected to induce a 10% drop in the Nasdaq.
A 10% algorithmic sweep, and where does that drop establish its floor?
It mathematically targets the 27,000 zone.
Let me guess. 27,000 is the exact origin point of a recent wave of retail exuberance.
It perfectly aligns with the absolute minimums established earlier this year in March 2026. It is a surgical strike designed to sweep out anyone who confidently bought the dip in the tech sector over the last several months.
So we are staring down the barrel of an engineered 8% drop in the S&P down to 7,000 and a 10% drop in the Nasdaq down to 27,000.
Hmm.
For anyone holding significant positions right now, this sounds like an incredibly bleak forecast for the remainder of 2026.
If we connect this to the bigger picture, it is actually the opposite of bleak. It is the necessary mechanical preamble to something historically explosive.
How so? Because systematically wiping out months of savings for millions of people sounds fundamentally bleak.
It is entirely bleak for the weak hands who don't understand the mechanism. But look at the ultimate conclusion of Kava's thesis. This sweeping strategy is not about permanently destroying the equity markets. The strong hands are long biased. They want the market to go up.
Right. They make money when it goes up, too.
Exactly. The sweep is about clearing the path of excess leverage and emotional capital. Kava explains that once this burrito, this systemic sweeping out of the retail investors, is complete, the market physics change instantaneously.
Because once the final panicked investor hits sell, there is literally no one left to sell.
Exactly. The order books are fundamentally cleansed. The weak hands are gone, holding cash and nursing their wounds. The strong hands have accumulated their massive target positions at the 7,000 and 27,000 levels. The downward pressure is entirely exhausted.
The vacuum is filled, the trap opens, and the algorithms flip back to accumulation mode.
And because there is no overhead retail supply left to suppress the price, the market doesn't just slowly recover. It is structurally designed to shoot up, in Kava's own words, like a rocket.
The path of least resistance is violently upward.
Precisely. And this leads to his ultimately optimistic, albeit highly Machiavellian, macro conclusion. He predicts that the year 2027 is going to be a marvel of historical wealth generation.
But the caveat is written in neon letters. It will be a marvel only for the speculators who understand the game being played. It will be a marvel only for those who survive this upcoming engineered transition sweep.
You have to possess the analytical discipline to recognize an 8% drop not as a systemic failure of the global economy, but as a temporary engineered liquidity vacuum. You have to recognize the trap being set, you have to hold your nerve, keep your hands strong, while the institutional caretakers violently shake the tree.
So what does this all mean? We've covered a tremendous amount of highly technical, deeply psychological ground today, essentially tracing the hidden architectural blueprint of market manipulation across 4 decades.
We began by demystifying the Federal Reserve transition. We looked past the headlines to the statistical reality that markets historically test new chairmen like Kevin Warsh, not with random chaos, but with a highly calculated 8% median drop.
A target chosen specifically to optimize retail panic while preserving the structural integrity of the global financial system.
Right. We analyzed the mechanical failure of 1987, where a primitive portfolio insurance algorithms created an accidental liquidity vacuum, forcing Alan Greenspan to step in and manually restart the market's matchmaking servers.
And then we contrasted that with the slow-motion, deliberate liquidity strangulation of the 2000 dot-com crash.
And we arrived at the pivotal revelation. Despite completely different macro catalysts, the strong hands executed the exact same sweeping maneuver in both eras. They allowed the market to fall precisely to the origin of the previous year's optimism, methodically wiping out the latecomers before accumulating shares at the absolute bottom.
We saw how that vintage 1987 playbook is supercharged in modern markets. From the transparent order book manipulation and targeted stop-loss hunting in Bitcoin, to the recent mathematically precise sweeps in the traditional indices.
Which brings us to the immediate, actionable reality. The quantitative forecast that the S&P 500 is currently being maneuvered away from resistance for an 8% drop down to the 7,000 zone and the Nasdaq for a 10% drop to 27,000.
A calculated, near-term demolition designed to expel the weak hands who bought in early 2026, setting the stage for a massive, frictionless rocket ship rally into a marvelous 2027. To you listening, the core takeaway from this deep dive is a fundamental rewiring of how you perceive market volatility. The next time you log into your brokerage account and see a violent, stomach-churning drop, do not just stare at the red percentage.
Look at the chart.
Look closely at where the price is finding its floor. If it's returning to the exact starting point of the previous rally, it might not be a macroeconomic collapse. It might not be a structural failure. It might simply be the strong hands pulling their algorithms, creating a vacuum and shaking the tree to see if you have the psychological fortitude to hold on.
But understanding this mechanism raises a profoundly important, almost existential question for the modern financial system. The entire architecture of this strategy relies exclusively on the predictable, emotional capitulation of the weak hands.
They need you to sell.
The strong hands need you to panic so they can harvest your cheap assets. So what happens to this entire historical ecosystem if retail investors simply figure out the game? What happens if the masses refuse to be swept and flatly refuse to sell?
Can the strong hands actually be starved of the liquidity they crave, breaking the cycle? Or do the massive institutions control enough algorithmic leverage to force the market down and execute the sweep regardless of our behavior?
It's the ultimate test of wills.
That is the ultimate unresolved paradox of modern financial mechanics. Are we participants or are we just prey? Thank you so much for joining us on this deep dive into the hidden architecture of the market. Keep your wits about you. Stay analytically disciplined in the murky waters, and most importantly, keep your hands strong.